Good morning. It is 9 a.m. on Tuesday, February 8th. I'm Julie Hyman. That's Brian Sozzi. This is Yahoo Finance Live. Let's take a look at futures here this morning. We're not seeing a heck of a lot of movement, and what movement we are seeing is mixed, as we've got Nasdaq futures off about 1/5 of 1%, Dow futures up about the same amount, and S&P futures hovering somewhere in the middle here, indicating a slightly lower open. I've got my eye on bond yields as we have been watching them. That big move upward after the jobs report has really held and extended here, even though we're not seeing much movement this morning. 1.95% is where we stand on the 10-year, and that definitely bears watching. Let's call the whole thing off. NVIDIA cancels its acquisition of ARM, even as its recent growth catapults its market cap over that of Meta. We'll discuss what's next for the chipmaker as Softbank now prepares for an IPO of ARM. Shot to the stock. Pfizer shares sink as the company's forecast for vaccine and COVID treatment revenue misses estimates, down about 4%. And no sugar tonight. Novo Nordisk CEO joins us to discuss the drug maker's blockbuster diabetes-fighting franchise and its foray into obesity treatments. But first, what's next on the playlist for Peloton? John Foley riding off onto the sunset, so to speak. At least he is stepping down as CEO after co-founding the company just about 10 years ago, and he will remain executive chairman of Peloton, which has been, of course, under a lot of pressure, including activist pressure, which we'll get to in a moment. But replacing him will be Barry McCarthy, who's a former chief financial officer of Spotify and Netflix. As part of the company's announcement today, it also said it's going to be cutting 2,800 jobs, which is about 20% of its corporate positions. And basically, Peloton trying to fix some of its overcapacity issues, as we have seen from recent reports and from the company's commentary itself. Demand has fallen, and it had ramped production way up to meet hot demand during the pandemic that has now fallen off, leaving it with too much stuff. So that's part of what's going on for the company. At the same time, Peloton, which was supposed to report after the close day, reported its numbers already and reported a wider loss than analysts had been looking for. There's a lot to pick through here. Brian Sozzi, we've been talking about this company a lot, and obviously that should be a loss up there on the Peloton numbers. Obviously a lot to dig through.
A lot to unpack, and you're probably not going to unpack it all today, Julie. This is a story that's probably going to be hot really for the next couple of days. But I've spent the morning just trying to, talking to a lot of folks inside the company, familiar with the new CEO, incoming CEO of Peloton, Barry McCarthy. Let's start here. First, it's going to be a very tough day inside of Peloton here. Of course, there's a human toll here. They essentially told 2,800 people, I believe that's 20% of their corporate workforce, that they will no longer have jobs. So internally today, they will be meeting with, the powers that be will be meeting with HR folks and getting that process under the way. And you have to wonder, at what point does that impact the company's content? Now, there are no cuts to the company's content. Content is the lifeblood of Peloton. No cuts there in terms of instructors or content. That's a good thing. But again, still, it's tough to see 2,800 people essentially sent packing because of a few really bad quarters here at the company and being under pressure from an activist. Number two, Barry McCarthy, lots of street cred on Wall Street. This guy is the real deal. He is the architect of Spotify's direct listing in 2018, was also, when he was CFO of Spotify, also the longtime CEO of Netflix in his prior life. Is really viewed as a numbers master and could be the right guy at the right time at Peloton to come in there, get the company's foundation correct, then perhaps in a couple of years hand the CEO baton to someone else. I was talking to a few folks who are familiar with how McCarthy led in the CEO role at Spotify. They really highlight his understanding of the subscription-based business model, which is very important because obviously at Peloton, that is subscription-based. And last but not least here, too, new letter which Yahoo Finance obtained from the activist investor over at Blackwell's Capital, Jason Untabi. I have a story on this now on the Yahoo Finance homepage, but effectively he's ripping Foley again because Foley's not going anywhere, Julie. He's still going to be the executive chair of the company, and Untabi is arguing that Foley essentially picked the new board members to Peloton in a 65-page presentation, new presentation from Untabi. He's making the case that Peloton is essentially worth $65 to about $75 a share, lists a long list of potential suitors for the company, which he wants to see. He wants to see Peloton sold. One of those companies highlighted as Spotify. That looks unlikely. Sirius, unlikely, but he, of course, also listed Comcast, Disney, Nike, and even a Dick's Sporting Goods here. Fascinating presentation, one that I'm still going through.
How many companies did he list as potential acquirers, Saz?
Well, please hold, Julie, as I go
I feel like
get that
it's
number
like
for you.
everything but the kitchen sink. He put Berkshire
3,
Hathaway
6,
on that list.
12.
He put Oracle on that list. Like, is there anybody he didn't put on that list as a potential acquirer?
He listed 12 viable suitors, so 12 in total I would say is viable. Disney, Viacom, Comcast, they're on top of the list, but he also goes on to note, Julie, he is just slamming Peloton here for one, lack of management qualifications, poor decision-making, lack of financial discipline, misalignment of interests, loss of credibility. And Tabi, the activist on Peloton, is making the case that Peloton has great assets, but as a standalone company, it will take a long while for them to regain credibility of Wall Street, just given how much of a disaster the company has been over the past 6 months.
I mean, McCarthy doesn't seem like an inexperienced executive, to your point. So it's interesting here that he is not happier about that. Something else that we have to talk about when we talk about Peloton today is what the stock has been doing in the past 48 hours, or really in the past week. But yesterday we saw a 21% surge in Peloton because of speculation about a sale. After a report that the likes of Apple or Amazon might be interested here, the stock then fell when we got this management transition announcement, because initially the first blush reaction seemed to be, well, if this is what they're doing, then maybe that means a sale is less likely. Now the stock is up again, as investors seem to be saying, well, maybe a sale could still happen, right? I think that seems to be the sort of chatter that is out there as we have seen the stock swing down and then up again in pre-market trading. So we'll see. We're going to talk to an analyst a little bit later in the show to see what he thinks about what this means for the stock sale, and for that matter, what you should be doing as an investor with the stock at this point. Let's move on to another story that we've been watching closely that now seems to be nearing a conclusion, or at least the next phase, and that's NVIDIA and ARM Holdings. NVIDIA have been planning to buy ARM from SoftBank for $40 billion. They agreed to that deal back in September of 2020. Now they're saying, not going to do it. And that's because it had faced a lot of regulatory hurdles. Now SoftBank instead, ARM's going to be a public company. Dan Howley has been following all of the developments for this. So this was going to be what? The biggest chip deal ever, right, Dan? Oh, Dan, I think you're muted. No, not muted? Here you are. I hear you.
Yeah, okay, sorry about that. That's right. That's part of the reason why there's been so much regulatory pushback from around the world, really. This kind of started hitting a wall in the UK, where ARM is based. They started looking at it as a national security concern. We didn't even get to the EU or China, which were also supposed to look over it, because then that Federal Trade Commission stepped in and they filed suit against NVIDIA to block the deal. At that point, they had basically said this proposed deal would distort ARM's incentives in chip markets and allow the combined firm to unfairly undermine NVIDIA's rivals. So it was basically the idea that because NVIDIA would own ARM, NVIDIA is an ARM customer, NVIDIA would have the incentive to then block its competitors from being able to access that kind of chip technology from ARM. We're talking the likes of Qualcomm, we're talking the likes of Intel. Basically every company under the sun uses some form of ARM chips. So they essentially said, look, we're not going to allow this to move forward. Now, this morning we had Jensen Huang, he's the CEO of NVIDIA, come out and say basically that though we won't be one company, we will partner closely with ARM. The significant investments that that's Masayoshi-san of SoftBank Group, has made have positioned ARM to expand the reach of the ARM CPU beyond client computing up to supercomputing, cloud, AI, and robotics. And that was the way that Jensen was originally positioning this deal. It would allow NVIDIA to make significant investments into ARM to push them forward into areas like AI and the cloud. And because the ARM chips aren't necessarily used so much in the cloud, it's really Intel, AMD, and to a lesser extent NVIDIA. They wanted to see if they could push ARM into the cloud more and really take on the likes of NVIDIA and AMD in the cloud space. But this deal not going through, and NVIDIA is still on the hook for $1.25 billion that it has to provide to ARM because the deal fell apart.
Yeah, and the shares of NVIDIA are pulling back a little bit this morning. They have been really quite an outperformer, though, over the past several years. But it's interesting, Dan, because you and I spoke to NVIDIA CEO Jensen Huang back in November. And even then, he was laying the groundwork for this potentially to not happen and talked about NVIDIA's sort of standalone strength. Let's listen to what he said at that point.
We would go forward very nicely as we're going forward today. We have, we support every CPU in the world, and we support x86s of Intel's x86, AMD's x86. We support ARM CPUs of our own. We support ARM CPUs of others, and so we support all CPUs.
So Dan, I'm just curious also what you're hearing from analysts and other folks in the industry. Since, again, this isn't a shocker that it's not happening, but what does this imply for NVIDIA going forward?
Yeah, I mean, it really does seem like Jensen was just setting that up as we spoke to him there, because look, it's not like ARM isn't going to make its products available to NVIDIA, or even that NVIDIA wasn't able to access ARM's technology. ARM is the Switzerland of the chip industry, and they allow everybody to use their technology, their chip designs, and go forward and build off of them. So it's not as though NVIDIA doesn't already use ARM. In fact, they do. It's actually the chip that powers Nintendo's Switch console is an NVIDIA chip based on ARM technology. So they'll continue to be able to have access to that. And then for ARM itself, we'll start to see them attempt to go public in the fiscal year ending before March 2023. But when investors and analysts were looking at this previously, they essentially had said, look, this looks like it's going to be dead in the water. One analyst I spoke to said this was dead in the water the moment it was announced because they didn't think it was ever going to go through. And I think it was a long shot from there.
Very interesting. We'll see what the demand will be like for ARM itself when it comes back to public markets. So Softbank expected to IPO it at some point. Thank you, Dan. As we're watching NVIDIA as well, Brian Sozzi, I just wanted to mention something else. I mean, first of all, NVIDIA is typically a trending ticker on yahoofinance.com. Here's a list of the top market caps in the United States in the S&P 500. And NVIDIA, you see now at number 7 as of yesterday's close, leapfrogging Meta. I mean, partly that's a function of NVIDIA doing well. Obviously, partly it's a function of Meta falling a lot too, Saz.
Yeah, no, it pays to be in plumbing. The market has rewarded AMD, it's rewarding NVIDIA, and it's not necessarily rewarding those companies that are building on top of the tech plumbing here. So not surprised to see NVIDIA here with its game-changing technologies just blow away Meta. Bye-bye, Meta.
Yeah. And we're going to talk more about Meta later in the show and the underperformance that we have seen here. But first, we got to talk about Pfizer and its numbers this morning, because there, too, we saw a disappointment. The shares are off by 4%. And the disappointment is in the revenues. You can see a little bit there. It's also in the forecast for 2022, sales and profit forecast from Pfizer, missing analyst estimates. And what's interesting here is it's the vaccine for COVID-19 and Pfizer's treatment that seemed to be the core of that disappointment, which is definitely a surprise here because Pfizer has been obviously selling so much of it. You could point out as well that the stock decline this morning is coming on the back of what has been strong performance from Pfizer.
I know we always tend to, the market always looks, as they say, forward, Julian. It's always concerned with growth rates. I understand there might be some disappointment here, but take a step back. Here you have Pfizer outlining this year potentially $102 billion in total sales. Last year, they had $81.3 billion. Their earnings outlook is about $2 per share higher than what they produced last year. So again, this company continues to drive major sales, major earnings. It's not just because of the COVID-19 vaccine. They're in leadership positions in many other markets here. Understand the disappointment, but I would encourage investors to keep in mind just the growth this company is putting up on top of very large numbers from last year. It's very impressive.
True, but that $102 billion, as large as it is, analysts apparently were looking for $4 billion more. So there you go.
They're all
That's
so
part
greedy.
of what.
So greedy.
It's an
greedy.
It's an expectations game, as always. Just wanted to quickly mention as well Novavax. We're watching those shares as well because there's some talk that company is not shipping out as much vaccine as it had thought. As it starts to get some approvals here, those shares, by the way, are down by almost 9% this morning. All right, we got to take a quick break. When we come back, we'll be talking more about the recent action in the market as we see quiet futures trading this morning. Investors taking a step back, figuring out what the heck should they do next. We'll get a perspective on that from Principal Global Investors Chief Strategist Seema Shah coming up next.
dose of calm has returned to the markets, at least before we get what may be another hot read on inflation in Thursday's CPI report. But will that calm last? Seema Shah is the chief strategist at Principal Global Investors and joins us now. Seema, always nice to see you. It feels like the calm before the storm in the markets. Would you agree with that?
Thanks for having me on. I think there's a little bit of calm. I think that's probably just the market taking a sit back and trying to digest all the data, the central bank moves from last week. Sorry, and trying to figure out how that's going to move on.
Seema, you know what? Why don't you grab water if you have water right next to you? And let's talk a little bit about what we're seeing here in the futures this morning, given what Brian was just asking about. We were talking about the futures down a little bit. You know, Saz, I would actually call it the calm after the storm, maybe, given what we've seen recently, or the calm between storms. I don't know. You know what I mean? Like we've had a lot of storming.
It feels like a tsunami is about to wash over the heads of these investors. I mean, calm markets for the past week and a half, and it feels like everyone is just waiting for that CPI report on Thursday. But look what's coming out over the next couple weeks. More potentially hot reads on inflation, a rate hike in March, earnings thus far. I'm not sure about you, but I have not been impressed. Netflix earnings disappointment, Meta disappointment, Pfizer. I know I just said the results were impressive, but still the market is viewing the results out this morning as disappointing. So again, there's a lot to be concerned about here.
Seema, are you still with us? Are you okay? Checking back in with Seema here. Awesome. Okay. So let's get back to it then, and how you're thinking about kind of what phase we're in at this point.
Yeah, look, I think the market is just digesting. I mean, there's been so much happening in the last few weeks with regards to central banks, the inflation, the labor market picture, and I think the market is just digesting that. I actually think a little bit of the calm is down to a greater understanding and acceptance that actually the economy is still doing pretty well. So although you do have the rate hikes coming, this growing sense that actually the economy is able to digest those hikes without too much trouble. And I think that's what's settling markets right now.
But Seema, it doesn't concern you that growth is slowing?
No, I think that is to be expected. I mean, we had such tremendous growth rates last year, and after the pandemic, it was a significant boom and impossible to sustain. Now, what we're seeing from here on is a more sustainable pace of growth. You'll still see consumers which are very resilient. They're still backed up by excess savings. You're going to see some supply chain normalization. So you'll see a boost to inventories and production. And most importantly, you still have corporate balance sheets, which are very, very strong. So it's a softer pace of growth, but it's nowhere near a recession.
And so what should people be thinking in this environment in terms of strategy here as we see slowing growth, but something that's not going to be grounding to a halt?
Yeah, well, look, I think, we can't assume that everything is completely fine. Clearly, things are becoming a little bit more challenging. And this is a point where we start to kind of divide up the market. We start to look for companies which have got strong balance sheets. We start to look for ones which have got the positive cash flow, which we continue to deliver earnings. So that's what the focus should be. And that might be that you see some which are spread out over growth, some spread out over value, some cyclicals, defensives. It's really not about style or sector. It's really about understanding a lot of those company fundamentals and looking for ones which have growth over the long run. So I think that's really the theme going forward. And I have to say the quality, given things becoming more challenging, is probably where the kind of key area that you want to be focusing on.
What grade would you put on earnings season so far?
Probably a B, right? If you assume that the previous couple of earnings seasons were an A, this is a down step, but this is also anticipated. So I don't think it's meaningfully surprised to the downside. It's just that met that kind of quite modest anticipation that we had.
Well, it's been a while since I've been in school, but B, it's still a passing grade. We'll leave it there. Seema Shah, Chief Strategist and Principal Global Investors. Always good to see you. All right, Peloton shares are up slightly after the company announced it's getting a new CEO, but there's lots more to discuss besides the debacle over Peloton, including earnings out of Take-Two, Chegg, and many others. Stick around.
Welcome back to Yahoo Finance Live. We are watching a number of different earnings-related movers before the opening bell today. Harley-Davidson is one of them. Surprise profit for Harley-Davidson, and the shares are up by 7.5%. Adjusted profit 15 cents a share. Had a 44-cent loss a year earlier, and analysts have been looking for a loss as well. Revenue from motorcycles and related products, $816 million. I mean, basically, Saz, we have seen a pretty sizable turnaround for Harley-Davidson.
It is a different company, and we've talked with new CEO Jochen Zeitz back in December. We talked to him in December when they announced the spinoff of their electric vehicle operations. You did get the sense that the company continues to look for areas to cut costs. Now, I do not see those cost cuts per se typed into the company's outlook for this year, looking for revenue growth of 5 to 10%, operating income to fall 20 to 25%. Looks like they're cutting back a little bit on CapEx, but still, the stock this morning looks to be trading off that revenue growth number in this most recent quarter up 40%. Now, that is not a number you have historically seen from the likes of Harley-Davidson. Reflects, I think, a more streamlined portfolio from the company. Also, number two, sales in the North America market up 8%. Obviously, North America remains the key driver of Harley-Davidson's business. So to see sales up there 8% while seeing some pressure overseas, I think the market likes that as well.
Yeah, definitely. So it's not just obviously not just a cost-cutting story. It's also a getting the portfolio right and selling more bikes too. So not definitely good news for the company. Let's also talk about Take-Two this morning and that company's numbers. Net bookings is something that gets attention at something like a video game maker. And net bookings came in short of Wall Street estimates. It was $866 million, just short of what analysts have been looking for. The company's forecast for net bookings in the current quarter is also below what analysts have been looking for. So that not helping matters. And that $866 million of revenue overall missing estimates, earnings per share beating estimates. But also, it's a pressure cooker kind of video game market right now, Saz. I mean, yes, Take-Two's buying Zynga. That's expected to close in its fiscal first quarter, which I believe is going to be early next year, if I've got their fiscal years right.
You got it. Got it.
But even so, Take-Two is still, I mean, it's just such a competitive market right now.
Yeah, just looking at some of the analyst notes, Julie, that have hit the wires off of this quarter, looks to be some Grand Theft Auto fatigue. At least that, I think, is one of the street's takeaways after that earnings call last night with Take-Two. But look, there are positives here. You have NBA 2K22. They sold 8 million units in the most recent quarter. That is very impressive here. Overall, bookings are still growing, just what you mentioned, Julie, just not living up to market estimates here.
Yeah, although some of the analyst commentary this morning is still pretty positive that this is sort of a temporary setback, if you will, for the company. So we'll have to see what happens here when it comes to Take-Two. And then also we are going to be looking at Chegg. Chegg is the
Love that
one-time,
name.
well, I guess they're still a textbook publisher, right? But they also do more than that now that a lot of textbooks have gone beyond just the physical textbook and have gone online. But the company coming out, as you can see there, with numbers beating estimates, and the company's forecasting the first quarter numbers ahead of estimates to both revenue and EBITDA for the first quarter, going to be ahead of what analysts have been looking for. And basically, it looks like expectations were running pretty low into this report. And so coming in better than expected was a relief to the street. And the shares are up 6.5%, Saz.
A little bit of I think a lot of folks in the street are breathing a sigh of relief. It was just, I believe, 3 months ago where the stock was absolutely obliterated to shreds after the company's most recent quarter. So Chegg coming out here, seeing some strength in the services, seeing some upside in sales and operating profits. The street is loving all of that.
Yeah, it looks that way, definitely. As you say, on the back of some pretty lousy performance going into this. We're about 30 seconds from the opening bell here on this Tuesday morning, and it looks like we are potentially going to get that mixed open. That's where the futures have been pointing this morning. So we'll be watching for that in just a moment. And, it's not as much a macro-driven story today. We have a lot of these individual earnings movers that we've been watching for, and we'll see how all of that pushes the market around. last opening bell here on this Tuesday morning. Remember, of course, it's Black History Month. The NAACP representatives ringing the opening bell here on this February 8th this morning. And if we take a look at what's going on with the opening bell and the opening prices here this morning, we are seeing that mixed picture that we were anticipating. The Dow trading higher by about 1/3 of 1%. The S&P, very little change to the downside. And the Nasdaq is off by about 1/5 to 1/4 of 1% here this morning. So as I say, a lot of this having to do with the individual movers that are going on. And speaking of those individual movers, before we go to break, just want to check on some of the big ones that we have been watching very closely this morning. Peloton shares up 2.4%, almost 3% now, as we get the news that John Foley is going to be stepping down as CEO. He'll be executive chairman. Barry McCarthy, former CFO of Spotify and Netflix, is going to become the CEO of Peloton. And now there's a lot of speculation about what's going to happen to the company. Is it for sale? Is it not for sale? What happens next? We'll be talking about that more in just a bit. NVIDIA calling off its acquisition of ARM Holdings amidst a lot of regulatory pressure, and that company is going to become a public company after it spins off from Softbank. And Pfizer, with a forecast that fell short of estimates, particularly because of vaccine and COVID treatment sales not necessarily being as robust or as optimistic as some very lofty estimates perhaps that are out there. So we are going to continue to watch these stocks. And coming up next, the CEO of pharma giant Novo Nordisk is going to join us to discuss the company's latest earnings and the state of the industry. Stay with us.
While COVID-19 vaccine makers are still focused on putting an end to the pandemic, pharma giant Novo Nordisk still locked in on ending diabetes. Let's talk more about the state of this mission and the company's latest earnings with Novo Nordisk CEO Lars Fruergaard Jorgensen. Yahoo Finance senior healthcare reporter Anjali Kamani is here as well. Good morning to you both. Lars, look, the pandemic, we're very much still smack in the middle of it. How is this, impacting how you go about ending diabetes?
Well, we have a business that's serving chronic disease, diabetes being the leading one. So we're really seeing a constant demand for our products. We've also seen that during a pandemic, being in good control is really important. And we're also now focusing on obesity. And we all know that living with obesity can be an extra factor when you capture COVID-19. So really, it's been beneficial for our business.
Lars, I'd love to dig into that because obviously we know there have been a lot of things that have come out throughout the pandemic as health sort of trends. One of the things that you're really focused on, especially going back to the larger portion, which is diabetes, is patient outreach. And I want to know a little bit more about that. Throughout the pandemic, we've seen, the growth of technology platforms. How do you plan on leveraging those specifically to really increase this?
Well, we have a strong presence in diabetes, both with our insulins and our GLP-1 products. And we see that it's still possible to drive innovation in those fields. We are trying now to do a weekly insulin. That will be a major change. Today, insulins are injectable on a daily basis or frequently during the day. And also, when you look at GLP-1, we are now seeing that we can make them both weekly injectable, but also available using new technologies as all administrations. So still a continued deployment of new technologies to advance these treatments for the benefit of patients and driving better outcomes and health benefits.
Lars, it's Julie here. I know you talked on your earnings call last week about a normalization of the supply chain and getting back up to speed when it comes to supplying all of these drugs that you all make. Talk to us about when you expect to get here. I know you talked a little bit about second half of the year. What sort of needs to happen in order to get there?
Yeah, we faced a situation where probably the strongest launch we have ever made in the history of the company, launching a new anti-obesity medicine called Wegovy in the US, was suddenly facing some supply issues, partly because of really, really strong demand, much stronger than we had anticipated. But we also faced some quality issues with one of our contract manufacturers. That is now being fixed, and we expect that this facility will be up running again towards the end of the first half of the year. So we can really, from the second half of 2022, supply the full demand in the US. So second half of this year will be a really interesting period for us as we get this capacity online again and hopefully see a very strong uptake of our anti-obesity medicines.
Lars, when you say supply chain challenges, where are they most acute? Where are you seeing that you just can't get the amount of products that you need?
So we have one particular issue in one facility, which is linked to some compliance issues. That's leading to some maintenance of that. But if I should talk to some of the general issues in supply chain, then it can, for instance, be in packaging material, where we can see that because of more complex distribution, scarcity in products, it's becoming harder to source these. But we manage and we get all the materials we need, and we can supply the patients who rely on our medicines. So it's taking more hard work, but we cope with it and we handle it. And so far, patients are getting the medicine they need.
Lars, I wonder about that. Looking at sort of broadly what we've seen throughout the pandemic and the learnings from that, supply chain constraints have been on and off an issue that you've had to contend with. When you look at it for the 2022 outlook and looking at where we are, in the pandemic with the world the way it is, and you having a really large stake in the diabetes market, something that we've seen constantly discussed when it comes to pricing concerns over the years, I wonder how you see this all shaping out in terms of whether or not there's been a shift in strategy or how you plan on moving forward with some of the issues in the past behind you.
Well, we have a global leadership role in diabetes and providing a good part of the world's insulin. And when you talk to pricing issues, obviously there's a lot of talk about insulin pricing in the US. It's really important for me to underline that the price we get for the products we sell in the US, that price is actually going down, and it has been going down over some years. So when patients are struggling affording insulin, it's actually not because of the price we get, it's because of the complex healthcare system that's in place. We are trying to do our part. providing support program for patients. For instance, if you are short of insulin and you are in a situation where you have to ration your insulin, you can walk into a pharmacy and get access to free insulin from Novo Nordisk. So we're trying to be there for those patients who struggle to afford based on the complexity of healthcare design and insurance design in the US.
So Lars, not that it's happening imminently in the United States, but given that you certainly have experience with other national health systems around the globe, what would be the effect on your bottom line if there was a change in the healthcare system in the US to make it more of a universal or nationalized system?
Well, that's the system we operate in most countries where there is one single buyer. So we are actually used to deal with that kind of structure. Today in the US, we give, whenever we sell a product, we give on average 75% in rebate. And for instance, that number is actually higher. So those rebates do not always get to the patients, and that's what's causing the problem. In the rest of the world, we so to say only have one price, which is the net price after rebates, which is now similar to what we get, for instance, in the US. So we are used to competing in different market structures, and I think also in a changed structure in the US overall healthcare system, we can handle that.
So Lars, I don't want to get you in trouble here, but is the implication that this system is better for patients in other countries and in a nationalized system?
Typically in the US, there is a broader access to innovation. So new products are launched in the US as the first country. So it's really a country that's open for innovation, which is benefiting patients. But it's also a country where you have a complex insurance design, which for some patients create problems. If, for instance, rebates were passed on to patients, obviously they will get the benefit of the rebate we are paying, which is not the case today. So there are different ways to deal with it. The important thing is that we are actually trying to help those patients. So we have a quite complex and broad set of support programs where we try to help those who fall between, say so to say, the cracks of those complications. And a significant number of Americans are actually benefiting from those. And if the system changed, obviously, we would not have to do that. So that would make it easier for us. But I don't anticipate near-term changes in this complex environment because it's a bit of a gridlock system. So we focus on helping the patients that are in need of our products today. And I feel good about how we do that.
Gridlock is putting it mildly. Always good to get some time with you. Novo Nordisk CEO Lars Fruergaard Jørgensen. Good to see you as always. Yahoo Finance senior healthcare reporter Angeline Kamlani. Thanks so much. All right, shares of Peloton are on the move higher after the company announced a shakeup to its leadership and released earnings earlier than expected. We'll discuss more on the other side of the break. Under activist pressure, Peloton will appoint former Spotify CEO Barry McCarthy as new CEO. Peloton founder and CEO John Foley will move to the executive chairman role. The company will also slash 2,800 corporate jobs. Joining us now for more is Oppenheimer analyst Jason Helfstein. Jason, always good to see you. Busy morning for you, I am sure. Look, I think getting lost in the sauce a little bit. They reported earnings, another big loss, tough outlook from the company, job cuts, a letter from Foley. But loss here, I think, is who in the world is Barry McCarthy? What's your understanding of Barry's leadership here, and what might he bring to the company?
Sure, Barry's pretty well known to the investment community. He was a longtime CFO at Netflix as they made the transition from DVDs to streaming. He then effectively retired from Netflix. He came out of retirement to help Spotify with their IPO via direct listing, which at the time was controversial way to go public, and they were successful with it. Then kind of retired from Spotify again, so he's coming out of retirement basically for the second time to helm this company.
Jason, is his mandate to, just given his background, Netflix CFO, Spotify CEO, 2 longtime successful stints there, is this his mandate just to get the foundations right at Peloton and then ultimately shop the company for sale?
I think that's right. I don't think Barry is looking to work 100 hours a week at this company. I think this came together, it seemed reasonably quickly. But this was a way, I guess, for CEO John Foley to kind of, to some extent, save face. So he's joining the board. He still has his 40%, super voting stock. But I ultimately think this company probably will get sold. But given numbers, analysts will reduce estimates this morning following their quarterly announcement and their revised guidance. But I don't think the company would be willing to sell off of probably what will be the new 22 numbers. I think they want to get credit for some of the restructuring that they'll do that should benefit gross profit over the next 12 to 18 months. Look, I just to put it simplistically, the revised guidance has connected fitness subscribers down about 8% for this fiscal year. So it's not catastrophic. But there's a bigger impact on gross profit because their cost structure is inefficient right now. And that's why they announced such a significant cost reduction.
So, Jason, what do you do with this stock? In the meantime, do you hang on and wait for the thing to get sold?
Yeah, so look, we had an outperform. Yeah, we had an outperform rating going in today because we just felt the stock was just way too cheap relative to other subscription businesses. We think that they are the leader in connected fitness. They have a great product, loyal user base. The engagement metrics, albeit slower, are still very strong. And we think this is a lot harder to do than maybe others think. And we think there effectively will be kind of minimal competition from here because it's going to be hard for any other company to get probably public or private market funding. Perhaps the only companies that will get funded may be strategic funding. So ultimately, we think they are the winner. We think there's value here if you look at what other subscription companies trade at. Look, we do think the company probably will get sold. If not, it becomes a turnaround story. We haven't updated our model yet since we just got a bunch of new information this morning. So kind of stay tuned where we shake out. But, look, you could look at the market reaction. I think the market is happy that CEO John Foley is not digging in, is kind of backing away from operations. They also announced that their longtime president, Lynch, is also kind of joining the board and stepping away from operations. So there is an acknowledgement that they do need to bring in perhaps some people who have just more experience with a company at this scale and size than the management team who really kind of founded the business and had more of a startup culture experience.
Jason, on the heels of this, the activist investor Blackwell's had a position, I believe about a 5% position here based on my reporting in Peloton. They're looking for, they see fair value for Peloton, $65 to $75 a share. Does that make sense to you?
Yeah, I'm not going to comment. We haven't published anything in that regard. But again, you can look at where the stock price was at some point Like I said, some connected fitness subs will go, estimates should go down another 8% on the company guidance relative to where they were. Again, this is a very low churn model, meaning, once people join, they stay for years, right? That's what the math suggests, and that's incredibly valuable. I also think what they've built is hard to replicate. I do think there's a network effect here. I do think people want to be on the same network as their friend, right? That's what makes social media work. And so, if you're going to do at-home cycling, you probably want to do it on a Peloton. It is early for the treadmill and boot camp. We'll see kind of where that ends up going, because right now it's just kind of not material to the model right now, albeit they would like it to be material. But again, you could look at the market reaction. I think they're pretty happy with the announcement this morning. Again, that the CEO, and again, Blackwell's like at a 5% position, it's really hard for them to move the needle. I think they can be a megaphone in the public markets, but they're not going to force John Foley or the other large shareholders to do anything. And I think the market's reaction, the fact that they're not digging in, and the company seems to be doing the right thing for shareholders.
Jason, lastly, 2,800 people today are losing their jobs in Peloton corporate. How concerned are you that bleeds over into the content part of their business?
I mean, they did talk about not cutting back on content. Again, you can look at the G&A and the sales and marketing. They did reiterate on the call that they were not going to cut R&D, but there's probably some inefficiency that could come out there. But really, there's a lot of inefficiency on the cost of goods side. They were going to open up another U.S. facility. They basically said, they're going to finish the warehouse and then sell the building and the land. So, look, I think that this company was successful with a lot less content, 2 years ago. I don't think their plan is to cut back on content. And so I think consumers won't notice the difference. This is entirely going to be behind the scenes cost restructuring.
All right, busy day for you. We'll get you back to working those models and those phones. Jason Helfstein, Oppenheimer analyst. Good to see you. All right, the crypto bulls are eyeing a new hearing in D.C. today on stablecoins. Yahoo Finance's Jennifer Schonberger joins us next off her chat with the key witness at the hearing. Stick around.
in just a few minutes, the House Financial Services Committee is scheduled to hold a virtual hearing on stablecoins. They're calling it digital assets and the future of finance, and they'll be talking about that topic. Our Jennifer Schomburger is here with a preview of that hearing. Good morning, Jen.
Good morning, Julie. Treasury Undersecretary for Domestic Finance Nellie Liang set to testify before the House Financial Services Committee this morning on the Biden administration's recommendations for regulating stablecoins. Liang is set to make the case to lawmakers this morning that there are gaps in the framework for regulating stablecoins when it comes to credit and liquidity risk that need to be addressed, especially if they become widely used for payments. Now, last November, the president's working group on financial markets tasked Congress with coming up with new regulations to oversee stablecoins, recommending that only banks be allowed to issue stablecoins. Since that report, Liang told me in an interview ahead of this hearing that Treasury officials have been speaking with lawmakers on Capitol Hill about how to best regulate stablecoins, considering questions about credit and liquidity risks of stablecoins, and whether the PWG proposal is the best way to protect against risks while encouraging innovation. So far, proposals for regulating stablecoins on Capitol Hill have been limited, though Liang told me Treasury is, quote, very supportive of the general direction of new stablecoin legislation proposed by Democratic Representative Josh Gottheimer, which would limit stablecoin issuance to FDIC-insured banks and to non-banks that follow specific rules, including only investing reserves in treasuries or keeping them on deposit at banks. Liang told me on this legislation, quote, I think there are important similarities, but there are specifics about what kind of assets need to back that stablecoin that could differ depending on the degree of supervision. So there are some discussion points there that would need to be had, but in general, the proposals are very aligned. It is something that we are very supportive of the general direction. So I just want to underscore that this is giving us some direction on where Congress could be going and what regulation could look like for stablecoins. Now, separately, I did ask Liang about whether Treasury supports a central bank digital currency. She told me that Treasury is very supportive of an urgent study of one, though stopped short of endorsing an actual CBDC. She says that stablecoins could coexist with a CBDC, and depending on how the Fed designs one, if they do indeed proceed with one, CBDC could actually supplant stablecoins. Now, it really will depend on what the future of the system looks like. She says it's very unclear at this point, and so there are question marks about how the two could interact. Expect that to come up in this morning's hearing. Julie?
Yeah, one of the very important tracks we're watching with everything regarding cryptocurrencies, certainly stablecoin is one of the most important, I think, when we're watching this space. Thanks so much, Jen. Appreciate it. Well, before we go to break, let's get a quick check on stocks about 30 minutes into the session, and we've got a mixed picture persisting here. Coming up next, we're going to have a conversation with BlackRock's CIO of Global Fixed Income. That is Rick Reeder. Always fun to chat with him about his outlook on the markets. And these are the stocks leading the Dow higher at this point. We got Amgen leading the pack. We'll be right back.
Welcome back to Yahoo Finance Live. I'm Brian Sosny alongside Julie Hyman, and we have you covered for the next hour of market action. Now, stocks are tiptoeing into Thursday's CPI report, which could be hot yet again and ratchet back up those Fed rate hike fears, seeing the Dow slightly in the green, the S&P 500 and Nasdaq both slightly in the red. Now, here are a few other things we're watching for you at this moment. Cycling in a new CEO. Under activist pressure, Peloton said it will appoint former Spotify and Netflix CFO Barry McCarthy as CEO. Peloton founder and CEO John Foley will move to the executive chairman role. The company also aims to slash $800 million in costs. I have more on who Barry McCarthy is in a story right now on the Yahoo Finance homepage, so do give it a read. Searching for a bottom, shares of Meta continue to see mixed action following last week's earnings drubbing. The stock lost 5% on Monday and is trading slightly lower in the early going today. Year to date, Meta has shed about 35% of its market value. And the industrial outlook. We'll chat with Carrier CEO David Gitlin following the HVAC giant's better than expected earnings out this morning. Now let's head over to Yahoo Finance's Inez Ferre with a tour of the Wi-Fi Interactive. Inez.
And Brian, let's take a look at oil right now because WTI is sliding down more than 2% under $90 a barrel right now. We've got Brent crude that is also lower. Let's take a look right now at the sector action. As we're looking at mixed markets, we are seeing financials and materials that are in the green, but we've got energy that is losing the most right now, as well as real estate. Looking at the RX, the healthcare players today, quite a bit of action going on here. You've got Pfizer that's down more than 5% after its fourth quarter sales missed estimates. Its revenue forecast for the full year of 2022 also missing expectations. Then you've got BioNTech that is down, BioNTech being Pfizer's partner, working on clearing that under 5 vaccine, down more than 9%. And Moderna is also lower right now. We are looking at shares of Amgen up more than 4% after announcing a share buyback plan. Its revenue guidance came in short of expectations. The stock, though, still really holding up well during today's market action. And then looking at the Nasdaq 100, I do want to mention that we are seeing, of course, Peloton being the best performer right now, being the outperformer of more than 12%. We've spoken quite a bit about Peloton today, but I also want to mention Pfizer down 5%. The fintech company's revenue growth outlook for 2022 came in lower than 2021. That's why you're seeing pressure on the stock. Julie, Brian.
Thanks so much, Inez. Appreciate it. Well, our next guest describes the current market environment as a dense fog. You see him right there, Rick Reeder, CIO of Global Fixed Income at BlackRock. Rick, it's good to see you. You know, sort of creating this fog is a combination of things, right? It's that economic growth is slowing, central bank trajectory is a little bit unclear how they're going to manage the landing. We've got geopolitical risk because of Russia, Ukraine. What of those factors worries you the most right now?
Thanks, Julie. Thanks for having me on. So what worries me the most? I think all of them. But the one that is, the way you described it is actually interesting because, like you say, some of the economic data is moderating. We saw that retail sales. We see that in some of the industrial production. We see in some of the consumer confidence data. But then we just got an employment report that was unbelievably strong, in fact, across virtually every sector. Here's what creates the challenge. You've got a Fed that is behind the curve that should have started moving months ago. By the way, still doing QE today. But you got a Fed that's behind the curve that needs to try and, we could debate needs to, but is going to address the inflation dynamic in the economy today. And so they're going to be aggressive. And the question is, how aggressive they're going to be when the economy is moderating and financial, and how much do you tighten financial conditions? It's a really tough dynamic to pull off if you're the central bank. So the reason why the markets are so jittery and the liquidity in the markets is so rough is because that whole how you land that plane is the dense fog is challenging today.
Do you think they're going to be able to do it, Rick? And I will observe that traditionally the market thinks the Fed is going to be more hawkish than it is, sort of historically, right? So do you think they're going to land? What does it landing the plane look like? Like, is there a certain number of rate hikes that implies?
Yeah, I mean, so first of all, I think landing the plane softly should have started taking place months ago. now you have a dynamic that how quickly do you get back to neutral? Listen, I think the only way to execute this plan today is to move back to neutral. That is ending the QE. You can let the balance sheet drain down. You can do it using the front end of the yield curve. Let the balance sheet come down to, certainly you can get off $1.5 trillion, a couple of trillion pretty easily. And then you get the funds rate to the neutral rate, and which I think over the long term is 1.5. We could debate maybe just under 2%. Listen, I think what markets are concerned about is if the Fed looks at historic conditions and says, gosh, we've got to get inflation that is running, core CPI today, that's running almost 6%. If you're going to have to try and bring that down, you could be more aggressive. That is a tough thing for markets. That is a tough thing actually for the economy. My sense is they're going to try and get to neutral fairly quickly. And then they're going to look at the landscape, because I think as you get into the second or third quarter this year, some of the economic data will be moderating. Some of the inflation data will be significantly less scary than it is today. And so I think get to neutral, move quickly to get to neutral, and then take a step back. That to me is the only way you can functionally land the plane in an effective manner.
Rick, getting to neutral, does that mean 3 rate hikes, 4, 5? Where do you sit?
Listen, to get to neutral, I think the funds rate, running neutral today is 1.5% or so. So I think they're going to get, they certainly can get 6 hikes in. The question is, do you have to get them all in this year? Good chance they're going to move quicker to get to neutral. Listen, it doesn't make any sense to be in accommodative monetary conditions. So do they get there quicker? I don't think they're going to do any 50 basis point rate hikes, but can they do 25 basis point increments quicker? Yeah, I think you can. Listen, I think the Fed needs to turn over, I think for the markets as well, turn over a couple of cards. Let's see the inflation data the next couple of months. Let's see the employment reports. Listen, in this employment report, there were a lot of seasonal noise to it. There was some of this wage component had some noise to it, given the average hourly work week came down. So we're going to get a lot more data over the next couple of months. And I think the Fed would be wise to look at how that transpires from here and then adjust course relative to that.
Rick, I'm going to ask you another sort of philosophical-ish question, which is that, in this period of time when there is all of this uncertainty about how all of this is going to go, what's your highest conviction, whether it comes to the markets or to the economy right now?
Tough question, because it's hard to have a lot of conviction on virtually anything
right.
today. So I'll say a couple of things. One, I do think the economy is going to grow. Listen, nominal GDP last year, depending on how you measure it, was pretty close to 11% nominal GDP. I think this year you're still going to see a good number. So my first point is, I think you could have 7, maybe a bit higher than that nominal GDP, and that's real at about 4%, 3.5% to 4%, and then inflation on the other side of that. So that is my number one. I do think the economy is still growing, and the consumer is still in a robust position. That's conviction number one. Conviction number two, listen, I do think that you're going to reach a point. I think interest rates are going to still move a bit higher from here, but you're getting to levels that are going to start to make some sense, particularly in the front end of the yield curve. You're pricing in an awful lot of hikes to own the front end, the Treasury curve, so 2-year Treasuries type of part of the market. Gosh, the amount of rate hike you'd have to get to lose money would be dramatically higher than where we are today, and I just don't see that as possible. So I like owning some of these front end interest rates to try and protect my principal. And then, quite frankly, on the other side of it, I do think equities are going to end the year higher. I think it's going to be tumultuous over the next couple of months while this data comes in. But then I think these earnings number, when you step back, you're still seeing a dynamic where the earnings are coming in at levels that easily support where valuations are. But I think it's going to take a bit of time. And we're being pretty conservative for the next couple of months because of all the risks and the dense fog you described. And I think by the end of the year, then I think you're going to have equities that are going to be higher than they are today. So those would be my top places of conviction.
By higher, Rick, let's just say the Fed does move with 6 rate hikes to get to neutral, tries to get there quick. Are you still thinking we can get double-digit returns on the S&P 500?
From here, yes. Oh, definitely from here. So let's say where you came into this year, could you hit double-digit returns? Yeah, maybe it's a bit hard, but it's not impossible. Gosh, I look at it. I think there's 3 ways you value equities. It's your multiple or your equity risk premium. It's your discount rate, and it's your earnings growth. If you think that earnings growth, which I do, think that you can get 12%, 12 to 15%. So let's say you lift the discount rate a bit, and then multiple in this environment compresses a little bit, boy, you can still get that low double-digit return. But gosh, do I think from today's point? Definitely. Do I think from where we ended the year you could still generate high single digits? I do, but I wouldn't make a big bet on that in the early February. I'd give it a little bit of time to see how all these dynamics and how aggressive the Fed needs to be over the next few weeks. And by the way, how much inflation moderates so that the Fed doesn't need to be that aggressive.
Well, we get a CPI print tomorrow, so we'll get a little bit more information on that front, but we got to wait a few months to see what the trend looks like. Rick Rieder, good to see you as always, CIO of Global Fixed Income at BlackRock. Thanks so much, Rick. All right, we're going to take a break. Before we do, I want to tell you about another trending ticker that we're watching, Velodyne LiDAR. The shares are up 14%. They were actually up a lot more in after-hours trading yesterday. Amazon disclosed it acquired warrants that could lead to a stake in Velodyne. Velodyne agreed to issue to Amazon a warrant. That warrant good to acquire more than 39 million shares. That's about 16% of the company. We don't know if Amazon is going to exercise that warrant, right, and actually acquire the shares, but the promise, the potential, the possibility of that is enough to send those shares higher. So we'll keep watching that to see if there are any further developments on that front. And speaking of Amazon, by the way, coming up next, Amazon workers could be getting a raise. We'll talk to you about that when we come back. The Internal Revenue Service is abandoning its facial recognition plans after it faced pushback from critics. Last year, the IRS announced it would start requiring people to submit selfies to access their information on its website using a software called ID.me. Then critics warned that giving ID.me access to that much biometric information was extremely risky. Now the IRS says it, quote, understands the concerns. Amazon is raising its maximum pay for corporate workers as the labor market continues to heat up. In an internal memo, the company said base pay for all white-collar workers will now be $350,000, up from its prior cap of $160,000. This pay does not include stock units and other bonuses. In addition to base pay, the company said it's also increasing overall compensation ranges for jobs globally. And Facebook's longest-standing outside board member, Peter Thiel, is stepping down from his role at Meta Platforms. The billionaire tech investor is a close confidant of CEO Mark Zuckerberg. He's also the co-founder of PayPal and an active booster as well for Donald Trump during the 2016 election. Why is that last item relevant in particular? He's going to step down from Meta's board later this year. He tends to focus his efforts on supporting Republican candidates in the 2022 midterm elections. That's according to the Wall Street Journal. So looks like given some of the, political controversy around Facebook at times, perhaps they all agreed it was best for him to step aside. I don't know exactly what was behind that, but Facebook's got to do something. Meta's got to do something, Saz. I was just looking at the stock. It is down 43% from its record high back in last September, 32% just since February 2nd. So, this tumble is not abating. It's not down much today, but it's still down.
Well, Julie, maybe Facebook / Meta should just make a play for Peloton. While I'm on my Peloton bike, I can
I'm
upload
sure that'll
Insta
solve
stories.
everything.
It makes lots of sense. No, but look, looking for two areas of support on the charts. One is the June 2020 lows in Facebook. That was the closing price, $216. And then going back to March 2020, the lows there were $149. It is just, we talked a little bit about this yesterday, not seeing those, big whale investors come up here and buy this, what is just, it's not a dip in Facebook. It's just an all-out rout. It's just been a gash in the company's stock price chart, which is alarming, but also quite telling about the fundamental challenges that lie ahead for this company.
Yeah, and among those, of course, a lot of regulatory challenges. Just wanted to mention that there was a report this morning that picked up an item, a little detail in the annual report that talked about the risk of potentially having to pull out from Europe, given some of the regulatory forces at work there. Seems like it's something that you just say in a filing as a sort of, to cover yourself if those regulatory forces do heat up, but nonetheless, it's something to pay attention to. You're smiling at me, Saz. Is that?
Well, you didn't like my Peloton. You didn't like my analysis there. I'm all for taking, selfies of myself on the Peloton bike, put them on stories. My friends can comment, applaud me in real time, say how amazing I look and what a great job I'm doing on the bike. Makes sense to me. You
can do all of that without Meta owning Peloton, though. You can keep on doing that. I don't know what that does for. I don't know. You know what? And if
I'm trying to boost my
them.
social media presence, Julie. I want more followers.
Oh my gosh, how would you possibly have time? Anyway, we're going to take a quick break. When we come back, beyond yogurt, Chobani's already branched out into some additional product lines, and now it's introducing yet more. We're going to talk to the Chobani president and COO, Peter McGinnis, coming up next. Well, yogurt maker Chobani, or should I say primarily known as yogurt maker Chobani, has been getting into some new product lines. The newest, filtered milk, ultra filtered milk, that is, and half and half. And the president and COO of the company, Peter McGinnis, is joining us now. Peter, good morning. So talk to us about why you guys are expanding into these new product lines, why now, and why did you choose these two particular categories?
Yeah, I mean, we've been expanding beyond yogurt, as you know, and I'm glad that you said partially known for yogurt, for the last couple of years. First, it was oat milk, then it was coffee creamers, then it was RTD, multi-serve coffee. And the latest is half and half and ultra filtered milk. Two exciting categories, one about $1 billion addressable, the other over $3 billion. And so these are exciting categories to get into that are ripe for disruption. Ultra filtered milk is growing 37%. It's value added milk. It's essentially, if you think about it, it's high protein, low sugar milk that's lactose free. It's got very similar characteristics to Greek yogurt. And when we got into Greek yogurt 13 years ago, it was dominated by traditional yogurt that was higher in sugar, lower in protein. Greek yogurt inverse that, and it was higher in protein, lower in sugar. And that's really what ultra filtered milk is. It's functional, delicious milk that's good for you, protein packed with 50% less sugar than regular milk.
Peter, is Coke's Fairlife your main competitor here, and how do you wrestle market share from them?
By putting out a great product from a great brand that's known, loved, and trusted. And so, look, we're familiar to formidable competition. When we got into yogurt, we were up against two juggernauts, General Mills and Dannon. These are multinational conglomerates, and we performed quite well over the past 13 years, and we really like our odds in this space too. Look, I think the branded house helps too. This is Chobani Ultra Filtered Milk, and that brand carries, like I said, a lot of trust. It's known, it's beloved, it stands for quality, and the product's great. It's got 20 grams of protein, which is the most protein in the segment, while being 50% less sugar and being lactose free. And one of the biggest food megatrends in the United States, and it has been for a very, very long time, is high protein, low sugar. That's what people want. And this is 20 grams. So you can make a pancake with it and suddenly you have high protein pancakes. You can make smoothies and everything becomes high protein with this product, which is fantastic.
So Peter, the more product lines you get into, the more milk you have to source. And so as we know, everybody's having supply chain problems all over the place these days. So how are you guys addressing that sourcing and also the cost of that sourcing?
Yeah, no, it's a great question. I think Chobani, we're not immune to inflation and supply chain challenges, just like any company. I'd like to think we're better prepared. And so we produce over 95% of our products in-house. So we have an in-house supply chain where we can control the supply, we can control the quality, and we have long-term contracts with suppliers. And we have backup suppliers and backup to the backups. So we've been able to navigate inflation and supply chain better than most. So our in-stock rates are very high and our service rates are very high. We've been in the mid-90s since the beginning of the pandemic, where many of our competitors, depending on the category, are in that high 70s, mid 80s. And so this is, it's just strong execution to deliver the products on time and in full with a backdrop where demand is unprecedented. Demand is very, very high across our portfolio, whether you look at our yogurt growing 16 to 17% in Nielsen. These are some of the highest growth rates we've seen, to oat milk in the 75 to 80% growth. We're the fastest growing oat milk brand in the country, and to coffee creamers around 80% as well. So very, very strong demand, and it is tricky on the supply chain side of things, but we're navigating it really well. And I'm proud of the team, and I'm proud of the plan that we're executing against.
Yeah, Peter, that is looks to be continued strong demand. Do you think, or are you seeing anything in your data that would suggest consumers are back to hoarding products, because we are still in the middle of a pandemic?
That's a great question, Brian. There may be some hoarding going on, but not perishable products. And again, I want to just underscore the fact that everything I've talked to you about, whether that be ultra-filtered milk or coffee creamers or oat milk or yogurt, is in the refrigerated perimeter. And that's a strategic area that we are in deliberately. It's an area we know well. There's many synergies from a sales perspective and a retail execution perspective and a shelf perspective. And this perishable part of the supermarket has the highest traffic, has the highest basket ring, is the most dynamic in the supermarket. So it's where you want to be. And we just continue to innovate within that refrigerated perimeter. And the brand has credibility to do that and permission to do that. But we don't see any hoarding on the perishable side of things because people just have limited refrigeration space at home.
And stuff does go bad, to your point, eventually.
Stuff does go bad.
You can't hoard that much stuff forever. Yeah, Peter, finally, before I let you go, got to ask you about the IPO because you guys have filed. We know it's happening. Do we know when it's happening? Can you give us a hint? Can you give us a range? Can you give us a ballpark?
I admire the try, and it's and I totally admire it, but I can't talk about the IPO right now. All I can say is that we're focused on continuing to drive the business and perform and grow and steal share and get these new categories to where they need to be. And we're super encouraged where we are, but there's more work to be done. We've had explosive innovation and we're just focusing on making that successful and continue to perform in a pretty tough environment. And like I said, we like our odds and chances, and we're just focused on the business right now.
Well, thanks for coming on, talking to us about this update. We look forward to any further updates on that front too. Peter McGinnis, Chobani President and COO. Good to catch up with you. Appreciate it. We're going to take a quick break. When we come back, shares of Simon Property are down almost 6%. Brian Sazi has thoughts. We'll get them when we come back. Are people still going to the mall? I know Brian Stassi goes. He goes to do channel checks, of course. But what did we learn from Simon Property Group's earnings? Because they own malls.
Well, Julie, the shares are down this morning, and you know me, I will not miss the opportunity to actually shred a retailer or really any company that is not doing things correctly. But I want to give a little bit of a pat on the back to Simon Property here this morning. Stock is down. They're looking for earnings to fall, earnings per share to fall this year. Market is not liking any of that, but always a colorful earnings call from Simon Property CEO David Simon. A couple things worth highlighting. One, they said last year they signed 4,100 leases for a total of more than 15 million square feet. That is impressive considering the ongoing shift into online shopping, in part which has been accelerated by the COVID-19 pandemic. Simon Property is still signing up tenants for its malls and outlets. That is a good thing. Simon noted that was the highest amount of leasing activity they have done in the last 6 years. Very impressive here. Also noting mall sales in the fourth quarter were up 8% in the fourth quarter and up 34% in the entire year. Again, those are pretty positive things, just given that structural shift to online shopping. And also one fun fact here, Julie, Simon Property and Brookfield are now owners of the struggling JCPenney, bought that dying brand out of bankruptcy. Simon noting on the call, he says JCPenney's results were, quote, impressive. I have not heard that about JCPenney in, I don't know, 25 years. Secondarily, also noting that JCPenney's liquidity position is now $1.6 billion, which is a good thing to see, given many Simon properties are still have JCPenney's as anchor tenants. That's large part why Simon came here and made a play for the company. Part of the reason for the earnings outlook, though, and the earnings reaction here by the street, a lot of investments. Simon highlighted in JCPenney, Aeropostale, other companies the company's involved in here. So they're going to invest aggressively this year to help build back some of these brands. And perhaps in 2023, you'll see an earnings reacceleration.
You know, when the expectations are for something to do nothing, then any outcome is impressive, right?
JCPenney's back, Julie. All right, JCPenney. Love it. Great.
The fact that JCPenney exists is impressive.
Here comes the SPAC.
Maybe the bar is that. Here comes the SPAC. Oy. All right, we're going to take a break. Before we do the stat of the day, here's a fun one for you. When the Super Bowl is played west of the Mississippi River, the average return of the S&P 500 in the subsequent year, 9%. When it's played east of the Mississippi River, the S&P returns a more robust 14.3%. S&P Global coming to us with these facts. Either way, it's higher because stocks go up. So who cares where the Super Bowl's played? All right, we're going to take a break. When we come back, carrier shares on the move. They're about 0.5% higher following the company's better than expected earnings. The company's CEO, Dave Gitlin, joins us next.
Industrial giant Carrier is out with better than expected earnings powered by demand for commercial HVAC systems and refrigerated truck technology. Joining us now is Carrier Chairman and CEO Dave Gitlin. Dave, nice to see you as always. Thanks for taking some time. The HVAC component of your business, strong there in the quarter. Is that mostly related to the pandemic and offices looking to replace the ventilation in their buildings?
It's a variety of factors. Clearly, healthy buildings drove significant growth for us last year. I mean, we saw things like $500 million of orders just driven by the trend around healthy buildings, going in with a $700 million pipeline, just driven by that one element. Sustainability is a big theme driving HVAC sales. Work from home helped our residential business, which saw very, very strong growth. We saw great share gains in our light commercial business. We saw 350 bips of share gains there, and that market's been up significantly as people go back into schools, back into some of the retail places. So there's a lot of factors driving HVAC growth. But if you look broadly, last year we thought our overall sales were going to be up about 5% organically. We ended up with 15% organic growth last year, and HVAC was a big factor in it.
And hey, David, it's Julie here. And where is that demand coming from specifically? You talked a little bit about schools and about retail. I'm curious also about office, because if people aren't going back, does that mean buildings are updating systems more slowly, for example, or not building as many office buildings? What are you seeing on that front?
Office building demand is strong as well. So we're seeing strong demand in K through 12. That was up significantly, especially in the United States last year. We saw very strong demand in our residential business. I mentioned our light commercial business, which plays to kind of retail and some of the restaurant kind of business that's starting to reopen. But then commercial office buildings, we're seeing orders up significantly and that included in January. So there's a lot of orders starting to being placed for our commercial applied business. And what we're doing is complementing the traditional chiller business that we have, which is more of a centralized technology for that commercial office building, with a new acquisition that we just announced a couple of days ago, where we're buying Toshiba's HVAC business, which is a different technology. It's variable refrigerant flow. It's a sustainable modular concept. So we add that into our existing portfolio, and we can really play to that as office buildings reopen. We have a couple of different alternatives for that space.
Dave, you're right. That was a big acquisition by Carrier. Does that mean you're no longer looking for further purchases?
No, it doesn't. I mean, you look at our spin from United Technologies less than 2 years ago. We spun with just under 10 billion of net debt. We've done so much to improve our balance sheet, in part just driven by very strong cash flow performance. And as we sit here today, we have just under 4 billion. So 10 billion to 4 billion in net debt just over the course of less than 2 years. So we have plenty of cash, and we're going to really start playing a lot more offense on capital deployment. Not only acquisitions, we've announced Toshiba, we built out our pipeline. We're still in the market for continued acquisitions, but we've also increased our dividend 25%. We announced a $1.6 billion share repurchase for this year. So we are in a much better position to create long-term shareholder value through really disciplined and more aggressive capital deployment.
And Dave, did I hear correctly? You have called out $1 billion in cost inflation this year. That's a big number.
It's about a 5% number, and we're going to see about 5% price realization. So we did call that out. We did it by design because obviously that does affect your margins. But despite that, Brian, we're still looking at 75 basis points of margin expansion this year, coming off a year where we had 80 bips of margin expansion last year. So we're taking a sober and realistic look at the inflationary pressures. Again, 5% there, but we are being very aggressive on the cost side, on the controllable cost side, 300 million of productivity savings. And what we're also doing is playing offense on growth. We invested another 150 million incremental investments last year in growth. And because of that, we're gaining share, we're growing the top line, and we're letting that volume drop through, given the high gross margins at pretty good numbers as well.
Dave, I want to circle back around to something that Brian asked you about in the beginning, and that has to do with filtration. And I guess I'm curious about the HVAC systems that people are putting in, or the upgrades they're doing. Are they adding more sophisticated components because of the concerns over COVID? Is that sort of a new or really bigger business line for you than it used to be?
100%. And it's not only adding in better levels of filtration, but it's also looking at your entire ventilation system to make sure that you have the right kind of airflow through whether it's schools or office buildings. And what's also happening is that people are investing in digital technologies. And one of our goals is to make air visible, because you would never drink a dirty glass of water. But what happens is people all the time in indoor environments, they breathe in dirty air because they can't see that it's dirty. So we have now sensor-based digital platforms that we've deployed for like the Atlanta Braves in Truist Park and some of the indoor parts of that arena. We have them in school systems. We have them in commercial office buildings. We're deploying them in restaurants. So when you walk in, you see a digital dashboard that can tell you, how are my CO2 levels? How's my particulate matter levels? How are my radon levels? And it gives customers confidence to come back into indoor spaces because they can see that it's a healthy and a safe indoor environment. And that's a big theme for us. So better ventilation, better filtration, better digital tools. And this is a trend that's going to withstand the test of time because now it's become an expectation. People spend 90% of their time indoors. There's still anxiety. People make restaurant reservations. They still ask for an outdoor table. Eventually, we're going to see people back in crowded indoor environments, and they're going to expect to have safe and healthy indoor air.
And so, Dave, what does that imply about the sustainability of that trend? Do you think that change is here to stay and people are going, that business for you guys is only going to grow?
100%, Julie. We've said that the trend around healthy buildings is going to add 1 to 2% growth for us per year. Last year, we saw 500 million. We're about a $20 billion business. So it actually added a little bit more than that for us last year. And we think this is a trend that's only going to continue, partly because of COVID, because people are now so in tune with the fact that you have these diseases that are airborne spread, but also in California, where they deal with wildfires outdoor and they want to make sure that the indoor air is safe, or pollution in many parts of the world. What COVID has done is shined a light on the criticality of having healthy indoor air. So this is a trend that we are very, very confident is here to stay. And we're investing a lot to be market leaders in that, and then complement it with our investments around sustainability, because there is no question that the focus on sustainability is here to stay. So we're doing a lot more around energy efficiency. And that was part of the reason we did that Toshiba acquisition as well.
All right, we'll leave it there for now. Carrier Chairman and CEO Dave Gitlin, always nice to see you. We'll talk to you soon. All right, staying on healthcare, Yahoo Finance's Anjali Kemlani is back with some updates on the COVID-19 pandemic. Anjali, mask mandates now appear to be going away in some states.
Specifically, of course, those states have had sort of this partnership, loosely partnered sort of approach to lifting mandates or enforcing mandates and the like. And that's what we're seeing right now. New Jersey, of course, announced yesterday that they're going to remove the mask mandates for schools starting March 7th. And that we're going to see, that's also in addition to what Pennsylvania did. We know that Delaware and Connecticut have also committed. So a lot going on there. We know that California and New York are also weighing similar measures. In other states where we do still see mandates, there's no word on whether or not they are going to be lifting anytime soon. Of course, this all comes at a time where we're seeing a decrease in cases of COVID, Omicron specific, as well as hospitalizations. We do continue to see concerning death toll, but with due time, this surge is going to pass, and this is sort of an advanced strategy as a result of that.
And also, Anjali, I wanted to ask you about another developing story with regard to COVID, which sounds wacky, but is actually quite serious. And that is, apparently deer have now been found to carry COVID. I think it's deer on Staten Island, if I'm not mistaken. It sounds like a punchline or something, but talk to us about what's at stake here and why it's serious.
So what you're hearing about is actually something that public health experts, virologists, infectious disease experts have been watching for the last couple of months, and it's sort of the reason why there's this debate about, when will the virus become endemic and when do we see the end of the pandemic, and that is largely focused on specifically this point. We had a virologist on Yahoo Finance last month, I believe, Dr. Angela Rasmussen, who specifically talked about this and how the animals actually are sort of a reservoir for this disease. And that's the reason why most health experts are not willing to point to an end of the pandemic. Listen to what she had to say about that specifically.
So frankly, I don't think that elimination is going to be possible with this virus. This virus infects a number of different animal species. This is actually one thing that my lab works on. And even if every human being on the planet was vaccinated, there's still potentially susceptible hosts in the form of other animals that this virus could get into.
So as you can hear, that's really where we see the issue and why the prolonging of this virus's existence is sort of sure at this point in time, and why it might take quite a few years before we see anything looking like the end of coronavirus and COVID. Back to you.
Mental note, run away from the deers and do not feed them. Anjali Kamani, thanks so much. All right, from fluffy-tailed deers to Oscar nominations, we'll have a full list of who made the list on the other side of the break. Stick around.
Well, the Oscar nominations are out, and as they can tend to give a boost to some of the studios that win a lot of nominations. We're going through some of the noms here, figuring it out. It looks like Netflix got the most nominations. The Power of the Dog, which is the Jane Campion Western, got 12 nominations. You see Dune got 10 nominations as well. Belfast, West Side Story. Interesting about West Side Story because I don't think it did terribly well at the box office, but got a lot of nominations there. I don't know if I've seen any of these movies, Brian Saucy.
I haven't. Let's be real. I've never even heard of them.
But it is fascinating to me, this sea change that we have seen over the past several years, where you remember when Netflix got like its first Oscar nomination, and it was a big deal, and there was a lot of sort of hand wringing in Hollywood about what this was going to mean, and now it's the norm that the streaming studios get nominations. Apple's getting nominations, Netflix is getting nominations, so it's just a very changed world.
When you spend billions on content like Netflix has, you're going to put yourself in a pool to win some great-looking statues for your home office. But I don't think it solves the issue of any of the issues that were brought up on Netflix's earnings call. It sent the stock crashing a couple weeks ago. Slowing subscriber growth in the first quarter here. There are challenges in this business that they're going to have to overcome this year.
Yes, indeed. So we are going to keep watching that. Maybe we'll actually watch some of the movies as well. I think I'm going to try and get through some of these. But let's talk about what's going on, please, with the markets in today's session, because all three major averages are now higher. We had seen a mixed open here this morning, and now we are seeing a boost for the major averages. The Nasdaq leading the pack. It's up 0.4%, and the S&P is now up about 0.5% as well. So that's something we continue to keep an eye on here this morning. We've been watching the trending tickers as we always do here on Yahoo Finance. We've been watching Peloton, of course, very closely here this morning, Saz.
Yeah, one finer point that now this is starting to make the rounds here on Peloton, not necessarily stock price performance impacted, but buried in the John Foley letter here, that is the now outgoing CEO of Peloton / founder. He will be the executive chairman. He notes that those people getting laid off, 2,800 people, they will at least get free Peloton the next 12 months. So yeah, just, I don't know. Again, I think it continues some of this thesis that is developed on Peloton of a tone-deaf management team. Good to see that happening though, right?
Sure, I guess so. I mean, I guess, I don't know what the severance picture
You don't have a job,
like.
but you can keep riding the Peloton. You can keep riding the bike from the company that fired you. So there you go.
I guess so. I'm just looking at some of our other trending tickers. We talked about Pfizer earlier today. It's now down almost 6%. Meta is now little changed, Saz. So maybe we could see an end to the recent slide that we have seen in those shares. And another story that we've been watching over the past couple of weeks or so, there was a report that Apple was going to be introducing a new kind of pay product for small businesses. That hit the shares of Block, aka Square, at the time. It's confirming it today. So those shares are trading lower a little bit as well, Saz.
Yeah, just searching for that bottom. And one thing I learned today, Julie, just stay away from deer. Stay away from the deer.
That's a good lesson for today.
Stay away.
And
just all but. Don't go near the deer,
on
Julie.
that note,
do not go
we're gonna leave it here. All right, Akiko and Brian are gonna take you through the next two hours of trading. Hopefully they'll have more to say about these Oscar nominations than we do. Stay right here. Yahoo Finance Live continues.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. We are seeing all three major indices in the green right now, with the Nasdaq leading the gains, at least so far in the session, up about 58 points, the Dow up 143, and the S&P 500 trading pretty flat. We've also been watching the yields or the bond moves today, with the yield on the 10-year T-note hitting a new pandemic high, looking at the highest level since November 2019. So something we're watching closely there. Peloton shakeup, shares of the exercise bike maker soaring in the session as CEO John Foley announces he is stepping down. The company's plans to restructure as demand slows from the pandemic highs. And deal collapsed. NVIDIA abandoned its pursuit of ARM after facing regulatory hurdles, while Softbank pushes ahead with an IPO of the chipmaker in the U.S. We're going to talk about the implications for all parties involved a little later in the show. But first, let's begin with that big corporate story of the day. Peloton shares soaring on a C-suite shakeup, and you see the stock there up 20% in the session. CEO John Foley stepping aside, with former Spotify CFO Barry McCarthy stepping into his role. The company also announcing it's shedding 2,800 jobs, about 20% of its workforce. All of this as the firm sees a dramatic pullback in demand. Outgoing CEO John Foley addressing the changes on the earnings call this morning, saying it is time for a change.
Our goal has always been to bring immersive and challenging workouts into people's lives in a more accessible, affordable, and efficient way. We've done a great job of delivering on that vision, and our large and loyal member community is proof of that. But we also acknowledge that we have made missteps along the way. To meet market demand, we scaled our operations too rapidly, and we overinvested in certain areas of our business. We own this. I own this.
And Brian, of course, the C-suite shakeup kind of overshadowing the numbers we got today from their quarterly results. The company did slash its outlook for the year, saying it's now expecting revenue between $3.7 to $3.8 billion. But this is clearly a company that is having to reset its expectations after the huge growth that it saw during the pandemic.
Yeah, and reset they will. I mean, the business model is going to change very dramatically, very quickly, and that's because of some of the dramatic expense costs that they plan on slashing, which they announced alongside the earnings this morning. When you take a look at the about 2,800 jobs, that's going to be affecting about 20% of its corporate positions that will be cut. Now, Peloton clarifies that this won't be impacting any of the instructors that they have on the apps themselves. They want to keep the suite of content that they have going, but they want to have these types of kind of corporate adjustments to allow for an $800 million in annual run rate cost savings. That's going to improve their gross margin. But it's important to note that this is unlikely to fully acquiesce the activist investors that have been slamming Peloton for not being more efficient in the past under John Foley's leadership. When you take a look at Blackwell's Capital, they have a massive investor. I mean, it's remarkable what they've been kind of slamming Peloton's business model for. They've obviously highlighted the bloated expenses. Some of these changes might address that, but they still feel like there's maybe other people inside the company that remaining there will remain an obstacle to really dramatically changing and transforming this business. So yes, the CEO might be out, but it remains to be seen, Akiko, if it's really going to be enough to kind of quell the issues that some of these activist investors have flagged.
Well, and one of the things the activist investors have flagged is a sale of the company. And of course, we got those reports over the weekend that potentially Amazon, maybe a Nike would be interested. I mean, certainly worth making that argument when you think about how much the stock has fallen. If you were interested in Peloton before, you're certainly interested at these price levels. But there's also a school of thought here that says, look, if they're changing up the leadership right now, maybe this is a company that sees its future as more independent. So that's certainly something to be watching. But I mean, either way, when you think about what was said today, certainly the focus seems to be not necessarily about bringing new users into the fold, but really adding additional elements, additional content, and also trying to keep those core users that are already on the platform. And that's kind of the start here, because we're not going to see the kind of growth that we saw during the pandemic, at least not now, when you think about how it was kind of the perfect storm that led to this explosive growth for the company.
Yeah, I was going to say my last point here is really that, you see the stock popping right now because I guess they do like the idea of a new person coming in. Obviously, Barry McCarthy, someone who has experience at Spotify, I believe Netflix as well, who, by the way, is an outsider, is my understanding. It's possible when Peloton hired McKinsey to take a look at kind of outside advice that's how they found Barry McCarthy, if it was McKinsey that was behind this. But look, Peloton was at $140, $150 a year ago. So even though the stock is popping, almost 20% today, I don't think that's stopping a lot of these suitors like a possible Apple or an Amazon or a Nike from looking at the discount here, because it is still a discount from where it was a year ago. So again, I don't think this stops the M&A chatter, but it does maybe give Peloton a little bit more wiggle room to fly independently for perhaps a little bit longer.
Yeah, we heard on the call today, the company saying every cost bucket is under scrutiny. And by the way, also the company basically abandoning that North American manufacturing plant that was scheduled. So something we'll be watching there. Let's talk about another big corporate story we're watching today. And this is about a deal falling apart, really. Softbank officially abandoning its plans to sell ARM to NVIDIA in a deal valued at up to $80 billion. Instead, the company plans to pursue a public listing here in the U.S. Let's bring in Yahoo Finance's Dan Halley, who's been following this story for us. Dan, not entirely a surprise when you think about investors who've been following NVIDIA. We've had a lot of analysts who've been calling for this deal to be halted at some point. What does it ultimately mean for both sides, ARM and NVIDIA?
Yeah, for NVIDIA, I think, as you pointed out, Akiko, this really doesn't mean very much. Analysts and investors had essentially thought that this deal was kind of dead from the start. $40 billion was announced in September 2020. We're here now in 2022, and we're now just getting news that they're calling it off. So, I had spoken to investors and analysts myself. They had basically said that, look, once they announced this, it was very unlikely to eventually go through. It was less than 50% chance of any kind of deal really being completed. And that's because of all the regulatory scrutiny that they had predicted would be behind it, and then that eventually started to flow. And so in the UK, they were looking at this as a national security concern because ARM is a major provider there of chip designs. It also provides chip designs, by the way, to a slew of NVIDIA rivals, as well as just major tech companies. We're talking about Qualcomm, Microsoft, Intel, believe it or not, Apple, Google. So, there were a number of different businesses that were pushing back on this. And that's because ARM is essentially a kind of Switzerland of the chip industry. They provide their designs to everybody, and they don't discriminate. And the fear here was that NVIDIA taking over would have put pressure on them to not provide chip designs to NVIDIA rivals. In fact, that's what the FTC had said at the time, calling the proposed deal the potential to distort ARM's incentives in chip markets and allow the combined firm to unfairly undermine NVIDIA's rivals. Now, we did get word from NVIDIA CEO Jensen Huang this morning. He said, though we won't be one company, we will partner closely with ARM. The significant investments that that's Masayoshi-san over at Softbank Group, has made have positioned ARM to expand the reach of the ARM CPU beyond client computing to supercomputing, cloud, AI, and robotics. I expect ARM to be the most important CPU architecture of the next decade. And just to give you an idea of where you'll find ARM, pick up a smartphone, because they're in every smartphone that's around. Apple uses them for their A chips, their A-series chips. They also use them, by the way, in their processors, the MacBook M1 chip. That's based on an ARM chip. Google uses them for their new Tensor series chips. They also use them for some of their supercomputing chips for the cloud. Microsoft uses them. So it really is a massive company. And I think that, this is something that people were expecting. And that's why you're really not seeing too much movement out of NVIDIA stock this morning. They're down less than 1% at 0.5% at this point. So I don't think that this is going to be a larger issue. I think the main focus is on NVIDIA still being able to get access to ARM chips in the future, just as everyone else did, and then focusing more and more on their graphics capabilities.
Dan, there's a question of what this means for Softbank, which is now left with ARM. We know the company has said they're going to pursue a listing for ARM here in the U.S. But of course, we saw that stock for Softbank Group move overnight during the Tokyo session on the back of their results. Yes, they returned a profit in the most recent quarter, but that number is about a 97% drop from where they were a year ago. And now they're having to deal with this on top of the other slides they've seen in their holdings. What does this collapse deal mean for Softbank?
Yeah, I think it's a bigger black eye for Softbank overall. And they said that, they're going to try to take ARM public in before the end of their March 2023 fiscal year. The profits for them in Q4, though, were down 97%. They came in with 29 billion yen, about $251 million. That's down, as you said, around the 97% from 1.2 trillion yen in the same quarter last year. And basically what's happening here is a number of the investments that they made are now basically upside down, and they're below what their original listing price was on the public markets. They're also being hurt by a lot of scrutiny from Chinese regulators. Obviously, Softbank has a lot of exposure there. And since we've seen the crackdown on some of the tech giants in China, those companies have been hurt as a result. And so Masayoshi Son, again, the head of Softbank Group, had this to say in a statement regarding some of those investments. We were in the middle of a blizzard and the storm has not ended. It has gotten stronger. So he's really looking out here and seeing that this is going to be a continued problem for Softbank. On the plus side, though, they're not getting that $40 billion from that NVIDIA deal. They will be getting $1.25 billion because the deal fell apart. That's a deposit that NVIDIA made that they won't get back from Softbank.
Dan, I want to switch gears here to the gaming industry because Take-Two, one of the big software developers, announced their earnings. It was a noisy report because you have that Zynga acquisition, but then you also have the positive developments on the new Grand Theft Auto game. It's been a long time since they had one. Give us the unpack for the earnings report.
Yeah, they missed on overall net bookings. And just to give you an idea, net bookings is their revenue plus revenue that they consider deferred from subscriptions, from monthly active users, things along those lines. So they missed on that, but they beat on actual earnings per share. So it was kind of a mixed bag for them. The NBA series that they have, NBA 2K, that's doing very well for them. But they saw a drop in overall revenue from Grand Theft Auto 5. That is just a ridiculous cash cow. I mean, it's done more for them than anything they could have ever imagined. It's more than $6 billion in revenue that's generated on its own, and that's thanks to the ongoing online component, that Grand Theft Auto Online. And I think what investors are looking at now is, well, we have positive news that the next version of Grand Theft Auto 6, or whatever they'll end up calling it, is actually in development. Take-Two has confirmed that. And so they're going to be looking at how they can unlock value there. And they really did a great job with Grand Theft Auto Online. They did the same thing with Red Dead Redemption Online, though that's fallen off compared to what you're seeing from something like Grand Theft Auto 5. Now, I think that once they have Grand Theft Auto 6, that's going to be on multiple new consoles as well as older consoles and PC. We'll see what else they can do there. But there's definitely going to be an online component. I mean, they'd be crazy not to have one. And that will do a lot of revenue for them as well. So huge developments there. But as you said, this comes after they acquired Zynga to really get into the mobile markets. And it comes as we're seeing more and more consolidation in the gaming industry. Microsoft obviously buying Activision Blizzard, a huge deal there. And then Sony buying up some of the other gaming companies out there, including Bungie, which was previously owned by Microsoft. So a lot of movement here in the game industry, but a mixed bag for this quarter for Take-Two. Moving forward, though, it's looking very good with that next game coming out.
Yeah, real arms race going on in that space. Yahoo Finance's Dan Howley, thanks so much for breaking all that down for us. I want to shift our attention now to a trending ticker. Let's take a look at shares of Pfizer, which are down almost 5% this morning. That's after it reported earnings. It actually missed on the top line, $23.8 billion in revenue, but they did beat on the bottom line with $1.08 of adjusted earnings per share on the bottom. Investors apparently not pleased with the year-over-year decline in its internal medicine sales and also a flat hospital segment business, but they did raise 2022 revenue guidance on their COVID vaccine, and they actually say that there should be about $32 billion of revenue from the vaccine. Keep in mind that also the drug companies, including Pfizer, are also trying to work through the authorization for a shot for those under 5 years old. Now, they do say overall across all of their businesses, Pfizer forecasts top line revenues to clock in somewhere between $98 to $102 billion next year, which also includes its COVID antiviral treatment. So a lot going on in the pharmaceutical space, Akiko.
Yeah, I mean, those numbers, $32 billion for the COVID vaccine this year, $22 billion for the antiviral COVID treatment pill, certainly worth noting there. But you get the sense that this is a stock that's already, run up on the expectations of that. You mentioned the disappointment in the internal medicine and hospital segment. Some other parts of that business now coming into scrutiny for investors. And maybe that's why we're seeing a bit of that decline there in Pfizer. But it's a reminder, Brian, that as we talked about Peloton too, but so many of these stocks that saw a big run up during the pandemic being re-rated in a different way now that we're looking beyond the height of COVID?
Yeah, absolutely. And just worth noting that over the last 6 months, the stock is still up 13%. And these types of earnings reports are very noisy because they have adjusted earnings per share, diluted adjusted earnings per share, but then also they try to control for the vaccine related revenue streams as well. So definitely worth watching that space. But we're going to shift gears, and coming up, stocks struggling for direction as investors await a key rating on inflation this week, although all the major indexes are up. FS Investment's chief market strategist will stop by to explain why he thinks cash flow will be king in 2022. Stay with us. Welcome back to Yahoo Finance Live. Let's check in on the markets as we get a little bit deeper into the trading day on this Tuesday, February 8th. It looks like all the major indexes currently in the green. Actually, the S&P 500 up about 0.5%, the Dow up about 0.6%, and Nasdaq up about 0.8%. We'll see if those gains hold throughout the rest of the trading session. Now, we know thematically having cash flow is key, whether it be a second job or investing in the stock market. But how important is the cash flow in this year of volatility of 2022? Obviously, the trading session so far has been a little bit rough. So joining us now is FS Investment's chief market strategist, Gary Gajewski. It's great to have you on the program, Troy. I just kind of want to ask you about what you think the proper allocation is right now with a lot of these FANG stocks and kind of the big movers in the market having a little bit of a rough go at it, let's just say, at the beginning of this year.
Yeah, so look, I think broader asset allocation, you saw clients slightly overweight go-go growth and large cap tech late last year coming into this year. Biggest trend the last 2 to 3 years is rotating away from fixed income into cash flow substitutes. But we're finally starting to see people peel back on some of their more aggressive growth, as well as just their broader equity exposure to embrace alternatives again, particularly those focused on cash flow. And really the last time we saw this was 2001 to 2011, which was really a function of the hangover from the internet bubble days. So, as we've entered a market environment where we have far more volatility, far more uncertainty, primarily due to the Fed tightening and not economic fundamentals, it's just an environment where cash flow is king again. And if you can find strategies like senior secured commercial real estate debt or double B CLOs pursued through interval fund structures that generate a consistent cash flow, not only do you have a reasonable probability of outperforming fixed income, but you also have a fighting chance to outperform equities with far less volatility.
So is that the alternative strategy you've pointed to? I mean, your notes say, keep it simple. You know, move away from those assets that obviously are going to get hit hard with higher rates. But what do you see as the biggest beneficiaries on the back of a Fed rate hike beyond what you just mentioned?
Yeah, so if you think of ways that you can generate attractive returns with reasonably low degrees of risk in an environment where interest rates are going higher, obviously you shouldn't be pursuing strategies focused on capital appreciation driven by multiple expansion. That was 2020 and 2021. In a year like 2022, when you're going to see multiple compression, you know, entering into alternatives that these days are very user-friendly, that can generate a high 5 to high 6% income stream that are incredibly economic resilient, like senior secured commercial real estate debt, is a very viable alternative, not only for fixed income, but also for equity exposures. And that's one of the biggest differences today versus if you go back to 2000 to 2002, is that back then it was very difficult to access alternative income streams like this or alternatives in general. Now, due to the work of firms like ours or others, they're very user-friendly structures with lower minimums, 1099s, ease of access, unlimited IRA capacity. And so when we think of the most economically resilient income stream, it's certainly senior secured commercial real estate debt. But if you want to take a little bit more risk, if you focus on interval funds that own double B CLOs, you earn a very attractive yield and have the potential for appreciation over time as well.
Troy, I want to highlight some data that we had gotten from the New York Fed this morning about household debt. And this is interesting because it kind of talks about the theme of interest rate sensitivity. Households, which are mostly kind of mortgage based, they have a lot of car loans and credit card debt. It's up to almost $16 trillion, increased by 2.2% on a quarterly over quarter basis. Now, is there any way to play how people are trying to get ahead of higher interest rates by essentially locking in rates? Now, I know that's a household picture, but obviously as an investor, you're trying to think about it the same way. Rates are going to go up either way you cut it or slice it later this year. Should you already be hedged for that?
Well, yeah. So look, it's not too late to re-embrace floating rate securities, right? So what we talked about before was cash flow and how important that is to a portfolio today. But even better than consistent cash flow is cash flow that increases as the Fed hikes. And that's the definition of floating rate securities or private floating rate loans. And so look at this year. We have 4 hikes penciled in for the Fed. We know some are at 7, some are at 5. We think 4 hikes plus or minus is the right amount. Isn't it better to have some exposure in a security or an income stream where you're rooting for the Fed to hike versus most assets, you're terrified of the Fed hiking? I mean, think about what's happened this year to fixed income. The Barclays Ag is down 3%. You know, equities are down, 5 to 7, depending on the index. And that's a direct result of tightening monetary policy. So where you can focus on floating rate exposures, again, double B CLOs or senior secured commercial real estate debt would be examples. That's an area you should focus on. That being said, there are also other alternatives. Market neutral multi-strategy is a very good, viable approach if you need daily liquidity. There are a tremendous amount of pricing inefficiencies in volatility markets right now that we can take advantage of, and others can as well. Tactical asset allocation strategies make a lot of sense as well. They just don't have the cash flow characteristics that we discussed before, but they're a reasonable probability of outperforming equities and fixed income with much lower volatility. So, cash flow isn't the only thing to focus on, but compared to the last 2 years, we think it's a much more viable strategy on a relative and absolute basis than at any time in at least the last 2 years.
Troy, where does crypto fall into your overall strategy right now? We saw Bitcoin hit 45,000 again earlier today, although it's right now below 44,000. Is this the time to get in, maybe add a little more exposure, or you think just given the volatility on the equity side, that risk is just too much to take?
Yeah, look, I mean, if you own crypto, you own it over the medium to long term as a hedge against continued government profligacy, very large budget deficits. Even though money supply is tightening now, it's more than likely going to re-expand at some point over the next 3 to 4 years. And so you have to think medium to long term. In the nearer term, given how late we are in the halving cycle and the fact that money supply growth is slowing, we think it's going to be a choppy environment. So you want to be cautious. And again, if you compare crypto or Bitcoin in particular, or any crypto asset similar to gold, there is no cash flow, right? So you're getting nothing but mark-to-market gains or losses. In strategies that generate cash flow, you can withstand some degree of mark-to-market or even impairments on capital and still be positive. So, when you think about 12, 18 months ago, the reason you wanted to be as long crypto and Bitcoin as you could tolerate was because you were early in the halving cycle and money supply growth was exploding, and you finally had meaningful adoption by institutions and deep-pocketed investors. Where we are today, we're late in the halving cycle, money supply growth slowing. And so on the margin, if you're trying to de-risk, you want to be de-risking into cash flow generative strategies as opposed to crypto. And remember, you should never own more crypto than you can tolerate losing a significant amount over the next week or 4 weeks if it causes you any stress. So we think it's going to remain a volatile environment for crypto for the time being. And just like other strategies, it's much better to focus on, maintaining or mitigating downside and generating a reasonable return than being a little too greedy, like a lot of people were in go-go growth stocks, a year and a half ago.
Yeah, de-risking appears to be the overarching theme we're going to continue to hear about. Troy, it's good to talk to you today. Troy Gajewski, FS Investments Chief Market Strategist. Well, coming up, tensions remain high amid a standoff in Ukraine. The latest developments is French President Emmanuel Macron arrives in Kiev after 5 hours of speaking with Russia's President Putin. We'll be right back. worldview today, French President Emmanuel Macron called for calm in Kiev today following his meeting with Ukrainian Prime Minister Vladimir Zelensky. The bilateral face-to-face comes one day after Macron's meeting with Russian President Vladimir Putin failed to yield any breakthroughs to ease tensions along its border with Ukraine. Russia has amassed more than 100,000 troops along the border, prompting the White House to warn of an imminent Russian invasion. Over in Ukraine, the country's defense minister said its soldiers will begin its own military drills using new weapons supplied by the U.S. and the U.K. The exercises are set to begin on Thursday. The same day, Russia is scheduled to conduct joint exercises with Belarusian troops near the Ukrainian border. Well, senior Canadian officials are warning against foreign interference as Republicans in the U.S. publicly voice support for vaccine protesters there. Demonstrators with the self-described Freedom Convoy have been blocking Ottawa roads for more than a week now, protesting vaccine requirements for truckers crossing the U.S.-Canada border. Those demonstrations have turned ugly in recent days, with protesters waving swastika flags and desecrating national monuments. A handful of prominent Republicans have expressed support for the movement. Florida Governor Ron DeSantis and Texas Attorney General Ken Paxton have called for an investigation into GoFundMe after the site reportedly froze funds raised to support the anti-vaccine truckers. Canada's public safety minister fired back at Paxton on Monday, saying it is not the concern of the Texas Attorney General as to how we in Canada go about our daily lives in accordance with the rule of law. And over in Beijing, figure skater Nathan Chen set the world record for the highest score in the men's short program that edged him well above rival and two-time gold medalist Yuzuru Hanyu of Japan. Chen completed 2 quadruple jumps, erasing any memories of his disappointing finish in the Pyeongchang Olympic Games. Meanwhile, in the women's big air competition, Eileen Gu's perfect landing propelled her to gold, sending Chinese social media into a frenzy. The U.S.-born athlete decided to compete for China back in 2019. Tweets about her gold medal temporarily crashed. Weibo, which of course, Brian, is the top social media site. By the way, fans left 90,000 comments in less than 30 minutes after her win. 7 of the top trending topics on Weibo were about Gu's win. So certainly Eileen Gu bringing a big gold back to China, even though she's born in the U.S. And then, of course, we're all rooting on Nathan Chen, right? It's a story of redemption after that big disappointment in 2018.
Yeah, absolutely. And for what it's worth, I mean, I always love the Winter Olympics coming around because it's always so great to see all the Asian American athletes that we don't usually see in the traditional major sports here in the United States on TV. Really just see them kind of dominate across all the sports. I mean, you know, all of these figures are people who, you know, Asian Americans growing up here will be able to look up to and say, hey, I can get into those sports. I can't get on figure skates, but maybe a lot of other kids could. And I think that it is cool to see that. I mean, we remember the Linsanity kind of episode from, actually it was around this time of the year a few years back. And, you know, these are all inspirational stories to the next generation of potential athletes. And again, to see Nathan Chen, especially the adversity that he had faced 4 years ago, come back and then get the gold against a formidable opponent, obviously, in the Japanese skater who's dominated over the last 2 Olympics. So, you know, a really cool story, and obviously a lot of attention to Eileen Gu, given her kind of dual citizen, or I guess the renouncement possibly of one of her citizenships. But again, just overall, very exciting to see all these sports.
Yeah, the American-born Chinese athletes, that's been an interesting thread in this Olympic Games as well. You mentioned Eileen Gu, another skater, Zhu Yi. She competed for China. She was born in California, but essentially renounced her citizenship to compete for China. She did not have the best result and actually got quite a lot of criticism on Weibo, with a lot of people sort of pointing out where she was born, whether she had not stood up to the pressure. So that's just a reminder, Brian, about just how public these things become. I mean, these athletes only get one shot every 4 years, and it is really sort of the highs and the lows that I think make the Olympics so interesting. But hoping for gold in figure skating. It's been a while since the U.S. won a gold medal in men's. Right?
Yeah, it has been a long time. But, again, it just kind of shows how the international scrutiny kind of comes with a lot of responsibility and pressure as well. But, again, it goes both ways. Eileen Gu, has been characterized in some media here stateside as a traitor because she's born in San Francisco, but decided to compete for China. But I think just in totality, nations aside, can we just not appreciate the sickness of a double cork 1440 or a left side double cork 1080 when you go like you're eating yourself?
I don't even know what
like,
it's called, Brian. It's just incredible. I watched it over and over.
It's insane. And the thing is, like, winter sports, like, everyone's faking knowledge of what they're watching. They're just like, oh yeah, okay. Oh, you got a 1 point deduction for not smoothly nailing the end of that, quadruple axle. Like, I don't know what I'm talking about, but it's beautiful and it's sick. And I feel like let's just put all the controversy aside and appreciate. These are young kids, 18, 19-year-olds who are just, shredding it out there. So let's just, I think, appreciate that. But let's drop the Olympics for right now and tease what we've got coming up on the other side of this break. Peloton still remaining the big story of the day. We'll have an analyst joining us next to explain the road ahead for the stationary bike maker as the company cuts its sales outlook and CEO John Foley steps aside right after this. Obviously, the big story of du jour remains Peloton, the stationary bike, which shares are currently up right now after the news that broke this morning alongside earnings that the CEO, John Foley, will be stepping down. Barry McCarthy, a former Spotify CFO, to replace him. So let's get a little bit more color on exactly what's going on here. There's a lot of angles to attack. Simeon Siegel, BMO Managing Director, joins us now live to break down the news. Obviously, a big shakeup in the C-suite at this very beleaguered company over the past a few days even. Just your initial thoughts on the management change, and do you think this staves off any sort of M&A chatter that was building over the past few days?
It's like a coffee talk, just discuss, like just throwing something out there. A lot of news, obviously. I think what we're seeing is Peloton adopt this restructuring focus, adopt a focus on cost cutting, which is unfortunately, because there's real people involved, probably the right decision from the health of the business. I think the interesting question we have to ask now is on that conference call, you saw the numbers, but you heard optimism. And the problem when you first start a restructuring, there's not that much room to already internalize growth. So I think right now there's still a lot of questions going out there and trying to figure out where are they taking the future right now. It's a great product. It's a phenomenal community. We all know that. The question is, what's the right size of the business?
And Simeon, that seems to be sort of your base case, right? It's not so much that your case for Peloton has changed. It is the very issue that executives raised on the call today, which is that they just became too big too quickly, and the valuations just soared beyond that on the expectation that what we saw over the last 2 years can continue when it couldn't.
Yeah, I think it's a great point. And listen, you and I have talked about different brands going too far too quickly. There's the multiple. So there's the stock price, and that's what you've addressed. Then there's also decisions that actually impact the business. There's the notion of spending a lot of capital intensive costs to build an incredible manufacturing facility. Inventory was around $1.5 billion this quarter. That's a lot of product for a product that is now seeing demand falter and wane. So I think this idea, it's more than just the stock price. It's also figuring out what's the right reset. What should the company optimize? And I think that's where this element that we've been talking about through the pandemic, did this company use pandemic strength to extrapolate for the future? Was this a pull forward of demand or an expansion of it? It increasingly seems like it's a pull forward. And the question I think we all have to ask today is that announcement sounds like an acknowledgement that it was a pull forward, but it's very quickly followed up with, but the growth will resume. The TAM, the addressable market hasn't changed. There's an internal conflict there that I think we need to get a little bit more comfortable with, because it's easy to hear the excitement and say, let's bring Peloton back to the heyday. But if the whole point, if you're taking out $800 million in charges, what suffers from that?
Well, Simeon, I guess the question, though, is a refocusing of your top line revenue. We know that they're planning on handling the expenses with this major shakeup. But at the same time, it seems like there's been a loss of who the primary demographic is here, because it used to be a high margin, right, high income clientele that they were able to sell very expensive bikes to. And then when they realized that the pandemic at some point was going to end, they wanted to scale, tried to decrease the price of the bike, and then everything just got lost in the sauce. So what do you think is the winning formula for them for top line growth in this next chapter?
So it's ironic because you and I have talked about other companies like Under Armour and Victoria's Secret as being too large. And the answer was they had to shrink to grow. They had to sell less and charge more. I think it's the same situation. I think when a brand goes beyond their core, it becomes expensive. Whether we call it CAC because it's a tech company or whether we call it promotional discounts because it's a retailer, it's the same idea. And so your point is such a perfect one. This company needs to figure out what their core audience size should be, because they did a phenomenal job at reaching them initially. And then what they probably should focus on is elevating the price. They probably should focus on ensuring that they're getting the most out of this community that's willing to pay likely more than $39 a month. What that means, though, is this should not be a mass rollout. This should not be the expectation that this growth happens to the moon. And I think that whether the growth comes later, right now, today is a day of resetting. Today is a day of cost cutting. That's not normally followed immediately by the same breath, but the growth is still there. And that's where the confusion, that's where the danger comes from. I think that's what we'll have to keep an eye on. But I agree with everything you just said.
And Simeon, the larger question is, does Peloton see this growth through as an independent company or under the umbrella of another company? There's been a number of names that have been floated around. I know you cover Nike as well. You've said you don't think that's a natural target. What about a name like Amazon or Apple, another one of those names that have been floated around to say, look, maybe they'd want to bring Peloton into the fold. Is that something that would make sense?
It's funny. It's like those two companies you mentioned sit on opposing sides of everything we were just talking about, right? Brand elevation, high margin price versus mass distribution, logistics, supply, et cetera. And the question is, where does Peloton, right? Does little Peloton, and I don't say that in a mean way, Peloton has done a phenomenal job, but is Peloton big enough to matter to either of the two largest companies in the world? And if so, which is the direction they want to go in? Are they going to follow the Apple? Are they going to follow? Do they make more sense for a brand enhancer margin story? Or do they make more sense for try to sell as many and get this in the hands of as many people as you can? So I think that from Peloton's perspective, there's an interesting decision. But ultimately, from the acquisitions perspective, what are you really getting? And do those two companies that you mentioned, and I obviously am not close to those two companies that you mentioned, what were they thinking at the beginning of the pandemic when Peloton was the hottest item in the world, right? Were they running their numbers then? Because if you think about it, the largest companies in the world want an incredible growth story that will have access to tremendous engagement and data? Or do they want a fixer-upper that's now trying to stave off and stabilize its slowing engagement and its slowing demand? I think we have to ask that question.
Simeon, quickly here, what's the significance of Foley staying on as executive chairman?
That's an excellent question. And understanding titles and understanding the role of the executive is there. I mean, Barry was not on the conference call today, so I think we have yet to hear the true plan. But listen, to his credit, John Foley created something truly special. He created a community, created a product that has changed people's lives, and give him all the credit he's due. I think that line, the fact that it's executive chairman, does make you have to ask the question of what just changed. I think like that is a very fair question.
And we'll be watching to see what the progress looks like. Simeon, always good to get your takes here. Simeon Siegel, BMO Managing Director. Well, coming up, the sweet taste of success. An entrepreneur joins us next to discuss the journey of growing her cookie business during the pandemic and snagging investments, some from big names like Rihanna and Jay-Z. Stay with us. We'll be right back. Well, as we celebrate Black History Month, we are celebrating some big name Black entrepreneurs who have found success in their individual sectors. Our next guest is the first Black woman to raise more than $1 million publicly for a food startup. It snagged some big name investments since, including those from Rihanna and Marcy Venture Partners. Let's bring in Denise Woodard. She's the CEO of Partake. And Denise, it's good to talk to you today. Talk to me about the growth of this company. You know, what you have seen over the last several years. You know, obviously we're talking about this in the context of Black History Month, but as a startup CEO, you have seen significant growth just within the last several years.
Sure. So I started Partake. I had the idea in the summer of 2016, and then we launched officially in the summer of 2017. And we really grew in very small baby steps. The first year I sold cookies out of my car to Nashville food stores in the New York market for nearly a year. And then we went into 2 small chains in the summer of 2018. And then the next year in 2019, we closed that $1 million round of funding that you referenced. And then in 2020, gosh, we grew our store count from 350 to 5,000. And now you can find us in over 8,000 stores around the country. So it was definitely a marathon, not a sprint to get to this point.
Denise, I'm looking at some of these flavors. They sound delicious. I want to ask you about kind of the fundraising, obviously, as a Black-owned, female-owned business. I mean, finding capital has historically been difficult, but what is interesting is you have a pretty amazing resume of people that have invested into your business. Rihanna, Marcy Venture Partners, you've raised over $7.5 million. Tell us a little bit about the community that's there to kind of raise capital for other aspiring entrepreneurs like yourself.
Sure. So we have been fortunate to partner with the folks that you mentioned, as well as funds that are focused on investing in women or people of color, like Kevin Johnson's Black Capital, the Black Star Fund, just a number of groups that have been very supportive. And I think also prioritize purpose and inclusivity and access, which are so many of the values that Partake stands for, as much as they value growth and profit.
And so you've highlighted, just how many inroads you've made in the 4 years since the business was launched. You've seen the growth to your cookies, but you've also had some baking mixes, additional products out there. What do you see 5 years from now? Talk to me about your ambitions for the company, how you plan to grow it.
Sure. So I hope that you find us in more stores around the country. We want our products to be as accessible and easy to find as possible. I hope that you find more products. So as you mentioned, we now have baking mixes and breakfast mixes in addition to our original products of cookies. And I hope that continues to grow. And then I hope that the positive social impact that we have, particularly around championing food inclusivity, fighting food insecurity, and opening doors for other Black and Brown entrepreneurs and students, that positive impact continues to grow as our business does.
All right, well, we wish you the best of luck as you get that growth continuing. But Denise Woodard, Partake CEO, thanks again for stopping by Yahoo Finance. On the other side of this break, stablecoin regulation takes center stage again. The developments from Washington as a top Treasury official argues that stablecoins need clear and consistent rules amid the crypto boom. That's next. Well, all eyes in the crypto space on the House Financial Services Committee, where they're holding a virtual hearing on stable coins. And there's a key Treasury official, Nellie Liang, who's currently testifying with regards to how the president's working group and an association of regulators might want to approach possible stablecoin regulation. Let's get a little bit of an update on the hearing, which is still happening right now with Yahoo Finance's Jennifer Schonberger. Jennifer, I understand you had the chance to talk with Ms. Liang before the hearing. What were we getting out of this hearing? Any sort of new headwinds that we're getting from the regulatory approach down there?
Hey there, Brian. Yeah, we're picking up a little tidbit here and there in an ongoing hearing right now before the House Financial Services Committee on how to regulate stable coins. Democratic and Republican lawmakers are questioning the sole witness under Treasury Secretary Nellie Liang on how to best regulate them. Committee Chairwoman Maxine Waters asked Liang whether technology companies should be allowed to issue stable coins after Facebook declined to continue pursuing its stablecoin Diem. Liang said, nope, technology companies should not be allowed to pursue them. Take a listen.
The report recommends that stablecoins be issued by insured depository institutions. And in that sense, then stablecoins would not recommend that stablecoins be issued by technology companies. This is the issue of the separation of banking and commerce has been an issue that Congress has grappled with for many years. In this case, we believe stablecoins as a payment instrument should not be issued by a technology firm.
Democrats prodded Liang on what protections need to be put in place. Liang was keen on protecting against run risks by ensuring that stablecoins are backed by assets investors have confidence in. She says if stablecoins are backed by high-quality assets, their risk is quite low, and they could form the cornerstone of a payment system. When asked whether she has concerns about the opacity of assets backing stablecoin Tether, she says she has concerns in general about the opacity of assets backing stablecoins for all issuers. She also said importantly that stablecoins that are only issued for payments and not used to make commercial loans like a commercial bank could be subject to a very different supervisory regime. So a degree of flexibility there in the PWG's proposal. She says depending on the quality of assets and capital and liquidity standards that could be applied to a stablecoin issuer, they may not need deposit insurance. Now, Republicans pressed Liang on why there wasn't attention paid to existing regulations at the state level. Liang says that state systems are too fragmented. Last November, the president's working group on financial markets tasked Congress with coming up with new regulations to oversee stablecoins, recommending that only banks be allowed to issue stablecoins. That's drawn ire from some Republicans. Ranking member Mick Henry said lawmakers should not legislate out of fear. Take a listen.
I'm not saying that there's zero risk, but Washington's knee-jerk reaction to regulate out of fear will not allow stablecoins to achieve their full potential and the myriad of solutions that they may be able to present. This new technology, like all financial technology, deserves appropriate and thoughtful regulatory approaches.
Now, Liang made clear that Treasury is very much approaching and looking at stablecoins as a form of payment, and that's why bank-like regulations versus money market fund-like regulations makes more sense to Treasury. Brian?
Okay, I'll pick it up from here. Jennifer Schomburger, thanks so much for bringing us that story. That does it for Brian and I in this hour, but we've got a Yahoo Finance special up ahead. Future of Finance special presented by Grayscale coming up on the other side of the break. A long number of guests here, including Coinbase CFO Alessia Haas, as well as author Vikram Mancharamani. That's all coming up on the other side. Welcome to this Yahoo Finance special, The Future of Finance. We are breaking down the unique dynamics that make up the financial system as we know it today. Our special guests will examine the way financial services are intersecting with technology and digital assets and how it affects our lives today and in the future. We'll also have an exclusive look at the newly launched Bloomberg Grayscale Future of Finance Index, which tracks the rapidly evolving digital economy. Join us as we explore the market forces that are shaping our financial future. Welcome to our special, The Future of Finance, brought to you by Grayscale. I'm Akiko Fujita. Over the next hour, we are taking a closer look, examining and defining the many dynamics that are shaping our financial future. We've got a long list of guests lined up for you over the next hour, but we are kicking things off with a discussion about the current state of finance. Joining us now is celebrated author and academic, Vikram Mancharamani. Vikram, it's great to talk to you today. The show is focused on the future, but I want to start on the present and the current environment we are seeing in the financial markets. It kind of feels like there's a bit of a reckoning that's playing out, especially among the tech companies that have been able to sell the story of huge growth, profitability at all costs in exchange for some pretty lofty valuations.
Yep.
What do you see when you look at the investor today?
Yeah, well, first of all, okay, thanks for having me. I'm thrilled to be with you and to share some of my thoughts here. Look, I think what's very simply happening is economic disruptions have created an environment with inflation. Inflation is leading to fears of higher rates and sort of more appropriately priced money equals less liquidity and greater discount rates. So the longest duration assets, if you've got tech companies with earnings way in the future, those future earnings are worth less in an NPV basis if you discount them back with a higher rate. So that's part of what's happening right now in the market. So let's talk about that. Number two, we've had, I believe, a passive investing bubble that's been brewing and may in fact start showing some signs of cracking and bursting here. I don't know. We need more time to see it validate. But what do I mean by the passive investing bubble? We've had flows driving prices more than fundamentals in many sectors. And part of that's being driven by just the massive amounts of money flowing into some of these, indexes, if you will. So take the ESG phenomenon. A lot of money went into ESG related funds. Those funds didn't have many places that they could park as much money as they were receiving. And so those flows drove stocks to levels perhaps that they might not have had they not had this ESG style mania bubble, if you will, that was brewing on the side. So the desperate desire to own green assets through lots of funds flowing in, profits in the future, but discounted at very low rates. So therefore worth a lot in today's terms. I think that's part of the story we're talking about here.
You mentioned ESG. Let's talk about the biggest ESG player, one of the biggest, and that's Tesla. And I like what you wrote about a year ago, specifically on Tesla. In an op-ed, you said the faith in market efficiency, the focus on being green, the fear of missing out, and the increasing power of storytelling by celebrity leaders have created fertile ground in which the Tesla bubble took root and grew. I believe it's about to burst. That was over a year ago.
Yep.
How much of that story, what you lay out there is happening with Tesla, can be applied to other companies?
Sure. Well, first of all, I was way early, I think, on the Tesla thing. And so maybe that's wrong. It's conceivable. But what we had happen in a situation like that, market efficiency, let's talk about each of those points you just raised. Market efficiency, we have faith that prices are right? That's the reason the passive investing bubble grew. Why bother paying for active management? Doesn't make sense. If you're an investor, why pay those fees? Why bother to have people do research? Prices are right. Buy the index. And so, of course, Tesla's a big component of certain indices, ESG indices for sure. Therefore, the price is right. Don't question it. And so you saw as that happened, fewer people shorting it, that some of them got squeezed out, et cetera. And so that definitely took place in terms of the market efficiency. This fear of missing out, that's a classic bubble dynamic, right? When higher prices result in more demand, not supply, That's really interesting, right? Because higher prices, more demand, equaling higher prices, equaling more demand, you get a self-fulfilling cycle going up. By the way, that can happen going down as well, right? So lower prices, less demand, lower prices, less. So you can see that dynamic in reverse. Celebrity CEO. I mean, come on, Elon Musk is the celebrity CEO of celebrity CEOs, the controversy, the style, the sort of everything about him sort of smacks of that celebrity CEO who gets a big pass on governance, on other topics in ways that maybe the non-celebrity CEO doesn't get. And so maybe has to explain more. Further, there's this visionary logic, which is it's all in the future. It's all coming. We've got full self-driving. We've got robo-taxis. We've got solar. We've got battery. We've got, you name it. We're going to Mars. We're going to send a car into Mars. Whatever it is, it all is believable to those who want to believe. And so the minute sentiment shifts, you can see sentiment shift quickly. And for a stock that's, I don't know what its valuation is at this point that we're talking $1 trillion, somewhere around there. And yet, you know, I think if you got rid of some of these pressures that have been supporting the stock, that maybe the stock wouldn't be where it is. But yes, to answer your question explicitly, I do think the same dynamic is visible in other securities.
Let's talk about what some would say is the future of money, and that's cryptocurrencies. You know, we're coming off of a banner year in this space, crypto assets totaling at some point at the highs, $3 trillion. We're talking with the T.
Yeah.
Where do you think crypto fits into the broader financial system? Not currently, but when you think 5 years, 10 years down the line.
Sure. Well, I think we need to see and pay attention to what's happening with central banks. And if the political motivation is to constantly print money and debase currencies, keep going. What investors should do to hedge from that risk is buy currencies that cannot be printed, right? Things that will be forever scarce. And historically, that was gold, silver, precious metals, and for those that wanted levered exposure to it, perhaps gold mining, silver mining companies, et cetera. But in a more modern era, in a digital era, one that may appeal to millennials and sort of younger folks that are more digitally native, you might think that, well, cryptocurrencies and Bitcoin might be a digital version of that non-printable currency. And so, you know, I'd go back to something Jim Grant has said in describing how to think about gold. He said you should think about gold and precious metals as not assets, but almost anti-assets, one divided by confidence in central banks. And so if you have rising confidence that central banks will raise rates, stop printing money, et cetera, well, then that denominator is going to go up and your ratio will fall. And by the way, as the Fed talk has entered the sort of equation of raising rates 4 or 5 times this year, we're going to stop printing money. Surprise, surprise, we've seen a headwind, if not, you know, a downdraft in cryptocurrencies and Bitcoin specifically. So I think that's a decent framework for thinking about it. Now, I do think that political motivations for printing money, having less priced, you know, lower priced money, et cetera, will continue to be persistent. And so in the long run, I got to imagine things like cryptocurrency, Bitcoin specifically, likely have a good future. Further, there's more adoption. And as it gets more stable and less volatile, it's going to be adopted for different uses. I can't claim to understand all the uses that it may have. I was talking to someone who said, you know, the number of the dollars of remittances that are being sent back and the fees that are charged in remittances from like Middle East to the Philippines. I forget exactly what it was, but think of the democratization of money transfers that become enabled this way. So I think there's going to be a lot of activity in decentralized finance and cryptocurrencies, and that world's going to be really exciting on a 5+ year view. There'll be a lot of volatility. People need to buckle up and go on the ride, but it is going to likely work out well.
Yeah, on something like remittances, we've already seen the use cases, especially in emerging economies. You're a lecturer at Harvard, and I know you speak to students, your class specifically, humanity and its challenges, which is a very broad topic.
Yeah.
What are you teaching the next generation of business, financial leaders? What do you tell them?
Yeah, so look, the big sort of lesson of my class is that we should all try to be more systems oriented in our thinking and our approaches to problem solving. What we're trying to do, and what I try to do with my students, is teach them to think broader, to focus more on connecting dots rather than generating dots, that to balance breadth with depth, and fundamentally to learn to think for themselves, which is, hey, this may sound like it makes sense, but when I connect the dots and I look at the feedback loops, that in fact, this may produce the very opposite conclusion that we were thinking we were seeking, right? And so one of the examples a lot of people have used is, seatbelts. Do seatbelts make drivers safer? Well, if it didn't change their behavior, the answer would be yes. But when you put a seatbelt on, you feel safer and you drive with a little more aggression and possibly even more risk. And does that offset the benefit of putting on the seatbelt? Same thing we saw with helmets and football players' concussions. And so there's this feedback loop logic that crosses silos and asks questions about assumptions and forces a connection focus, sort of asks you to focus more on connections than generating the actual components or dots. And that's ultimately what I'm teaching. And we do it across a bunch of cases: inequality in capitalism, technology and jobs, the future of space, et cetera, et cetera.
It's a lesson that we can all take away, not just your students. Vikram Mancharamani, it's great to talk to you today. Really appreciate the time.
Great. Thanks for having me.
Coming up, how to keep up with the rapidly evolving digital economy. We have an exclusive look into the newly launched Bloomberg Grayscale Future of Finance Index. That's coming up after the break. Yahoo Finance's presentation of the future of finance is brought to you by Grayscale.
Welcome back to this special look at the future of finance. And joining us now is Dave Lavelle, Grayscale's Global Head of ETFs, and David Gedeon, Bloomberg's Head of Multi-Asset Index. And guys, we bring you here today because you're launching an index in an ETF. You just did that last week, the Bloomberg Grayscale Future of Finance Index and its corresponding, ETF. And David Gedeon, we got two Daves here, two Davids, so I'm going to have to use your last name so we don't get confused. But David Gedeon, I want to throw this to you just in terms of the constituency. I'm looking at some of the components here: PayPal, Square, CoinDesk, Robinhood. Those are some of the big names. We got some smaller players too. I'm just wondering where you're going with this. What is the theme you're trying to represent?
Yeah, thanks a lot for the question, and thanks for having us as we celebrate this great accomplishment for Bloomberg and Grayscale. And what we are trying to do and trying to accomplish is really be able to benchmark out what is the future of finance and be able to find and identify the companies who are most involved within the digital economy. And so what Bloomberg set out to do through our independent research, through our Bloomberg intelligence team, is be able to go through and develop out the theme. So define out what we mean by future of finance, and then define the names who are part of that. When we think about the financial foundations, digital asset infrastructure, and technology solutions, and then through the BI process, they're able to go through a quantitative and qualitative review over those names, assign the companies into those respective categories based off of their exposure to the theme, and end up building out the index off of this. And so, when we look at it of what the index is trying to do, the index is benchmarking what we believe to be the future of finance. So the membership today can change. It can change in next quarter and the quarter after as we go through that process each quarter. And so really as an index provider and in leveraging the research that we have here at Bloomberg, we're really trying to create the framework for the ongoing benchmarking of really the revolution in finance and what is the next stage of the digital economy.
And Dave Lavelle, let me get your take on this, because we've seen a number of products from your company, Grayscale, probably the most famous of which is the Bitcoin exchange traded product, notably not an ETF. But this index right here, this ETF is not just trying to track crypto or be some kind of proxy. It's really about the future of finance, which I understand is in the name, but it's kind of a bigger picture. Would you agree with that? And then what was some of the development process that you went through here with Bloomberg and perhaps the other Dave and some of his colleagues?
Yeah, so you hit the nail on the head. This really is not a Bitcoin replication product. As Dave Gideon mentioned, this is about defining the digital economy, and we believe the future of finance, and the Grayscale Future of Finance ETF in partnership with Bloomberg is really accomplishing that. This is about defining a new investment theme. It's not, dissimilar to themes that have been defined in the past that at the time of their launch really weren't household themes or household names. Think cloud computing, 5G, robotics and automation, right? The digital economy is a theme that we're defining and we believe is going to be the future of, how investors really have the opportunity to experience the digital economy. And so, we had a lot of conviction around the notion of the digital economy and this theme, and really being at the bleeding edge of the digital economy ecosystem and the digital asset ecosystem as a member of, digital currency groups, broader portfolio of companies. We came to Bloomberg and, with strong conviction and worked with them to build out the methodology.
And Dave Gideon, I was looking at the list of companies, a list of components here, and one of the things that stood out to me was the lack of certain companies. In other words, there's no MicroStrategy in there, there's no Tesla. Both of those companies have huge Bitcoin holdings. In the vein of you're not trying to replicate a Bitcoin strategy, is that the reason why that these companies aren't represented, or is there some kind of other criteria?
Yeah, and this is one of the things that we set out to accomplish with the index is almost have a hallmark of what's not in it, because it is not a Bitcoin replication. It is not a crypto basket. It is a basket that's meant to represent the future of finance and what is going on with the digitalization of financial transactions, financial management, asset management, and to do so and to include companies who are, I think we want to call them crypto adjacent, like MicroStrategy, who continues to acquire Bitcoin, Tesla, who noted they hadn't transacted any further at their last earnings call. Overstock is another traditional name in this space. Even some of the semiconductors who are obviously very correlated in terms of crypto demand from mining. We really wanted an index that avoided those names because we're not trying to have a correlation to one for Bitcoin or provide that proxy. We're really trying to create exposure and be able to benchmark exposure across the financial ecosystem. But as that financial ecosystem digitizes, modernizes, and evolves, we want a basket that has become an index that can track that evolution going forward.
MasterCard recently announced that they're going to give crypto access to a bunch of their customers. I'm wondering if MasterCard or a company like it would be under consideration for inclusion in this index, noting that you also have PayPal as well.
Yeah, look, I mean, I can't comment in terms on, on future inclusions, but as our methodology of, looks at the changing dynamics of companies, and as companies get more involved in embrace and invest further into the digital economy, then it's very possible that they can start to become part of this ecosystem. Exchanges would fall into that category. Other asset managers can also fall into that category of potential future ads, but there's still more development in those business lines to get pure into the theme in order for them to be part of it. But that's one of the things that we're doing here at Bloomberg from the thematic perspective, is to be really transparent about that. And so, on the terminal, you're able to go and run a function and actually see those quarterly results, see the analyst reviews on these names each quarter in terms of why they were included or excluded. And we think that will be a really important differentiator going forward for the thematic offering, so that way people can track almost in real time the future of finance.
So is this going to be like the Kathy Wood ARC Innovation Funds? She sends an email to me every night saying what she bought and sold, but maybe with a little bit more commentary. Is that what you're talking about?
It would be great if it's able to be as successful as Ms. Wood has been, but no, it is not active in that regard. Once a quarter, the index membership will change. You'll be able to see the adds and deletes off of that index membership via the terminal. It is still very much a rules-based, objective and transparent index that is tracking this theme.
Coming up, we're going to take a look at the regulatory structure of Bitcoin. Are we going to get that spot Bitcoin ETF after this? Welcome back to this special look at the future of finance. And joining us now is Dave Lavelle, Grayscale's Global Head of ETFs, and David Gedeon, Bloomberg's Head of Multi-Asset Index. I just want to talk about some of the regulatory aspects with the SEC. We have Chair Gensler, Gary Gensler in there. He's been there for about a year. I've seen your commentary on shows about the Bitcoin futures ETF and some of the hurdles that we've had getting those approved, and then the Bitcoin ETF conversion process for Grayscale Bitcoin Trust. In general, how has it been like working with the SEC over the last year as opposed to some of the prior administrations?
Well, look, this is, a story that we have been seeing for the past, 25 plus years with ETF innovation. When SPY came to market in 1993. It was a really innovative and a really bleeding edge, cutting edge, investment theme, which was S&P 500 with market cap, weighting. And as the ETF marketplace has continued to evolve, different exposures that were novel at the time have required regulatory review and regulatory approval. And so this is really no different than anything that we've seen in the history of the ETF marketplace. We're sympathetic to the job that the SEC has to do. And we've been really, fortunate to have a very strong working dialogue with the SEC and are happy to have a 19B4 rule filing in front of them that will allow them to review, the opportunity to convert GBTC into an ETF. And we think now is the right time. With the approval of, the Bitcoin futures product, we believe now is the opportune time to have a spot product approved by the SEC and available for all of our investors.
It's interesting that you mentioned the SPY ETF. It's part of my Twitter handle at SpyJared, but also at Yahoo Finance, we've interviewed Spider Woman. She was the lawyer who created the framework for the Spider ETF trust. Her name is Kathleen Moriarty. And during the conversation, I think this was several years ago, but she remarked that in the interim, so much has changed in the world, but not a lot has changed in the legal and the regulatory structure. And a lot of it is just a little bit antiquated. I'm wondering, is there more of a drive to innovate nowadays and to finally shed some of the structures and achieve some new ones that investors can really gain from?
Look, the ETF wrapper is really battle tested. I know Kathleen quite well, and she, is as good as anybody on trust law. And she certainly was at the forefront of bringing the ETF to the marketplace in conjunction with the American Stock Exchange and a number of other members of the ETF ecosystem. We don't see any problem with, the ETF structure, the ETF wrapper. In fact, it's quite battle tested and it's really stood the test of time in a number of really volatile markets since its inception. And so, we believe that we're really actually just talking about, when, not if, which is really exciting in terms of a Bitcoin spot ETF coming to market. And additionally, for a long time in ETFs kind of, innovation and evolution, there's been a question around the ETF wrapper and a question around the underlying asset. We've gotten to the point where the ETF has been, battle tested and really has stood the test of time in a way that no one's really talking about the ETF in terms of its, viability to hold the asset. It's really talking about, the Bitcoin as being held by the ETF. And that's really something that's exciting, that the ETF wrapper is actually, a vote of confidence for the underlying asset.
And David Gedian, we just have about a minute or two left. Want to get your thoughts on everything we've just been talking about, give you the floor, any comments or commentary in that regard.
Yeah, I think the wonderful thing that we have seen over the last, history now, going back to 94 or 93 with the ETF is the evolution and constant evolution of new products. And whether that's new exposures in terms of bringing international securities into domestic investors for the first time, fixed income, futures-based commodities, physical-based commodities, thematics, factor strategies. There's been so much evolution, and it's resulted in just massive revolution within the asset management industry and within the investing industry. If you think about the amount of money saved for the common investor in terms of what they're able to access now with broad-based index funds compared to the traditional active side, it becomes a very natural step for new product to be introduced and for the wrapper to be able to, as Dave Lavelle has said, for that wrapper to be able to handle this, because it's handled so much over the last several decades. It's just a very natural step for us to see, and it's one that, as an index provider, we're excited to continue to partner with very dynamic firms and bring our indices out into the marketplace in conjunction.
Well, we have to leave it there, but really appreciate both of you, Dave, stopping by here, and congratulations on the launch of your products, the index and the ETF. Dave Lavelle, Grayscale's global head of ETFs, as well as David Gedian, Bloomberg's head of multi-asset index.
Thanks for having me.
Thank you very much.
Coming up next, a closer look at the companies making up this new index and how they are redefining the future of finance. We have two special guests, Coinbase CFO Alicia Haas and Silvergate CEO Alan Lane. Stay tuned.
Welcome back to this special look at the future of finance, sponsored by Grayscale. I'm Brad Smith, and it's great to have you with us. Joining us now, we've got Alan Lane, who is the CEO of Silvergate. Alan, great to have you here with us. We know Silvergate to be an innovator in the fintech and cryptocurrency space, and we got to get your perspective. When you think back about the pandemic and how it's accelerated the adoption of digital currency, what sticks out to you the most about that period of time and the acceleration?
Yeah, Brad, thank you. It's great to be with you today. And you know, one of the things that we experienced, and I'm sure it's not unique to Silvergate, but any company that was focusing on a digital strategy likely saw that strategy accelerate significantly through the pandemic. And you know, we've experienced just a tremendous amount of growth through the pandemic. And one of the things that we did early on was we went to a remote first work environment. And I can honestly tell you that we would not have been able to keep up with the growth that we experienced if we were forced to hire folks in San Diego, as opposed to hiring them essentially all over the country. When the pandemic started, we had almost all of our 200 employees working at Silvergate's headquarters in La Jolla, California. Today, we have a little over 300 employees, and we have employees in 32 different states.
Wow. And so considering that acceleration in the adoption of digital currency, this has also prompted even more discussion around what regulation may look like, or some of these central bank digital currencies, CBDCs. And as that conversation accelerates as well, what does that signal for the utilization of existing coins that have been out there for years and either utilized or held as an asset?
Yeah, so clearly the Bitcoin and Ethereum assets, you know, which have been kind of the granddaddies of them all, have certainly experienced a lot of adoption. The central bank digital currency kind of jumps the curve and goes all the way to the concept of central banks issuing their own currencies on a blockchain. We're kind of thinking about that right in the middle between a CBDC on the one end and decentralized tokens such as Bitcoin and Ethereum on the other. And we're more focused on US dollar-backed stablecoins, which there are currently existing stablecoins in the market that are primarily used for cryptocurrency trading, where we see an opportunity to bring dollars on the blockchain for usage in payments and cross-border remittance.
How has what we've seen in terms of the adoption and the acceptance, how has that also prompted industry-wide prioritization of wallet or asset security?
Yeah, so digital wallets are really becoming kind of the way most people interact. Whether you know, it started with just having a mobile app, you know, mobile banking app on your phone, but these days, whether you're shopping for something on Amazon, whether you're paying for something, you know, coffee at Starbucks, you know, we're all using some form of digital wallet. And this gets back to this integration where we see that taking the concept of a digital wallet, where you're carrying this wallet around on your phone, and it's with you essentially 24 hours a day, 7 days a week, and the ability to have US dollars tokenized and resident in your wallet so that you can pay for things without actually having to use a credit card or a debit card.
Now at Silvergate, it's also been a big time for you as you've acquired Diem assets from Meta Platforms. Consolidation in crypto and the acquire to grow methodology historically seen in tech. Do you believe that's something that we're going to see going forward from here? And what particularly can Silvergate bring to those assets that were acquired that Meta Platforms was not able to bring to the market?
Yeah, so just a quick distinction there. So you know, Meta had previously kind of spun off that technology to the DM Association. We in turn have purchased the technology from the DM Association. So we weren't working directly with Meta, but rather with the DM Association. And what we believe is that the DM protocol is a purpose-built blockchain specifically built for payments. Some of the other existing blockchains that are out there that stablecoins are running on were not specifically built for payments, for a payments use case, and specifically with some of the proprietary regulatory compliance features that are built into the protocol, things that we were working on with DM last year. And we believe that the combination of the open source DM protocol with the proprietary elements that we've acquired, combining that then to issue a US dollar-backed stablecoin issued by Silvergate, run on that blockchain, we think that that will bring this into the regulated framework that the US banking regulators are looking for.
What do you believe the reality is for the future of finance and perhaps the roadmap to get there?
I think we're all very accustomed to using our phones and using the apps on our phones to pay for things, to hail a ride from Uber, to buy things online, to use the digital wallets when we're at the store, et cetera. But a lot of that is running on rails, the existing credit card rails, the ACH system, et cetera, which in many cases, adds a lot of cost. And then that in turn essentially keeps folks outside of the system because they can't afford to kind of enter. And but yet almost everybody has a phone. And so if we can get to the point where we're just tokenizing dollars and allowing folks to use them in these apps so that they are transacting 24/7 using their phones, spending dollars or fractional payments. This is one of the other things is doing micro payments, which becomes cost prohibitive when you're using the traditional layers. I think it's revolutionary, and we're really looking forward to being a part of it.
Alan Lane, CEO of Silvergate, joining us today. Thanks so much for the time, Alan. And everyone, we'll be right back with another company leading us to a bright new future of finance. Alicia Haas from Coinbase is here next.
Welcome back to this Yahoo Finance special, The Future of Finance, brought to you by Grayscale. I'm Brian Sozzi. Joining us now is the CFO of Coinbase, Alicia Haas. Alicia, nice to see you again. Good to get some time with you here. This whole special is really focused on the future of finance. What role do you see crypto playing in that future?
Brian, so nice to see you again. Thanks for having me this morning. So we believe that crypto presents an opportunity for a new financial ecosystem. Essentially, we think that any financial asset can become a tokenized form of value. And that enables us to see a world with faster payments, cheaper payments, global payments that operate at the speed of sending an email, sending a text. And that we think that it will have new financial infrastructure built. You've seen the growth of decentralized finance, which we call DeFi, now enabling peer-to-peer lending, peer-to-peer insurance. And I think that we're going to see continued growth and innovation in this space built on this new technology.
Yeah, no, to your point, there seems as if there's so much going on in this space. I mean, there's been an explosion in all things cryptos and platforms. If someone is new to the space, how should they approach investing in it, or even thinking about the growth trajectory of this industry over the next decade?
Oh, wow. So I think that people should think about crypto the same way that Coinbase does, which is that it's just a tremendous technology innovation. And we're just getting started. This is the earliest days. And so it's going to enable new ways that we have our financial system, as I mentioned, through decentralized finance, a new way that we engage with applications through the development of what we call decentralized applications, or dApps, and the internet. And so I think that what 2021 brought us is this promise now of an advent and growth of what we call Web3. And what this is bringing together now content, which we've had on the web, but merging that with payments and identity. And that is going to create this new ecosystem of innovation and growth that I think will be really exciting for consumers in the decade ahead.
We're not very far removed from 2021. We're about a month and a half in or so. I know time moves fast, but as someone leading Coinbase as CFO, what were some of your biggest moments for last year, and how might you use them to help inform what you do in 2022?
So 2021 was a huge year for crypto and for Coinbase across the board. So I think what we saw in 2021 thematically was just huge institutional interest in the crypto space. They came in huge, unprecedented numbers. We also saw DeFi gain tremendous traction. We saw NFTs explode. I mean, we had a headline of a $69 million NFT trade. We also saw the industry focus on scaling and regulation, which I think are really important foundational elements. And so ETH completed a major upgrade, preparing for the merge of ETH2. We saw regulators and lawmakers across the globe start to focus on crypto, and I think that will create a level playing field. And so for Coinbase, what we're doing is we're continuing to just build a platform to enable easy to use products for our customers to gain access for all of the innovation that's happening in crypto. And we want to expand that globally.
You mentioned regulation, and you, if I'm correct, you did testify in front of lawmakers. And I think the industry agrees that some form of regulation is good, but when do you see it coming, and what would quantify as good?
We did testify, and we were really thankful for the House making that an opportunity for us. We're very optimistic that regulators and lawmakers in the US and globally will make the right decision when it comes to smart crypto regulation. We've seen significant engagement across a variety of lawmakers over the last couple months, and we think that there's going to be action soon, quite candidly. What we've seen, though, is that we're starting to have meaningful dialogue with the industry, and that's what we really value. We wanted to ensure that there was conversation, that this is a transparent process, so that we harness the good of this innovation, but also do it in a safe way for the consumer. So we have a long way to go. We're in the very early innings, but I think that people are starting to see the potential, and I think that we'll get to a good place.
Being that this is still a new company, it's a new technology, I imagine the skills of being a CFO at a Coinbase are a lot different than, let's say, leading a packaged good company.
So I think what we all learn here is to live with volatility, live with a variety of outcomes. So we plan in scenarios, we plan for ups, we plan for downs, we plan for sideways. And I think you just have to be a little bit more flexible and dynamic in your thinking. And the industry moves at such a fast pace that we're constantly reevaluating what our roadmap looks like, where our resources go, what we should be focused on. And so you have to be a little bit more nimble to be operating in crypto, I think.
Coinbase CFO Alicia Haas, always nice to see you. Thank you for giving us some time. We'll talk to you soon.
Thanks, Brian.
All right, coming up next, seeing around corners, Matthew Blake from the World Economic Forum joins us next.
Yahoo Finance's presentation of the future of finance is brought to you by Grayscale.
New York Federal Reserve, giving him a vantage point into what the future may hold for the global financial system and finance. Matthew, thanks so much for being here. It's great to see you.
Pleasure to be here with you again.
Matthew, I want to start with a macroeconomic question. What's your sense of outlook for the global economy here? We're dealing with Omicron. The pandemic is continuing. How do you see that impacting global growth? What do you see as the biggest risks to global growth this year?
We had the IMF last week issue some guidance to the downside for global growth. I think that's a telling. That was a telling print for 4.4%, down about half a percentage point. There's no doubt that Omicron has yet again thrown a curveball at us from the standpoint of the pandemic. You know, people being forced to stay at home, either sick or working from home, aggregate demand therefore getting hit. So it's been a tricky period here. Supply chains also have been impacted. So not all that surprising that we've seen a bit of a revision. We will also see what the future holds. I think as a global population, we're coming to the difficult realization that we're dealing with an endemic here. This is not a transitory thing. We will be confronted with future scenarios where different variants crop up. And it's really about being resilient and prepared for that process, which is not going away anytime soon, unfortunately.
To your point, you mentioned the supply chain issues, and obviously part of that has been COVID, the pandemic. So do you see that kind of becoming a permanent basis for inflation and creating a scenario where inflation could be sticky, leading to that upward wage spiral inflation? Or do you see inflation coming back down later this year? And also, given that the U.S. Federal Reserve is set to raise interest rates to combat inflation, how do you see that rippling through global markets?
It's a very tricky period. I think it's the multi-trillion-dollar question of whether or not inflation is sticky or transitory. There's huge debate on all sides. My sense is, again, like as we work through the pandemic, we get better at dealing with these different waves, things will settle down. But it's a matter of acculturation and familiarization with being resilient and putting up with this. There's no doubt when we take a step back and look at inflationary trends that we are essentially in a new paradigm here. I think we heard that loud and clear from the Fed last week, that this is nothing like 2015, 16, 17. We are in a new place. The tone was very hawkish. And, the Fed has the tools, both in terms of communication, which they've already started, and also in the ability of raising interest rates, be it 50 basis points or 25, on a number of different occasions over the months to come, to try and take some of that excess out of markets, out of the economy. And it also has, obviously, the balance sheet. You had mentioned that I'd worked at the Fed. That was back in the 2010 timeframe. The balance sheet of the Fed at that point was $1 trillion. In February 2020, at the outset of COVID period, that balance sheet was at $4 trillion. And as of recent times, we're up to $9 trillion there. So tapering that, no longer being a consistent buyer in markets is going to have an influence on asset prices. There's no doubt about it. And it will take a little bit of time for markets to digest that. We've already seen volatility in some of the more liquidity sensitive sectors, be it tech or crypto. And the market will work through those changes.
So shifting more to a longer futuristic outlook, right? Where you're in your title, it says you look at the future of finance and financial systems. What are the secular trends, Matthew, that you see impacting the future of finance? It seems like a blockchain technology, digital assets could be one. But if you look out 10, 20 years, how are consumers, investors going to interface with financial products?
Yeah, we do try to take a futuristic view. I think 10 to 20 years is very far out. If you look back over what has transpired over the past decade and certainly over 20 years, it's quite remarkable. Difficult to make predictions that far out. But I think certainly the push towards digitalization more broadly was a trend already well established, but accelerated significantly during the COVID period. Technologies like artificial intelligence, machine learning, some of the chatbots and robots, they were critical technologies as we went, the global population pivoted toward working and living essentially out of their homes. And the 6 billion smartphones that are out there became our portal to all things in life, including financial services. So firms had to adjust very rapidly for onboarding and also for risk mitigation. So looking at fraud, nefarious transactions, AML, KYC. So in doing that with the benefit of technology supporting those processes was huge. So we saw a major uptick in adoption. We saw a major uptick in a migration toward cloud computing and multi-cloud strategies. So I think in terms of operational forces, those are here to stay, and we can talk a little bit more about blockchain technology. I just wanted to share, perhaps before we go there, more of a boardroom observation as well. You know, this notion of an institution thinking beyond its profit profile. So this notion of stakeholder capitalism. So how well are you doing in financial terms? Certainly critical, but also how are you dealing with the people around you, the communities, the planet, and what is the essence and the purpose of your institutional mission? The ability to maintain that one social license in an operating environment became much more critical, and having a narrative and the substantiating data to support that narrative is a fundamental shift, I think, that has been yet again accelerated as a result of the COVID environment. So, you know, one piece is operational, the other piece is strategic. They're both obviously intertwined, but there are some reflections for you.
You mentioned blockchain technology. Curious as to how you think that specifically is going to impact how banking is done and how we interface. We know that right now, when we trade stocks, for the most part, humans are not involved in that, right? Blockchain seeking to essentially extract that middleman, something that's core to Wall Street and financial transactions. Tell us a little bit more of how you see that manifesting and being adopted, say, even within the next 5 years.
The overall trend is absolutely toward greater automation in markets. You know, we had the privilege of working with over 200 stakeholders, public and private sectors, across 8 different workshops and a survey. And we put forward a report. It's in the public domain. You can find it on our website, called DLT and the Future of Capital Markets. And it really went to look at how well DLT, the pickup of DLT across different use cases. It made an attempt. I mean, there's a lot of hyperbole around blockchain. So we tried to really focus on where the applicability, where are these use cases and what do they look like? And we saw a number of really interesting examples, be it with FX netting, some of the securitized products being digitized across their life cycle. We saw certain repo functions and transactions being repurposed on DLT. So a lot of very specific use cases, either by idiosyncratic institutions, so one institution, but increasingly a number of institutions coming together to deploy that technology. I think that is telling. One of the key learnings from this work was not that we are entering into a complete disintermediation of middlemen. I think that's not where we're heading in the near term, but we do see increased adoption, and that the critical decision point on whether or not DLT is adopted is really the use case that's in question, and really looking at that very concertedly and seeing whether or not DLT is the right fit. So bottom line, increased adoption, no wholesale disintermediation seen at this point in time. It's a set of building blocks as we move forward.
Matthew Blake of the World Economic Forum, thank you so much for your insight. So appreciate it.
Good to see you again. Thank you very much.
And that'll do it for this special on the future of finance. Stay with us at Yahoo Finance for the very best in economic and business news.
Welcome, everyone, to A Time for Change. I'm Alexis Christoforous, along with Marquise Francis. As the NFL gears up for Super Bowl 56 this Sunday, the league continues to deal with fallout from the explosive class action lawsuit filed by former Miami Dolphins head coach Brian Flores. Now, Flores was fired last month despite posting 2 straight winning seasons. He is suing the league and 3 teams, the Miami Dolphins, the New York Giants, and the Denver Broncos, alleging discrimination and racism in hiring practices. And that's despite the NFL's longstanding Rooney Rule requiring teams to interview candidates of color for head coaching and senior positions.
And after initially rebutting the claims, saying they were without merit, the NFL and its commissioner, Roger Goodell, have since acknowledged the state of the NFL's locker rooms, calling the lack of diversity, quote, unacceptable, adding, quote, we understand the concerns expressed by Coach Flores and others this week. Here to talk about the latest in the Flores case and what the NFL's about face means is N. Jeremy DeRue, professor of law at American University and the author of Advancing the Ball, Race, Reformation, and the Quest for Equal Coaching Opportunity in the NFL. Professor DeRue, thank you so much for joining us today.
Thanks for having me. Look forward to it.
Great. And so just to jump into things, in the week since Flores announced that lawsuit, 2 more minority head coaches have been hired by the NFL, both Lovie Smith, the black man in Houston Texans, and also Mike McDaniel, a mixed race man in Miami Dolphins. So was this a little bit of cause and effect? And does the fact that 2 more head coaches change the optics at all of this Flores lawsuit?
No, so there's no way to know if it was cause and effect, right? There's no way to prove it one way or another. What we do know is that there has been, over the history of the NFL's efforts to increase people of color among the ranks of head coaches, there have been fits and starts, situations where numbers have gone way up and then they've come way down. They've gone up and there's been backsliding. So I don't think too much should be taken from these 2 hires. Really thrilled about them. Very happy for Coach McDaniel. Very happy for Coach Smith. I don't think anybody should conclude that as a consequence of these 2 hires, Flores' suit is irrelevant or that the problem is solved.
Professor, from the moment this class action lawsuit was filed, it seems we keep hearing the same thing. The burden of proof lies with Brian Flores. We've seen the text messages that he referred to between himself and Coach Belichick. How difficult a battle will this be for him to prove what he is alleging?
So it'll be, it's an uphill battle. It's always an uphill battle when you're challenging an employer with respect to employment discrimination, because courts tend to be rather deferential to employers with respect to their subjective decision-making as to who's right for the job, who has that certain quality. And so it'll be an uphill battle. I mean, what Flores has done is quite effectively laid out in his complaint double standards and headwinds that have been a real problem for African-American head coaches over the course of many, many years. And then he lays out his own experiences, as you mentioned, in Denver, in Miami, in New York, and he wants to wrap those experiences around the broader nationwide, league-wide double standards and bring a racial discrimination claim. He'll have to prove to the court that his particular instances in New York, in Miami, in Denver were race-based. That'll be his challenge.
Mm-hmm. And Professor, as much as the government has rules in place to protect against monopolies, it feels as though the NFL is one in and of itself. They make their own rules and they govern themselves. So how much could they actually stand to lose in this lawsuit?
Oh, I think they could stand to lose a great deal. I mean, I think they could stand to lose the appearance of being a league that is committed to diversity in a world that is day by day, it seems, week by week, month by month, recognizing the need for an exploration of diversity and a commitment to equal opportunities. That's one thing they could lose. They also could lose. There's something else that Coach Flores mentioned in his lawsuit. He talked about an allegation that the owner of his club with the Dolphins, when he was a coach, asked him to lose games on purpose in exchange for $100,000 per game lost. And so that allegation is now a part of the lawsuit. And if the NFL loses the sense among viewers, among fans, that each competition really is about every given Sunday anybody can win, then the product they're offering is very, very different. And I think they really could be in a situation where they lose market share to other major sports leagues in the country.
I'm glad you brought that up because I feel like that's getting lost in the sauce a little bit. This allegation that, which is a serious allegation, Flores says that ownership was trying to incentivize him to throw games, in essence, to guarantee that the team would get a better top draft pick. How much does Flores perhaps leave himself open to a defamation case here if he can't prove it effectively?
If you can't prove it effectively, then there's always a possibility, but truth is a defense. And so unless it can be made clear that there is no truth in what he said, I think he's pretty safe with respect to some sort of a counterclaim. And allow me to add that I think his lawyers would have vetted that out very carefully before they put that the allegation in the complaint.
Yeah, we would absolutely hope so. Given that it's a class action lawsuit, that means other people can jump in. Thus far, no one has necessarily raised their hand fully, and folks have been rather resistant. What do potential plaintiffs in this case also have at stake? Because we've seen what's happened in the past by Colin Kaepernick allegedly being blackballed from the league for also standing up. Is there also a sentiment that could also be the case for others that jump in?
Yeah, without question. I think, let's just focus for a moment on how, whatever you feel about Brian Flores' lawsuit, how brave it was to bring the suit, as I said, it's well recognized in the community that there are double standards, and there have been double standards for years with respect to getting a head coaching job for African-American head coaching candidates. So it's not that these statistics haven't been around, it's that nobody has decided to come forward and assert the case publicly and legally. And so Flores has done that, and it took tremendous courage, and it'll take courage from others to join the class. There is the risk that you might not be able to coach again in the league. We hope that's not the case. We know that Brian Flores wants to coach again. We know that he loves to coach. I hope that it won't be a situation where he's viewed as no longer a viable candidate. But that's always a risk with a suit like this. And I think others joining the class face a similar risk, unfortunately.
I mean, we know that Flores was one of three people up for the head coaching job with the Texans. We know that didn't work out. They actually wound up going a whole different way and decided to hire from within. But, from when you look at other cases like Flores's, do you believe that he has, sort of committed career suicide and may he just have to look outside football for his next career move?
Again, you would really hope not, but it's possible. I mean, if we could spend a couple of hours exploring racial discrimination in American sport over the course of the last several decades, and we could point to many people who have challenged leagues with respect to racial discrimination and who have not found themselves with jobs in the leagues again. So that possibility is there. Really hoping it doesn't come to pass here because Flores wants to coach, and he's a great coach, and the league is better with him in it as a coach.
And Professor, I just want to finish up. A last question here. In your book, Advancing the Ball, I'm curious, what were your findings? And because of those, what is the actual, do you feel like Flores has a strong case?
So the findings of the book, the book basically explored the effort generally to increase diversity among head coaches of color. And the book actually focused heavily on the early years of the Rooney Rule. And in the early years of the Rooney Rule, it was very, very effective at increasing diversity in the league. One of the challenges that we've seen over the course of the last, 5 to 6 years, is that it seems as though clubs are less willing, less interested in implementing the rule in a meaningful and intentional and deliberate manner. And when clubs haven't done that, the league has not come down on them with punishment. And so the consequence, I think, is a lot of people feel like the rule doesn't work. It's not that the rule doesn't work or that the rule's conceptually weak. The rule is conceptually strong, but the clubs have not implemented the rule. That's, I think, what we've seen. And that is, among other things, what's led Brian Flores to sue.
Absolutely. And Jeremy Deroux, professor of law at American University, thank you so much for your insight this afternoon. Coming up, we'll hear from one CEO who says it's good business to invest in diverse-led companies. She'll explain that and more coming up after the break.
Welcome back to A Time for Change. The pandemic may have slowed most of us down, but not so for new companies trying to get up and running. In 2021, startups raised a record $329 billion, double the previous year. That's according to a new PitchBook report. But how much of that money went to diverse founders? Here to dive in is Bahia Yasmin Robinson, founder and CEO at VC Include. Bahia, thanks so much for being with us. So for people who are not familiar, this fund, it's a nonprofit membership-based fund. Tell us a little bit about the work you're doing there and how you're focusing on diverse businesses.
Absolutely. Thank you so much for having me. So in 2018, we embarked on creating a platform to aggregate best-in-class fund managers with the express mission to amplify and accelerate investment both into the asset managers as well as into founders, right, into companies.
And following up there, you now have a fellowship for BIPOC fund managers. Tell us more about how that came about and what exactly you're looking for in those candidates.
Absolutely. So the fellowship on the VCI side was really designed to support first-time fund managers that were looking to invest in diverse founders, looking to invest in the new majority. You know, when I started this journey about 8 years ago, there were about 20 or so Black women, for instance, founders that had raised more than $1 million. And that number has increased now to about 100, but out of 23.5 million Black women, that number is still very low. And so what we realize is that asset managers or VC funds, private equity funds, specifically investing in underrepresented founders actually can increase that number on aggregate.
So, Bahia, talk to me a little bit about the trends you've been seeing, especially during the pandemic, because we've talked a lot here at Yahoo Finance about the fact that women were disproportionately impacted by the pandemic and left the workforce in droves, and not all of them have come back. I'm wondering what the numbers are with regards to women and startups. What are you seeing there, and what's the appetite like for VC money for those businesses?
Well, what's interesting is that even though the number of investments into the VC space has increased exponentially, it's actually decreased for women. And so there's a challenge there in finding and investing in women-led startups. And again, the same thing is happening. What's happening is that corporates and other asset allocators are kind of standing up and saying, look, we want to invest in more asset management firms. We want to invest in more historically underrepresented founders. But it's happening incrementally. It's not happening as quickly as the market is investing in venture.
Yeah, and to that point, minority and women-owned firms manage only 1% of assets under management, and yet they produce better investment returns than their non-diverse counterparts. What are folks really not understanding about the success is really plain in sight?
Yeah, I mean, absolutely. I think, again, COVID has done an interesting thing, which has really spotlighted the fact that 1.3% of assets under management are managed by women and people of color together, right? So that's a huge market, a massive market opportunity. And so I think both the understanding that there's a correlation between asset managers, investment teams that are more diverse and women-led actually correlate into a higher investment into some of those funds that are led by new majority and women-led companies. And it's continuing to increase. I think on the allocator side, we get a lot of interest and a lot of coming to us to pick our brains about how can corporates and other large financial institutions and asset managers and asset allocators continue to increase in investment into those types of founders.
Mm-hmm. And I'm sure there's a lot of folks watching really wanting to know how can they get involved. So what sectors are really hot right now? And are there any particular regions in the country where you're seeing business is really booming?
Midwest and Southeast is booming. Of course, there's been a lot of migration patterns coming out of some of the larger tier 1 cities into some of the smaller cities. And We don't know if that trend is going to increase over time or if there's going to be a bounce back to some of the larger urban centers like a New York, a Los Angeles, a San Francisco. But there's been a lot of kind of movement into the Austin, the Miami, the Atlanta markets. And so I think that's spreading some of the opportunity throughout the nation. But I think that we'll see in terms of trends, obviously Web3, kind of crypto, decentralized organizations is going to be, something that's going to continue to increase, as well as ESG. And one of the things that our franchise and a lot of our training and education centers around is environmental and social governance. So not just making sure that there's inclusion and diversity, both at the company level and at the fund manager level, but there's also an environmental consideration as well.
And sort of from your perspective there at VC Include, what would you say are some of the biggest obstacles, but also some of the biggest opportunities to diversify businesses?
Well, we know that the stats are very clear. Women-led firms outperform. New majority, or some folks still say minority firms, diverse firms outperform the market, both again at the company level as well as at the fund manager level. And so there's several studies that prove that from all the major financial institutions and consulting firms that manage the 70 trillion of assets under management. I think that the massive opportunities investing into these firms and into these founders, picking the right teams, making sure that there's an ecosystem approach to investing, and making sure that there's more inclusion and therefore, more opportunities to drive market rates of returns on the market, global markets.
All right, we're going to have to leave it there. Bahia Yasmin Robinson, founder and CEO of VC Include, thanks for being here today. Coming up next, Olympian and gold medalist Lindsey Vonn shares her thoughts on what it will take to increase diversity at the Winter Olympics. We're back right after this.
Welcome back to A Time for Change. If you're following the Winter Olympics, you're likely seeing a familiar face on your screen. Olympic gold medalist Lindsey Vonn is covering the games as a correspondent for NBC, trading her skis for the broadcast booth. I'd sat down and talked to Lindsey Vonn recently about diversity at the Winter Olympics and about her pivot from world-class skier to author and co-director of a new documentary about her childhood idol, skiing legend Peekaboo Street.
I mean, I met Peekaboo when I was 9 years old at an autograph signing in Minnesota, and she was really the person that inspired me to want to be an Olympian. You know, skiing wasn't on TV, and there was not a lot of tangible people that I could look up to in that way. And so Peekaboo is really the driving force of that. And, you know, to be able to co-direct with Frank Marshall and produce her documentary was such a full circle moment. And I was very honored to be able to do that project, and it's out on Peacock, so check it out. But she's such an amazing person. I felt very lucky to be able to do that.
And diving a little bit more into the Olympics, this year, the Beijing Olympics is touted to have the best gender equity of any Winter Olympics, to the tune of 45% women. Why has it taken so long?
Well, I think they need a different structure on how they're choosing the athletes. I'm incredibly excited about how many women are going to be on this Olympic team, but I think the selection process needs a bit of work. I know from the men's side, on the alpine side, they're only taking 6 men, and they're leaving out a lot of team members that should be on the Olympic team because of this new gender equity rule, which again is great in theory, but I think there needs to be some adjusting, and we need to make sure it's fair all around. But I'm happy again that there's so many women on the team.
Yeah, and including equity there, you know, in terms of men and women, there's also the racial aspect of diversity. There's no secret the Winter Olympics are not very diverse. I know it took a long time for me to see someone who looked like me on the screen, and it wasn't until 2002 a Black person actually won a gold medal at the Winter Olympics. So what can be done for the games to increase their racial diversity?
I think it starts from the development phase, from junior sports. Allowing access to different communities. I mean, I know skiing is such an expensive sport. It's very inaccessible. And in a lot of ways, I don't know how to change that, because there just that's a difficult one to figure out. But I think starting from the ground up and having, the Olympics or each NGB having their own, program, diversity program, and giving access to different communities that don't have access. And we have a very long way to go to give that access to people who should have it.
I think one thing I really want to note is that you're actually putting in the work, right? You have the Lindsey Vonn Foundation, where you support women through scholarships, education, and athletics. So you talked about, obviously, you put your money where your mouth is, but why was this something important for you to make sure you're actually helping the next generation?
Well, for me, Peekaboo did so much. And honestly, it was meeting her for 90 seconds and it changed my life. So that was the premise of my foundation, is hoping that I can do the same for others, and allow them access and give them, encouragement and empower them to achieve their dreams. And so, we've done camps across the country, Baltimore, New York, Colorado, California, Minnesota. So I'm really trying to give access and, again, empower them to accomplish whatever it is, not just in skiing, but in life, because we have sports scholarships, but we also have 50% educational based scholarships. And I'm heavily involved in STEM programs as well, which I think are really important for the next generation.
That 90-second chance meeting really changed Lindsey Vonn's life. And it was really amazing to hear from Lindsey talking about her childhood idol, meeting her and seeing how it really changed her life. And that documentary, Peekaboo, that Lindsey Vonn co-directed, is streaming right now on Peacock in the US and Olympics.com elsewhere in the world. And at last count, I saw the US was right outside the top 10 for medal count. So I'm definitely looking forward to them putting in some work in the week ahead. That's all for the show today. I'm Marquise Francis.
All right, thanks a lot. And I'm Alexis Christoforous. Coming up in the next hour, my interview with Lululemon CEO and the very latest on all the big changes at Peloton.
Another big day for earnings, including Peloton reporting after the bell, but the attention is on bonds once again as a global sell-off intensifies investors on edge ahead of CPI coming out later this week. Lululemon just released its second annual Global Well-Being Report. Alexis speaks with the CEO to find out how people are feeling and coping on this side of the pandemic. And Game On, Super Bowl ads hit a new high ahead of the big game. Multiple companies paying up to $7 million for a 30-second spot. One big trend so far, lots of celebrities in play. We speak to Nissan about the thrill of returning to the game and what they have planned. You'll have a front row seat. Thanks for joining us, everyone. I'm Karina Mitchell, along with Alexis Christoforous. It is a big day for earnings. Lots of eyes on Peloton after the bell. Pfizer, Lyft, some of the other big names that are reporting as well today. And markets on an upswing at session highs at the moment. But Alexis, maybe the bigger story today is a bond market, the 10-year touching 1.96 briefly.
Yeah, definitely the action in the bond market. We don't say that too often, right? But it looks like investors continuing to sell those government bonds in anticipation of the Fed raising interest rates next month. And as we know, bond yields rise when prices fall. So here you have it, the 10-year yield now closing in on 2%, folks, 1.96% right now. Some are even calling for a 3% yield by the end of this year, the yield on the 30-year at 2.26%. Let's take a look now at the stock market, because after struggling to find direction this morning, it seems investors have found it, and that direction is up. We've got the Dow now at its best level of the day, up about 343 points. The S&P adding more than 30, and the Nasdaq Composite now up 139 points after being lower for most of the day. In addition to those earnings you mentioned, Karina, we're also going to hear from Disney this week and Uber, so lots of big names still to come. Financials, materials, and tech leading the way higher. Just two sectors in the S&P 500 pulling back, that is energy and real estate. Just one more note on bonds. The 10-year yield on course for its highest closing level since 2019. So definitely the action happening there in the bond market today. Karina?
All right, Alexis, and let's keep it on the markets. Bring in our next guest, Eddie Gabor, Key Advisors Group, author of Common Sense Bull. Eddie, great to have you here. Just want to get your reaction first to the 10-year breaking out, touching 1.96. What is the bond market telling us?
Look, I think the bond market is letting you know that higher rates are here in regards to what direction the Fed is going to go into. We think it'll probably hit 2, which probably isn't a crazy call at this point in time. But we are a little bit under consensus in regards to the direction of the 10-year. We think once it hits 2, or potentially hits 2, that is, that once the Fed starts raising rates, that 10-year bond rate will actually go down. I know that's not consensus, but that's because we believe that the rate of change on GDP is going to be slowing down at a pretty rapid pace. And the bond market is usually forward looking in regards to that. So we think once the Fed starts going into that more tightening mode, that the 10-year bond will probably stop going up or have less upside, in our opinion. And then the path of least resistance will be down.
So when do you see it hitting 2? Do you see that sometime in March?
Well, that's where we think the Fed is going to start raising rates. I think that's pretty much consensus, and I think that they're going to raise rates. So I would assume by March is when you hit that 2% level, or maybe even by the end of this month, because, again, the bond is forward-looking. And then, again, I think you're going to see the 10-year bond rate actually go down, which won't be good for financials. So financials are doing well right now because of the 10-year. I think that's going to be short-lived.
So now I know when you were in November, you said the Fed had to accelerate its tightening, but I want to ask you, how much room does the Fed actually have to hike rates? Because usually that happens when you're going into a growth period. We're going into a period of deceleration. So, is there a risk that the Fed is going to be too aggressive?
There's a huge risk to that. And that's why in November, when I was on your show, I was talking about that was our biggest fear for 2022. And now they put themselves in a lose-lose situation. I know there's a lot of people out there saying they're going to raise rates 5 times, 6 times. I've even heard some crazy calls of 7 and 8. There's no way, in my opinion, this market can handle more than 2 rate hikes, let alone 4 or 5. If they do 4 rate hikes in 2022, when this economy is slowing down at the rate that it's going to slow down, then a 15% correction will look like recess, and we will wish that it's only 15%. Because if we get that, then I would look for the indexes to be at minimum 20 to 25% down.
How healthy is the consumer right now? Because CPI comes out on Thursday, expecting a consensus handle of 7.3%. So people are shelling out more to get the goods that they want, but real wages are actually lower. So how long does a consumer, keep paying these prices before they have to put their hands up?
Well, that's our concern, right? This is why we feel like it's going to be very hard for this economy to do nothing but slow down at a rapid pace. Because again, the consumer's been holding on as long as they can. They had a lot of extra cash last year. I mean, their balance sheets are healthy, but look, let's face it. When you look at food costs, you look at housing costs, rents, everything, fuel, this consumer is in a really tough spot. And again, when you're tightening during that slowdown, is usually when you have a lot of problems. And that's what we're faced with here these first 6 months.
So JP Morgan is saying for people who are investing that right now one should be tilting towards value and international stocks. What do you say to your client?
So we've actually gone full defense. Starting in November when I was on your show, we started doing that rotation. We've been buying utilities, consumer staples. We put gold into portfolios for the first time a few weeks ago when it was under 1,800. We have a little bit of healthcare exposure. That's, in our opinion, and cash. That, in our opinion, is where investors need to be because those areas have a tendency to hold up better in a slowdown. So you want a boring portfolio right now, and that's why we're playing defense. I think gold could perform extremely well here in this environment.
And what are you most looking for as far as earnings season? I know Peloton is reporting after the bell. A lot of people want to see what happens there. Do you think that the markets are shaken up by what comes out of Peloton today? And then just as far as earnings season more broadly, what are you looking most closely at? Is it the margins?
So there's a couple of things. The number one thing that we really want to take a look at is forward guidance, right? We know earnings should be pretty good because of the fourth quarter last year was one of the best quarters that we had. So that should be strong. It's the guidance moving forward. And in regards to revenue growth, and we think they're going to be decelerating and moving forward. We think the outlook is not going to be very positive. And so investors, in our opinion, need to play defense going into the second quarter because second quarter comps are going to be even harder than first quarter comps to beat from an earnings standpoint. So it's going to be a very challenging market for high risk assets.
Okay, we will leave it there. Eddie Gabor, Key Advisors Group and author of The Common Sense Bull. Thanks for your perspective today. So we want to keep it on the Peloton story and bring in Dan Howley. Dan, what a mess Peloton is and earnings coming out after the bell, but the stock is higher at the moment.
That's right, Karina. We're seeing the stock go higher. And obviously, this is all on the news that the founder and CEO, John Foley, is going to be stepping down or has stepped down. He's being replaced by Barry McCarthy as CEO, though Foley will still be on the board, so he's not completely leaving. And this comes as the company also announced that it's cutting 2,800 jobs. And some of the people who have been let go have said that they've been notified by their Slack actually being disabled at the company. And we also saw reports that Peloton is offering a year of free Peloton service to those who have been let go, which I don't really know how that's going to help put food on the table, but I guess it's something. The company says that it's aiming to achieve an $800 million cost savings and that they're going to be cutting expenditures by $150 million, all of that this year. Now, in addition to the moves that the company is making, we've also seen, obviously, a lot of talk about the potential for Peloton to be scooped up by a company like perhaps Nike or Amazon. There's also been talk about how it fits into Apple's portfolio, especially with its Apple Fitness Plus program and its work in the fitness area, though it really is kind of a long shot, I think, for Apple to pick something like that up. And the idea that they're actually putting their own CEO into place after replacing Foley kind of says that it wants to stay independent for the time being. But, a lot of this goes back to the production issues that they had, the idea that so many people were leaving their Pelotons or not interested in buying up Pelotons as they went back to gyms, as we started to see the coronavirus kind of cut back and start to see people going back outside again. So this just seems to be a perfect storm. And obviously Blackwell's Capital being the activist investor coming in and calling for a lot of these changes. So we'll have to see what happens during the earnings call later today.
Yeah, I think there are going to be lots and lots of questions on that earnings call about the future of Peloton. I just want to get back to sort of what I'm calling the cringe moment of the day for Peloton. And that is they are giving those 2,800 employees that they're letting go of a free 1-year subscription on the way out the door. What does that do to sort of the court of public opinion when it comes to this company that we know has been struggling with its image for quite some time now?
Yeah, I don't think this helps Peloton at all. I mean, you can start off with that very cringy ad that they had run a few years back where it looked like the guy's girlfriend or wife was being held hostage while riding on the bike. And then you have obviously the Sex and the City spinoff or return where one of the main characters dies on a Peloton. We have another show where a character had a heart attack on a Peloton. And obviously Peloton's not going to, do that unless you have some kind of underlying health issue. I think if I got on there, I would be okay. But they really need to do something about trying to pull their kind of image out of the gutter and, offering the people who you just let go a year of your service. I mean, that does not do any help for that.
All right, Dan Howley, more to come on this story. Thank you so much. Alexis?
All right, thanks so much. All right, are those supply chain bottlenecks finally starting to ease? We'll find out when the executive director of the Port of Los Angeles joins us next. The supply chain issues that crippled our nation's ports at the end of last year are starting to look a little bit better. Here to fill us in is Jean Soroka, Executive Director at the Port of Los Angeles, which we know is one of the busiest in the country. Jean, good to have you on the show. So let's just start with an update here. How many ships are out there waiting to get in? How many containers are waiting to get taken out of the port? And how does that compare with just a few months ago?
Yeah, good morning, Karina. The number of ships coming across the ocean, those that have just left or traversing the Pacific or just about to get here to the ports of Long Beach and Los Angeles, counts at 83 today. That's the lowest it's been since the fall of last year, just before the industry started to measure the ships through their new queuing process. The flow of cargo continues with an early Lunar New Year in Asia, landings here for container cargo toward the end of this month. And what we've seen is a large number of these ships by count are the smaller vessels by capacity, which take just as long, if not longer, to work. The total container count on the water coming across represents about 2 weeks worth of work for us.
Now, Gene, how long are these ships staying in port on average? And then are you still considering imposing fees for if they stay on the dock for too long, those dwell fees?
The work of the vessels in Port, Alexis, are really staggered throughout the course of the work week. If there's enough room on the terminal tarmac, we're able to unload those ships in good frequency. They're staying a little bit longer than normal, dependent upon the shipping lines requirements and the private sector terminal operators plan to move those containers in and out by truck and rail. What we have right now is 55% of our truck gates go unused every day. That means we've got about half of our capacity in latent stage. We could move more cargo in and out. There's also 30% of our rail capacity that's not being used today, as markets have shifted since late last summer. In both cases, both modes of transportation, we can handle more cargo than ever before. On your question of those long aging containers, which we tried to isolate last fall, since we announced a penalty back on October 25th, we've reduced those containers that were sitting 9 days and longer by an amazing 74%. We now have less than 10,000 container units on the ground, well off the peak of 37,000+ units back in October. So our plan looks like it was correct. Let's segment that cargo away that's not needed right now and speed the other product that needed to get to market. Think of factory parts and components, those products that needed to go into our medical system and hospital communities, as well as those at the retail level that needed to get to market for the all-important holiday season. And as we've seen, while no one is taking a victory lap, retail sales grew by 8.5% during the holidays, and it was the best retail sales year in our nation's history.
Gene, Alexis here. Give us a feel for what the biggest challenges are at the moment, because we know with the Omicron surge and even prior to that, there were real labor issues up and down the supply chain. Is it infrastructure? Is it not having room to stash the goods once they're offloaded from inbound vessels? As you see it right now, what are the most outstanding challenges?
There are so many elements to this, Alexis, that you really can't just pull one lever and say, I've got it isolated, it's going to be fixed. This all began with the trade policies back in the fall of 2017, leading up to the implementation of trade tariffs in March of 2018. Many American importers rushed and advanced inventories to market as quickly as they could to avoid those taxes or tariffs. China then met us with retaliatory tariffs that really hurt the American farmer and manufacturer. Go a little bit farther forward to the fourth quarter of 2019, our business fell off a cliff, dropping by some 16%. Then COVID-19 hit China and the manufacturing community shut down for the better part of the first half of 2020. Our business then dropped another 19% through the month of May. Then suddenly the strength of the American consumer shined through and we began shipping more cargo than ever before. In fact, the trade gap widened even after those policies were implemented, simply because we weren't traveling, going to movies or ball games. We were buying products and more online than ever before. That cargo keeps flowing, and it was never overly terrible for the supply chain, but it was like taking 10 lanes of freeway traffic and squeezing them into 5. If the driver next to you didn't let you in and you had to get to work at a certain time, you were left behind. And that's what we saw with a lot of American importers, small and medium, who were getting stuck behind the larger importing companies who didn't need their product right away. We had on our docks lounge chairs, patio furniture, and even flat screens for Super Bowl back last fall. Those products weren't needed right away. We needed to get the other goods to market. And that's how we started to segment the cargo, prioritizing based on need in the supply chain domestically. We also have an infrastructure law now in place, which will allow us to hopefully erase and leapfrog a decade worth of underinvestment. $11 billion in the past 10 years was assigned by the federal government and Congress to ports on the U.S. East and Gulf Coast compared to only $1 billion here out west. That's got to change. 40% of the nation's imports come through Los Angeles and Long Beach ports, and we should get a representative amount of those federal infrastructure dollars.
Gene, let me jump in here because I'm wondering if you can give us an educated prediction, I guess, as to when we might see the supply chain go back to pre-pandemic levels, or is there just going to be a new normal for us, and when might that, what might that look like?
I don't think we're going to hearken back to a better look at yesteryear. This is what we have to work with. American consumers are driving this economic recovery through COVID-19. We're seeing more purchasing online, as you all have reported so often. And in addition to that, we're going to be ramping up American exports. We've got to help better balance this trade, not only for the industry, where we start getting round trip and triangulated economics for our service providers, but we've got to get the American farmer and manufacturer back in the game. The use of digital solutions will become omnipresent. Right now, with the Port Optimizer, the Port of Los Angeles introduced the nation's first and still only port community system. We have a line of sight as much as 40 days upstream in Asia as to what's coming our way. That way, we can better plan staffing and machinery to move all this cargo, but we need others to adopt this. It's not good that just in our patch we can see the cargo. We need a wider array of service provider participants to be able to see that data, share theirs in generic format only, nothing proprietary, but one that will help us really drive the decision-making of the importers and exporters so they then have choice. Which rail, truck provider, liner shipping company, and port they may use.
Yeah, I mean, I agree. Transparency is key, right? You all have to be able to be looking at the same thing to make the best choices. Gene Soroka, Port of Los Angeles Executive Director, thanks so much for your time today. Karina?
Okay, coming up, why crypto could turn out to be king this Super Bowl. Stay with us. Welcome back. Well, some are calling this year's big game the Crypto Bowl instead of the Super Bowl, with multiple crypto ads debuting. Here with more is Yahoo Finance's David Hollerith. And David, FTX actually planning to give away Bitcoin as part of its ad.
Yeah, fat with profits from this 2-year bull market we've seen in the cryptocurrency sector. A lot of cryptocurrency companies, particularly exchanges, are looking to gain brand recognition in this year's Super Bowl. Now, FTX is sort of coming out on top, and this is becoming a little bit of a race. they released their commercial about 2 days ago. And in it, it's sort of showing a parody of various characters throughout history getting over their skepticism over FTX's giveaway. Now, the giveaway, in fact, is at the airtime, depending on when FTX releases their ad during the Super Bowl, they're going to give away the amount of Bitcoin based on the time of their release. So if the advertising spot is at 9 o'clock, it will give away 9 BTC. If it's any time later, it'll obviously increase. So what we're seeing is sort of a catchy kind of joke at, a lot of people who still have a pretty significant skepticism towards cryptocurrency. And that's a lot of what this whole major ad spin, especially towards sports marketing, has been for cryptocurrency companies. It's to try and get brand and name recognition. So I think we're expecting to see a lot of cryptocurrency advertisements this Sunday, and it'll be interesting to see who comes on top. They're all going to have an interesting spin. Another sort of side to this too is that Anheuser-Busch owns exclusive rights to beer ads during the Super Bowl. So Miller's parent company, Miller Lite's parent company, Molson Coors, is actually, since they can't advertise in the Super Bowl, will be doing an ad spot on a cryptocurrency virtual reality platform called Decentraland during the Super Bowl. So there's a little bit of other companies that are starting to advertise with cryptocurrency specific products in this kind of interchange we're seeing. But obviously, a lot of this is coming from the fact that cryptocurrency market has a ton of money flowing around and maybe not as much brand recognition.
All right, well, we'll have to see how much water cooler talk revolves around those crypto ads after the game. We'll leave it there. Yahoo Finance's David Hollerith. Thank you so much. Alexis?
All right, guys, thank you. Coming up in the next hour here on Yahoo Finance Live, the CEO of Lululemon is going to stop by. And of course, we'll have the latest on Peloton. Its earnings out. They disappoint. Lots of changes there on tap. The stock, though, rallying double digits. We're going to dig into all of it right after this. Welcome back to Yahoo Finance Live, everybody. It's 2 p.m. here on the East Coast. I'm Alexis Christoforous along with Karina Mitchell. Want to kick things off with a check of the markets, but the real action today actually taking place over in the bond market, where we have the 10-year Treasury yield climbing to 1.96%, so closing in on that 2% level. It's a level we haven't seen since 2019, and in fact, some analysts are betting we could be headed for 3% this year as the Federal Reserve hikes interest rates to battle that red-hot inflation. Let's switch gears and look at the stock market, because after searching for direction this morning, investors have found it. As you can see, that direction is up. The Dow Industrials gaining now more than 360 points. The broader market also higher, led there by technology and financials. We've got investors waiting for some fresh inflation data. That's due out Thursday in the form of the Consumer Price Index. And also big name companies out with earnings this week. We heard from Peloton already today. We've got Disney and Uber set to report as well. Pfizer, by the way, the top trending ticker on our Yahoo Finance site today after posting quarterly earnings that beat estimates. Revenue, though, missed Wall Street's lofty expectations. The drug maker, though, predicting record revenue this year as it expects to sell $32 billion of its COVID-19 vaccines and $22 billion of its antiviral coronavirus pill. For more trending tickers now, let's check in with Jared Blickery, standing by for us at the charts. And Jared, I know you are, I see a lot of green on your screen.
Yes.
You're going to start with Morgan Stanley. Hits a record as those financials surge today.
Yes, they are. And it's all about the yield curve and that move in the bond market that you were just discussing. We can see Morgan Stanley up a little bit less than 1%. This is what they've done over the last year. Only recently have they been breaking to new highs. And you can see it's just a new nominal high. Really haven't broken out for sure just yet. But I would expect, based on this momentum, and if we get that surge in yields, bringing the 10-year up to 2.0%, I would expect it to be able to move beyond materially these levels. But it's not just Morgan Stanley that's hitting records. It's American Express today. A lot of the insurance companies have been recently hitting record highs. Berkshire Hathaway is right there. So all in all, looking pretty bullish for the financials here.
And then, Jared, news not so good for Meta. There's a lot of controversy surrounding privacy and data in Europe, and Meta says it has absolutely no desire to withdraw from Europe.
That is right. So there is a little bit of a confusion earlier this morning. They disclosed something in a regulatory filing last week, and it contains some language that might have suggested to some that they were considering pulling out of Europe. That's what the headlines were. However, they are saying that is not the case. And I do have a statement from one of their European spokesmen. They're saying, like all publicly traded companies, we are legally required to disclose material risks to our investors. Last week, as we have done in our previous 4 financial quarters, we discussed that continuing uncertainty over the EU-US data transfer mechanisms. They pose a threat to our ability to serve European consumers and operate our business in Europe. Meta closely monitoring the potential impact to the millions of people and businesses who use our services as these developments progress. Like other international and European businesses, brands, and trade organizations, we hope to see continued progress in negotiations for a privacy shield replacement. So just a little bit of confusion there, wrapping that up. But the real story is the incredible price decline. You can see over the last year, we have come down and hit more than a 52-week low here. That's a 30% drop from just before their earnings last week. So the carnage kind of continuing here for Meta.
Wow, not a good looking chart there. Another chart that's not real pretty is Cathie Wood's ARK Innovation. I mean, the stocks in there have gotten slammed. Are there any signs that, we've reached a bottom?
Well, I'll tell you what, we're at the point where we could easily see a short covering rally. But when you look at the year-to-date performance of a lot of these components, you can see everything from here down is more than 20% off. But Square, the ticker formerly known as Square, that's down 37%. Shopify down 36%, Roku 31%. I'm writing about this at yahoofinance.com, so I encourage people to read the article. You take a look over the last year, a lot of these stocks actually topped out just over a year ago, and so we're seeing a lot of carnage here. Only Intellia Therapeutics, that's up 25%, Tesla up 7% over that year. So really a lot of the high growth stocks have been getting slammed, and more so in the ARK fund. So we'll have to see what comes of it, but could be due for a short covering bounce.
All right, Jared Blickery, thanks for the roundup. Athleisure retailer Lululemon is out with its second annual Global Well-Being Report. And here to break it down for us is Lululemon CEO Calvin McDonald. Calvin, welcome back to the show. It's good to have you here again. We spoke last year when you had this inaugural well-being report, and compared to then, it looks like we're starting to feel a little bit better. Where did you see the most improvement?
We did, as you mentioned. And first of all, as a company that supports well-being, we believed in the importance to continue this work of benchmarking the state of well-being across the world to really help inform us and create a healthier future. Last year, the Global Well-Being Index was at 65, and this year, the score came in at 66, which with a study of this size, over 10,000 participants over 10 markets, that is a meaningful improvement. And with that, though, there are still challenges and opportunities, as I'm sure we all feel, to feel more well. And the key areas there were holistic well-being continues to be a challenge, with only 29% of respondents feeling a high degree of well-being. Gen Z continue to face the most challenging well-being scores, and returning to work, interestingly, actually was shown and reported to drive the well-being score up. So some interesting insights in its second year.
Yeah, I'm glad you brought up that return to the office stat, because when you first did this report last year, a lot of us were not back in the office. Some of us still aren't back in the office. So it's nice to see that folks are feeling a little bit better about returning. You also took a look at social media and how that's affecting our overall well-being. What did you find there?
Yeah, with social well-being, it's definitely not an either or scenario, meaning no social media leads to better well-being, but there's definitely a min and max in how much one should engage in social media. And what we found was those that spent an hour and a half or less on social media scored and indicated a higher overall well-being. And interestingly, Gen Zs, which scored the lowest, also spent the most on social media, over 3 hours a day. So we definitely saw a big connection between the number of hours spent and one's overall well-being. And that's really driven because a big part of social well-being, which is one of the aspects of the holistic well-being index, we look at it through a physical well-being, mental well-being, and social well-being. Social media helps us feel more connected to family, friends, and loved ones. But there is a diminishing return if you spend too much time, and it can weigh negatively on your overall well-being.
Yeah, I think my takeaway there is everything in moderation, right?
Yes.
What are some of the successful coping strategies that you heard people talk about in terms of making them feel better and improving their overall mental health?
Yeah, it's definitely, I think, being second year into the pandemic, one of the things that we saw rise where people reported handling and using more coping skills to improve their overall well-being, which is an encouraging trend. And of those, the top 4 were spending time outdoor, physical activity. Both of those seem logical. They're hard to prioritize at times, but when they do, they definitely impact one's physical and mental well-being. And the others, coping is connecting with people that you care about daily and taking breaks to relax throughout the day. The notion of take care of yourself to take care of others. So these coping skills, many of them aren't new. It's the discipline of using them, but we're definitely seeing that people are finding ways to incorporate them more into their daily activities, which is helping to impact their overall well-being.
And before we move into sort of the business and business conditions at Lululemon, I just want to ask this contribution that you're making, the company's making to well-being in the global supply chain. Can you just briefly fill us in on that?
No, for sure. As I mentioned, we're committed to advancing well-being, not just with our own employees, but with our guests and our collective community, be it our partners on the manufacturing side or in the communities in which we serve and do business. And we're very proud to have announced the Center for Social Impact in October of this past year. And the center's focus is really on to provide access to mental well-being tools to over 10 million people by 2025. As well, we pledged $75 million to help contribute and support well-being across our global communities. And some of the key areas where we've already deployed and working with a number of our partners are with United Nations Resilience Fund for Women, Women Win, as well as CARES Made by Women. Great organizations focused on mental well-being and something that we're committed and will continue to invest and support.
Fantastic. Good luck with all of that. I want to talk a little bit now about those business conditions, because I know, Calvin, last month you warned that Q4 results would come in at the low end of guidance because of some of the constraints brought on by the Omicron variant. So I'm wondering, 1 month later, what are you seeing? Are there any improvements there on the labor front, on the COVID front?
Yeah, as you mentioned, we indicated with the Omicron rise that we saw across many of our markets, which led to operational constraints, which led to anxiety with guests shopping through some of the most important, highest volume weeks of the year through the holiday. We definitely saw that impact as a result of the updated guidance. At the same time, we indicated that it really was a short window of impact, and then post that we saw an increase in traffic, a return to sort of that pre-Omicron impact, and we're continuing to see that as we move out of 21 into 22. Operational constraints in a lot of our markets, in particular in Canada, are softening, and some guest confidence in coming back and shopping is returning. So similar trend to what we shared. And on a labor shortage market, we're also seeing our numbers within our own store teams dropping and able to return to more stable operational with access to our educators.
That's definitely encouraging news there. And just sort of part of your overall commitment to well-being, you bought Mirror, that fitness startup, for $500 million a couple of years ago. I know since then you've had to cut the brand sales outlook, but I'm wondering if you're going to be doubling down on that space. Do you see more acquisitions like that in the future? And dare I ask, would you be interested in Peloton at all?
We're not going to comment on any speculation on other businesses that are in the marketplace. What I will do is talk about Mirror and the fact that the acquisition of Mirror was to strengthen our retention and loyalty with our guests. What we've learned through our membership pilots pre the Mirror acquisition is that there is a strong connection and relationship we have with our guests and demand to offer sweat options, both digitally and physically. And we know the more they sweat, the more they spend, and that drives loyalty. So it was very much through that thesis that we were excited about the acquisition. And it's been about a year and a half. We've seen significant growth and growth in the membership base, which is having the impact. So we're excited about building this community. We're excited about sharing the vision of Mirror, as well as our new 5-year growth plan in the coming months at our Analyst Day. As you know, we reached our 5-year growth plan 2 years early at the end of 2021. So we're very excited about that, excited about sharing the next 5 years of our growth story, and Mirror and the notion of driving community and connection plays a part in that, and we're excited to share that.
Well, certainly as the CEO of a company that does own Mirror, you're watching this sort of drama unfold with Peloton. There's news that one of your competitors, Nike, is looking closely at buying it. Is there an opportunity there, perhaps, for Mirror? And I mean, they just let go of thousands of employees. Is that even an opportunity to perhaps bring some of those folks on with a background in fitness hardware to something like Mirror?
We're growing. Mirror, we're growing the guest and membership features. We're excited with the size of our membership base at the end of 21, with only owning the business for a year and a half, and we're continuing to invest in that membership experience. And that investment opens up the opportunity for people, for new roles, and we're always out looking for talent. We'll continue to do that. And the benefit is Mirror fits within the Lululemon ecosystem, plays an important part, but it's a part of a growth story. And we can take the time we need to grow it, to build the community, build a meaningful community that's engaged with the brand of Lululemon and the opportunity that we have across our activities. And that's what we're really focused on as we drive the overall business. Mirror will play a part in that, but we definitely are taking a long-term view of building that community. And talent always is a big part of our growth story. It's how we grow, it's how we deploy, and we're always out looking for great talent.
Well, it's nice to have the time to grow that community and to grow that talent. All right, Lululemon
Absolutely.
CEO Calvin McDonald, always a pleasure. Thanks for stopping by.
Great, thanks so much.
Karina?
Okay, that was a great conversation. I've got to say, I love my mirror. I use it all the time. We are going to switch gears, and coming up after a quick break, a look at the best ETFs to consider in the current economic and dividend-rich environment. Stay with us. Welcome back to Yahoo Finance. It's time now for our ETF report brought to you by Invesco QQQ. ETF inflow has seen continued momentum into the start of this year. Here with which ones are gaining traction, let's bring in Todd Rosenbluth, head of ETF and mutual fund research at CFRA. Todd, thanks so much for being here. So investors poured a record $7.5 billion into dividend ETFs in January alone. How do you square that with the rotation we're seeing in equities?
So what we're seeing in the equity space is either investors are rotating towards more value-oriented strategies and companies that are paying dividends and consistently paying dividends or having an above-average yield would fit into that camp. But we're also in a potentially rising interest rate environment. And because we're in that environment, investors are looking at equity income in a different way than they might have beforehand. You could have gotten exposure to the S&P 500, the broad market, and paid a dividend that was above average what you'd get in the 10-year Treasury. Now you have to look for more dividend-oriented products to be able to get exposure to those above average yields.
So when you're looking at dividends, there are two broad categories, right? There's growth and there's high yield. So what should investors know about the differences between both of those?
Right. So dividend yield-oriented ETFs tend to be more defensively slanted. You'd have higher exposure to consumer staples, to utilities, in some cases energy, because of how the stock prices have fallen, whereas dividend growth-oriented ETFs have more exposure towards cyclical sectors. You'll find industrials, you'll find financials. In some cases, you'll find technology. If we look at a shorter period of time of dividend track records, so an ETF like VIG, Vanguard Dividend Appreciation ETF, has a healthy weighting within the technology sector, whereas an ETF like SDY, which is a Spider S&P dividend ETF, which looks for 20 years of dividend growth, it's not going to have companies such as Microsoft that have been raising dividends for 10, but not yet 20 years. So you really need to look under the hood and make sure you understand what you're getting, even if you're focusing on dividend growth as opposed to dividend yield-oriented products.
I'm wondering, it's a challenging year ahead. So what if companies start to pull back on the dividends they offer? What are you advising clients? And then what about duration as well?
Right. So companies that have raised dividends don't perpetually raise dividends. We saw AT&T cut their dividend. They actually stopped paying or stopped raising the dividend in 2021, and then they cut it in 2022. So stopping raising it is certainly a sign that there's something at risk. You want to look for companies that are growing their earnings, that are likely to be able to continue to grow their dividends. Those go hand in hand. A company's board and management is less likely to have confidence in the longer term earnings prospects and yet raise a dividend. So if you're looking for companies that you find within NOBL, which is the ProShares dividend ETF, or SDY, that State Street product, or VIG, look at the companies inside and look at their earnings prospects, which is something that we're doing with our research to understand if these are good, average, or bad ETFs.
And then you also like some value ETFs as well, but you say look inside those as well because it's important to know some of the differences, because there can be a disagreement about what constitutes a value stock, right?
That's right. So the two leading value-oriented ETFs are the iShares Russell 1000 Value ETF and the iShares S&P 500 Value ETF. You can tell they're different because they've got a different index name, constituents that are part of it. The iShares S&P 500 Value ETF, IVE, has companies like MasterCard and Visa, where you wouldn't find that within the Russell 1000 Value ETF. So not surprisingly, since those are technology companies, you'll get more exposure to the tech sector with IVE than you would get with the iShares Russell 1000 Value ETF. And I see we're showing on the screen here the performance. These are not going to perform in line with one another because they're constructed differently. So even though value ETFs have been particularly popular to start 2022, it does matter what ETF you're choosing and the index partner that they're working with.
Hey, Todd, really quickly, only a few seconds left, but new Bitcoin ETF from Valkyrie coming on the market today. How coincidental it comes just ahead of the Super Bowl where there's so much interest in crypto. Do you see more interest in crypto ETFs coming down the line this year?
So we've seen relatively strong interest in that. Investors have stayed loyal to the Bitcoin futures-based ETFs like BITO from ProShares. The Valkyrie product you're talking about is a Bitcoin miners ETF. So these are owning companies that are exposed to the Bitcoin space. We're certainly seeing supply for that. I think there's overall demand, but obviously we haven't seen the performance in 2022 to back that up.
Okay, we will leave it there. Todd Rosenbluth, head of ETF and mutual fund research at CFRA. Thanks for your perspective today, Alexis.
All right, thanks a lot. Well, the 2022 Oscar nominations are out. Coming up, we'll look at the surprises and the snubs right after this. Welcome back. Netflix stands to be the big winner of this year's Academy Awards. Its Power of the Dog leads the pack with 12 nominations. But as usual, it's the Oscar snubs that have everybody talking. Here to break down the nominations for us is Yahoo Finance's Alexandra Canal. So, Allie, let's start with who actually did nab some nominations. What stood out to you?
What stood out to me, Alexis, is that we're in a drastically different environment than we were even last year. Studios are still trying to figure out the best way to bring content to consumers. In terms of nominations, as you mentioned, Netflix, once again, standing on the shoulders of its streaming competitors, 27 total nods, led by The Power of the Dog and Don't Look Up. However, that's down from last year's 35 nominations. So just something to keep in mind as we talk about the role of streamers at the Oscars. Meanwhile, we have Apple TV Plus going up this year compared to last with 6 nominations. Last year, they only had 2, so a decent jump for Apple TV Plus. They scored their first Best Picture nod with Coda. In addition to that film, The Tragedy of Macbeth, starring Denzel Washington, also added to the streamer's total haul. And moving on to Amazon Prime Video, 3 nominations, led by Being the Ricardos, all in the acting category. But similar to Netflix, that is also down from last year when the streamer had 12 nominations, and Hulu once again staying on pace with just 1 nod. So it's not like we saw pure play streaming giants really dominate the nomination list this year. I actually think last year was a bit more significant. On top of that, we had more muddled distribution models from studios. Pretty much all of them leaned into that hybrid release strategy. Warner Brothers' King Richard, for example, landed 6 nominations, including Best Picture, but was a simultaneous release on HBO Max the same day as theaters. Same thing with Dune, 10 nominations, but once again, shared the big screen with the small screen. So there's no denying that the landscape has totally transformed, obviously accelerated by the pandemic. And we know that these streamers, especially Netflix, they've been paying top dollar to secure that content. The A-list stars, the marketing campaigns, they want Oscars, they want recognition. But I think it's interesting to look at a streamer like Netflix, for example, that saw huge success with Squid Game, now 27 Oscar nominations. And yet, in the last earnings report, there was still a slowdown in that subscriber growth. So I think Hollywood at large still trying to figure out where streamers fit into all of this and into all of this, all the awards and all of the movies and the TV shows and everything that we talk about every day. And I think that's going to be the more interesting story to focus in on, even when we get these winners in March.
Equally interesting to focus in on are all of the snubs. I'm shocked Lady Gaga was not nominated for House of Gucci.
You are not alone, Karina. That's probably the most talked about snub, Lady Gaga. House of Gucci at large, they didn't get a lot of love from the Academy. The film was shut out from most of the top categories, including Best Picture. In fact, it only received 1 nomination for hair and makeup, no acting nods at all. Some critics thought that Jared Leto would win best or get nominated for Best Supporting Actor. They thought Gaga was a shoo-in for Best Actress. A lot of critics were also surprised that we saw Kristen Stewart get nominated for Best Actress, but no, Gaga. But we always have some of these major snubs here. I also think it's interesting to see that Spider-Man No Way Home, the film grossed over $1.7 billion in international markets, which is a huge success both globally and domestically, especially during the pandemic, praised by critics, and yet it only received 1 nomination in visual effects. Now, historically speaking, the Academy doesn't really embrace blockbusters like that, but some critics thought that there was a chance that this could squeak by and get a Best Picture nomination. So that had fans pretty disappointed. And I think that's going to be something that the Academy is going to have to grapple with moving forward, the future of these award shows. Perhaps it could be more relevant, more accessible if more of the big blockbusters were nominated for these types of films. And in the past, we have seen that with Joker and Black Panther, but there's usually a more artistic element to things. So that's something that I'm going to be watching moving forward. But regardless, I do think that these award shows, they need a shake up. They have struggled in recent years to really capture audiences. Viewership has been on a pretty significant decline. So I'm curious to see how they handle the live telecast this year in March.
Yeah, we're all curious to see what that's even going to look like, because I think the Golden Globes, didn't they basically tweet out who the winners were? So yes. With COVID, we're still in a COVID world. We'll have to see how it all shakes out. But thanks for wrapping that up for us, Allie Canal. Karina?
Yep, I have definitely a lot of catching up to do on some of those nominees. We'll leave it there. Coming up, from high wattage star power to a check of the energy sector and how oil closed. Stay with us. Welcome back to Yahoo Finance. Well, oil slipping today from a 7-year high. Here with more on that is Yahoo Finance's Jared Blickery. Jared, what's behind the dip today?
Well, we got a little bit of supply, more supply coming online in the coming years than the market had thought. We are seeing WTI down about 1.7%. The final closing number was 89.36, and it is, of course, still trading in the aftermarket hours or electronic market. Here's a 2-month chart. We haven't really seen much of a downdraft lately. These red bars tend to be buying points rather than selling points, at least on the following day. So we'll have to see what comes of this. But the U.S. just upped its demand forecast for the current year to nearly 12 million barrels, or excuse me, the supply, its output supply characteristics to 12 million barrels per day. And then for the next year, 2023, they're expecting 12.6 million barrels to be produced in the U.S., and that would be a record. So with all that extra supply, we're only seeing the price of crude oil futures down 1-2%. I think it's just a blip on the radar here. We're going to get some numbers after the bell, the API weekly inventory numbers for the U.S. And then tomorrow morning, we get the Department of Energy numbers. That'll probably be more of a catalyst here, but it speaks to the long term because we know President Biden has been adamant that the price of crude oil and, of course, gasoline go down. We know there are midterm elections this year, so a lot is at stake. And let's take a look at our energy heat map. We can see a lot of red on the screen. Exxon down about 2.5%, Chevron down 1.5%. I believe it did start out the day in the green. It did hit a record yesterday, but nevertheless, seeing a little bit of inside action today. So all in all, we're seeing a little bit more supply potentially coming in not only this year, but the next year.
Okay, Jared, we'll have to track which way it all goes. Thank you so much for that report. We are going to pivot now and turn to our next story. The U.S. is facing an opioid crisis. According to a new government report, fatal opioid overdoses cost our economy $1 trillion a year. Here with more on that story is Yahoo Finance's Adriana Belmonte with a special guest. Adriana.
That's right, Karina. I want to bring in John Abramson. He is a professor at Harvard Medical School, and he's also the author of a new book, Sickening: How Big Pharma Broke American Healthcare and How We Can Repair It. John, before we dive into your book, I want to ask you about the recent opioid settlement between the state of Texas and Teva Pharmaceuticals. According to the Texas AG, Teva will pay $150 million over 15 years and provide $75 million worth of naloxone. Do you think this is enough to undo the damage that they've caused?
Well, no, you can't put the genie back in the bottle. It's important to have these kinds of settlements so that people can be in part compensated, but you can't bring back the people who are dead, and you can't you can't give back the shattered lives, the time that has been lost. So I think the key here going forward is to figure out a way to prevent these kinds of tragedies from happening, to prevent the pharmaceutical industry from excesses that are damaging.
So kind of on that topic, you talked a lot in your book about big pharma, the deceptive practices that many of them, if not all of them, carry out. So politicians have vowed to address the issue of prescription drug prices, just big pharma at large, but there's no legislation that's really been passed over the last few years despite these promises. So why do you think this is?
Well,
Welcome back to Yahoo Finance. Well, we had some technical issues, but want to bring back both our guests, Adriana Belmonte and John Abramson, the Harvard Medical School professor and drug litigation expert, talking about the opioid crisis and legislation. Adriana.
Hi. Yeah. So, John, I wanted to ask you, politicians have vowed to address this issue with big pharma, prescription drug prices, but there's been no pieces of legislation passed over the last few years. Why is that?
Well, the pharmaceutical industry is very bipartisan in the way it doles out lobbying money and campaign contributions. So more than 80% of Americans want drug prices to be controlled. And the same number think that the drug companies are more interested in profits than they are in helping people. So the fact that legislation cannot get passed is a demonstration of the failure of our democracy to play the people's will to play a countervailing role against industry, which is in control here.
And we had the Pfizer CEO on our show a few months ago, and he argued that prescription drug prices, because they only account for about 12% of our overall healthcare spending, they can't be to blame or the big problem for what's going on with our healthcare. Do you agree with that assessment?
That's a great question. Thank you. First of all, if he said 12, he's wrong. It's about 17%, but it doesn't change the basic question. Can pharma be responsible for what's going on in American healthcare if it only accounts for 17% of our spending? And the answer is yes, it can, because pharma has taken over virtually all of the knowledge that's produced that informs doctors about how to practice medicine. So even though it's only 17% of our healthcare dollars, 96% of our research agenda is committed to developing new drugs and devices, and only 4% is left over to look at how to make Americans healthier. The health of Americans is a crisis that should be covered every day in the news. We rank 68th in the world in our healthy life expectancy. We've gone down from 38th in 2000 to 68th in 2019 before the pandemic started. And for this poor health, falling so far behind the other wealthy countries, we're spending $1.5 trillion extra. So what we've got is a market that is driving our healthcare towards the most profit-generating way of providing care, which is going to make the investors maximally happy. But we don't have the welfare of the American people at hand, and our health is far inferior to the health of other people in similarly wealthy countries.
And lastly, I want to ask you, in your opinion, how do you think that we could rebuild the trust that the American public has with pharmaceutical companies and just our healthcare system at large?
That's great. So what we need to do, first of all, is we need to liberate the data. The drug industry pays for about 86% of clinical research. They own that data. They don't make that data available to peer reviewers. They don't make that data available to the experts who write clinical guidelines. So the docs who are trying to practice evidence-based medicine have to take the drug company's word about what their clinical trials show. We need a system that is based on verification, not on trust. And that would be one of the key pivot points to make peer review truly informed by the underlying data. Another thing that would go a long way, the United States is virtually the only wealthy country that doesn't have a way of performing health technology assessment so that an independent body assesses clinical trial results and tells doctors which new drugs provide heretofore unavailable benefit and provide value that's worth the cost. We lack that. So doctors are stuck reading peer-reviewed articles that haven't been clearly vetted and following clinical practice guidelines where the experts haven't had access to the data. And we don't have any outside body to tell docs what the most effective and efficient way to practice is.
Well said, Dr. Abramson.
Thank you.
Thank you so much for joining us today. Back to you, Karina.
All right. Thank you both so much. That was a fascinating conversation. Adriana Belmonte, along with John Abramson, Harvard Medical School professor. And the name of the book is Sickening: How Big Pharma Broke American Healthcare and How We Can Repair It. All right. I'll throw it over to you, Alexis.
All right, going to do a hard turn here, Karina, because coming up next, it has been a 6-year hiatus, but Nissan returns to the Super Bowl with a star-studded commercial. We'll have that right after this break.
Nice ride.
Want to give it a spin?
Coffee's enough excitement for me.
Come on.
Very nice. Catherine?
What the?
All right.
Is that
Eugene Levy? Eugene.
All right, that's a taste of Nissan's 60-second spot airing in the fourth quarter of Sunday's Super Bowl between the LA Rams and the Cincinnati Bengals. And as you can see, it is packed with celebrities. Joining us now is Allison Witherspoon, Chief Marketing Officer at Nissan US. Allison, thanks so much for joining us. I see you have the car behind you. This is Nissan's first Super Bowl ad since 2015. So why was now the right time to come back?
For us, obviously, advertising in the Super Bowl is a considered investment. And so Nissan doesn't go into the Super Bowl and advertise every year. What I was looking for in evaluating it this year was, one, we have been investing in the brand over the last year, and we've been running a year-long brand campaign. The second piece of it was really about the product transformation that we've been on over the last couple of years. And the third one is that we have some exciting new products, and you mentioned them, they're right behind me. In 2022, we're going to be launching the all-new Nissan Z and the all-new, all-electric Nissan Ariya. So we felt that all three of these things combined gave us a really good opportunity to tell our story through the Super Bowl platform.
Now, Allison, I've got to tell you, my very first job ever was working for a show called CBS Sunday Morning. And the assignment was we were tracking two companies who were putting their Super Bowl ads together. One of them was Ford and one of them was Charmin. And I'll date myself by telling you in those days, the top spots went for $2.5 million for a 30-second spot. There are some companies now that are paying up to $7 million for this Super Bowl for a 30-second spot. You're taking a 60-second ad. There is so much pressure to deliver. And I'm wondering, is a return on investment worth it all? Or is it just about getting the buzz?
I think it's obviously, in order to make this type of investment, you do have to be confident that there is going to be a return on that investment. When we go in and evaluate it, one, we're looking at, can we actually have a strong story that we can tell in the Super Bowl? And that's going to be really around our brand and the products that we have coming out. And the second one really is going to be about the efficiency of it. So we do an ROI investment. We did see that this was going to be positive for us this year. And then it's about proceeding. We have a very strong measurement framework that we have in place to determine whether or not this is going to be a success. It's going to be about measuring demand that the campaign delivers, as well as the return on the objective. Is it moving the needle when it comes to the brand metrics? And then obviously the return on the total investment.
And Alice, I'm wondering how you look at this holistically, because the way we watch or consume things like a sporting event has really changed. And it doesn't mean the Super Bowl has to happen on a big screen TV anymore. Lots of folks are going to be looking at it piecemeal on social media. So how does this change, I guess, your advertising strategy when you have to factor in things like social media?
Yeah, so the biggest change, and this happened a few years ago, it's been going back for a few years now, but the biggest thing is that it's now not just about the game day. What's interesting about game day is that obviously, it is a massive platform. It's a way for you to reach over 100 million viewers. And it's also, you have a very captive audience and they're interested in the advertising. But really what you need to be doing, and this is just because of basic consumer and human behavior, is how do you tap into those second screens? We know everyone is engaging in social media, they're engaging digitally. So how do you make sure that your actual spot in the game is going to be amplified a lot of times leading up to the game, but also actually during the game? How are you going to make sure that you're engaging consumers? And that goes all of that goes into the planning process and how we put together our plan for Super Bowl.
Allison, it's really important to make sure you capture the right ad, right? So people are talking about it the next day for all the right reasons. So talk about some of the trends and some of the creative concept and thought process that went into developing this particular ad.
So what we were really looking for is we wanted to tell and talk about our transformation story and how one drive can change everything. And we knew that we wanted to talk about our all-new Nissan Z and our all-new Nissan Ariya. And from there, we also knew that humor works very well in the Super Bowl. And humor, it's not just a linear path. You have to find the right type of balance with that. You have to find the right type of tone. But we knew that we wanted to tell a more comedic, lighthearted story as well. And so the concepts came from there. It really started with talking about a transformation. We couldn't think of anyone better than Eugene Levy, who is a beloved character, and actually showing him in a way that's unexpected, that people haven't seen from him before, to help us tell that story.
Anytime you can get Eugene Levy into something, it's a positive. Allison Witherspoon, Chief Marketing Officer at Nissan US. Thanks so much, and happy Super Bowl Sunday. All right, we want to switch gears and bring you some breaking news now. Jared Blickery standing by at the charts with news on Microsoft, said to be pursuing a deal for the cybersecurity firm Mandiant. And Jared, I know that stock just resumed trading a moment ago, and it is rallying.
Look at that, up 17, almost 18% here. Now, Mandiant is a company that was spun off from FireEye a few years ago, and now Microsoft, according to Bloomberg, and this is just a report, according to sources there, may be buying it. They're careful to say this may not result in an offer, but you can see the chart right there. In fact, let's do a max chart, and this is going to go back to 2015. You can see the stock after an initial pop here, lots of IPOs experiences, basically been treading water over the last 5-6 years. So you can see it's down 50% from that beginning slot. But I do have some details here. The company's current market value before the announcement was $3.7 billion. Also adding that Microsoft, they bought two smaller cybersecurity companies. That was last year, and they have amassed $15 billion in software security sales in 2021. That is up almost 45% from a year earlier. This is according to the Bloomberg article. So we'll have to see if this comes to fruition, but we know that cybersecurity has been in the forefront of investors' minds, although I would say as an industry group, along with software, it is really beaten down. So perhaps Microsoft is simply taking a stab at this company because of the depressed prices. And I just check out Microsoft here. Since we have a couple seconds, we can see not really moving much on that news, given the behemoth that it is, but up about 0.9% today.
All right, thanks for bringing us that breaking news, Jared Blickery. Karina, over to you.
All right, and we're going to leave it there on this risk-on session for the market. Still lots more earnings to come after the bell, but we will leave it there. From Alexis and me, thank you so much for watching. And after the break, Yahoo Finance continues with our next set of colleagues into the closing bell and beyond.
Folks, you can forget about rabbit season or duck season. We are squarely in earnings season, and today we zero in on revenue and earnings figures after the bell. On deck in the ride-hailing industry, we've got Lyft shares moving higher ahead of the report earlier today. And in the fast casual restaurant space, Chipotle, ticker symbol CMG. We're tracking those shares into the close. They've been waffling a little bit earlier. We'll have the latest results for you after the market close. Meanwhile, at Peloton, it's the end of the road, as Boyz II Men would say, in the CEO cycle at least, for co-founder John Foley, who will matriculate to the executive chair role, while Barry McCarthy steps in as CEO and president. Peloton simultaneously released a strategy to reduce costs, which includes cutting approximately 2,800 global positions and trimming warehousing and delivery operations. Where the ride goes from here in just a minute. And later on, filmmaker and actor Mark Duplass of Morning Show and Believe fame joins Yahoo Finance alongside Seed and Spark CEO and founder Emily Best with the details on their new crowdfunding program that connects established filmmakers and industry industry veterans with emerging storytellers, all that and much more during today's show. Counting you down to the market close. You're watching Yahoo Finance Live. Today is February 8th, 2022, and I'm Brad Smith.
And I'm Emily McCormick. Great to be with you, Brad. And this afternoon, stocks are trading in the green, but of course, anything could happen in this final hour of trading. But for now, we are seeing the Dow Jones Industrial Average up more than 200 points, or about 0.6%. The S&P 500 up about 0.3%, and the Nasdaq Composite up about 0.6%. So seeing those technology shares coming back during today's session as well. But diving a little bit deeper into the S&P 500 by sector, we have materials, consumer discretionary, and financials, the outperformers during this afternoon session. Whereas on the flip side, we do have energy, real estate, and communication services lagging in the broader index. But taking a look at a deeper dive at the market action, we want to bring in our first guest of the hour, and that is going to be Jack Manley, JP Morgan Asset Management Global Market Strategist. Jack, thank you so much for joining us. We've seen stocks beginning to shake off some of that volatility that we saw in January. What do you think is going to be the biggest factor that'll determine whether we continue on this upward trajectory or whether we're going to be getting some more volatility in the near term?
Well, I'll tell you, Emily, right now, what people are looking for in markets is earnings. That is the story at the moment, because we know moving through 2022 that earnings are going to come under pressure as margins contract and as the economy slows down. It's why we're concerned about things like rising interest rates. It's why we're concerned about the elevated inflation prints. It's why we're concerned about policy missteps this year. The way that we're going to be able to avoid any of those potential pitfalls is through earnings. So looking at the earnings season as it develops so far, it's been a pretty good one. Looking towards that forward guidance, trying to figure out what this year is going to mean for corporate America. That, I think, is what's going to keep us on the right track when it comes to price performance today, tomorrow, and the rest of this year.
We haven't heard a ton from companies about the Fed policy environment that we are in right now. Do you expect them to continue to lean into how, in some cases, they are needing to still monitor some of the supply chain crunches that they are seeing, or how they're investing further into their business, either in the form of share repurchases or in CapEx? Or do you expect them to just continue to move forward, give investors as best guidance as they possibly can right now, as we're finally squarely in earnings season where we've gotten guidance at least for most of those companies?
Yeah, Brad, I mean, the problem, right, is that there are just so many moving parts right now, and it's got to be so difficult to be in that C-suite trying to project out where things are going this year, considering the fact that there are so many risks, so much uncertainty. You know, even when it comes to Fed policy, I think there are plenty of opinions about what exactly interest rates are going to do this year. There are clearly plenty of opinions about when supply chain kinks are going to get ironed out. I think that these companies are going to provide as much guidance as they possibly can, given the information that is available at the moment. But I think we as investors paying attention to what's going on in these companies just have to recognize that a lot can change, that anything can happen between now and the end of this quarter, now and the end of the year. It's going to be a difficult time period, I think, for earnings. And yet again, that's why it makes such a compelling case for paying close attention to who can generate sustainable, stable earnings right now.
Well, and to that point, so far in 2022, it seemed like the market has been weighing these ongoing concerns over the Fed tightening against signs that the economy, the consumer, and to your point, corporate earnings are still holding up quite robustly. Now, with that in mind, how confident are you that the Fed is going to be able to engineer this soft landing that it's aiming for without derailing some of these positives for corporate earnings or the economy that we've seen so far?
So I'll tell you, Emily, you know, the way I think about a lot of the recent Fed positioning is that rather than telling us objectively, very obliquely, that it's going to be hyper aggressive this year, Jay Powell and the FOMC have reminded us that they have a whole lot of tools in their tool chest when it comes to dealing with overall macro conditions. They want to raise rates by 50 basis points. They can raise rates by 50 basis points. They want to hike 10 times this year. They can hike 10 times this year. It doesn't mean that they're going to. It just means that it is a possibility. So when I think about where rates are going from here at the moment, I would absolutely say that the Federal Reserve would be able to engineer a soft landing. But the timing of those rate hikes, the magnitude of the change in balance sheet, the magnitude of those rate hikes, those are all things that the Fed is going to have to be very, very careful about as we see how policy evolves really starting in March. If they make a misstep, if they make life too challenging for the consumer, they could very easily throw this economy right back into a recession. And And I think they are cognizant of that position, of their power in the space right now. And they're going to act with a whole lot of caution and a whole lot of stability in terms of forward guidance, in terms of signaling, and in terms of actual policy changes.
Additionally here, when we think about where the U.S. kind of sits within this broader recovery, if you will, because there was so much impact globally from the pandemic on the early onset in 2020, and then even lingering through 2021. And now, even as we're getting more of that transparency to the best of their ability as possible from companies, how are there still lingering global impacts that some of the companies that have relied on their globalization for growth are still having to navigate through?
Well, Brad, I'd say from a global perspective and an interest rate side of things, we have to remember that U.S. interest rates don't operate in a vacuum. We have to take into consideration what's going on with other central banks around the world. We have gotten a lot more hawkish sentiment out of places like the European Central Bank. That does indicate that rates are going to move higher globally. But I think we have to recognize that most of these developed market central banks like the ECB, like the BOJ, are going to be behind the Fed when it comes to how much they can do and how frequently they can do it. That suggests to me that we will continue to have an interest rate differential here, which does help to keep a lid on just how high U.S. yields can climb. Now, when it comes to supply chain issues, that is unfortunately a global issue at this point. I mean, certainly the U.S. has its own fair share of problems, particularly on a labor front. There just aren't enough transportation workers. There just aren't enough warehouse workers. But globally speaking, supply chains are very sensitive everywhere. COVID tolerance policies are sensitive everywhere. A shortage of semiconductors means a shortage of a whole host of goods everywhere. And so it's not just going to be us climbing out of this problem. In fact, exactly to your point, Brad, we are, I think, in the midst of maybe the early innings of a global synchronized growth story, a whole big cyclical upswing as the entire world starts to emerge from COVID. So I think something to take into consideration as we look out over the course of this year. It's a lot more than just the US in terms of the opportunity set because of where the whole world is coming from.
Certainly, something we're going to be keeping a close eye on. Jack Manley, we appreciate the time here today. JP Morgan Asset Management Global Market Strategist joining us here on Yahoo Finance Live. And continuing to celebrate Black History Month and multicultural advancement in business, we speak with the Chief Engagement Officer about the ETF designed to provide exposure to U.S. companies with strong racial and ethnic diversity policies in place. That is coming up next.
Welcome back. Interest in environmental, social, and governance, or ESG investing, has grown dramatically in recent years as traders consider putting capital to work in areas that promote a sustainable and equitable future. One fund focused on investing for social advocacy and racial justice is the Impact Shares NAACP Minority Empowerment ETF. Marvin Owens, Impact Shares Chief Engagement Officer, joins us now for more. Marvin, thank you so much for your time this afternoon. Looking at this ETF, the ticker is NACP, and many of the top holdings are companies very familiar to many investors and that are also some of the top components in the S&P 500, like Apple, Microsoft, Amazon, and Tesla. Tell us what Impact Shares is screening for when considering what companies to include in this fund.
Thanks for the question, and it's great to be here. I think that we're focused in on what is most important related to our advocacy partners. Impact Shares created this ETF in partnership with the NAACP. The NAACP has more than 100 years of advocacy history behind it and advocating for racial equity. It began with the corporate scorecard that was a couple of decades old, in which we took that strategy and applied it to publicly traded companies. So we're looking at things like board diversity, supplier diversity, freedom of association policies, gender pay disclosure information. We're also looking at things like media ethics, product offering ethics, and we're excluding those things like fossil fuels and companies that profit from riot gear and other sort of exclusions. But the idea here is to be in alignment with the mission of the NAACP.
And so have you had to do any rotation, and in the future, how do you continue to track where companies stand on some of the promises that they've made with regard to diversity, equity, and inclusion, and where they're continuing to champion the measures that are necessary to see this through to fruition?
Yeah, that's a great question. Two things that come up. I think the one thing is that we're using data that is derived from our partners at Morningstar and Sustainalytics. Sustainalytics is a leading ESG data provider, and we're constantly getting updated information about what companies are doing, what's happening with them in terms of what they're doing around these kinds of commitments that they've made publicly. The key here is to align those public pronouncements with actual change internally, and that's where the engagement of a partner like the NAACP becomes most important. The NAACP is constantly engaging with corporate America to ensure the fact that they're creating policies and implementing programs that are in alignment with the concerns around racial equity.
You also, in addition to rotating companies and considering how they're making good on some of their commitments, you also previously updated the indicators that you use to assess these companies. And recently, your updates have included looking for companies with media ethics progress, human rights progress, advertising ethics, and more. I'm wondering how often and what tends to catalyze these updates in terms of the parameters that you're looking for to evaluate your companies as well.
Yeah, again, that goes back to the partner that we have in the NAACP. That update really was the result of the engagement work of the NAACP. We can go back a couple of years to the engagement that the NAACP and other civil rights organizations had with companies like Facebook, in which there was a real concern around hate speech on their platform. And so these civil rights organizations really sat down with the leadership at Facebook and began to sort of ask the kind of questions around what could be done to be better at making sure that hate speech was not on their platform. What resulted was that we looked at our factors and social factors that we were looking at and said, we really do need to take a look at this. Previously, we had not looked at that as closely as we had most recently. But I think the reality is, as the NAACP becomes more clear in terms of what the kind of work that they're doing, the result of their engagement, then our social factors begin to reflect those evolutions.
The social factors, they also kind of range across a bevy of different, not just companies, but also subsectors as well, and the responses that those industries and sectors are having to issues that also do have an impact on equity and inclusion. And if we even think about climate, all the way to housing, where are some of the other areas that you're kind of prioritizing in the future where there could be additional ETFs that stem from a very similar environmental and social governance initiative?
That's a great question. We have 5 ETFs right now on our platform, and most recently we launched over the summer OWNS, which is a mortgage-backed securities ETF that's really focused on closing the racial wealth gap through Black home ownership. This is another one of those opportunities that we're saying that you can take the public markets and capital markets to really move the needle on the social concerns that we care about and that make our country and society better. We have an SDGA fund that is focused on sustainable development goals. We launched at Glasgow Net Zero Fund, NTZO, that it's really about reducing carbon and really making those climate commitments that are most important to not just our country but the entire world. So I think that there's plenty space to really develop what we call bespoke financial products that are in alignment with leading social and environmental advocacy organizations. So we're looking for a number of new opportunities to develop new products in the future.
What kind of returns have you been seeing recently for the NACP ETF and impact shares, other ETFs more broadly that you were just talking about? And how do you expect these funds to perform relative to the broader market in the future as, again, impact investing, ESG investing becomes something more and more important to many investors?
Yeah, I think thanks for raising that question. We've seen our products perform very well. I mean, we're talking between 20 and 30% returns. We are doing extremely well. What we're trying to do is to ensure the fact that the investing audience understands that you can align capital with cause and you don't have to make a concession about returns. You can do well and do good at the same time, and our products are a good example of why that's the case.
All right, we'll leave it there for now. Marvin Owens is Impact Shares Chief Engagement Officer, and we thank you so much again for your time this afternoon. Coming up, the bets are rolling in with the Super Bowl on tap for this weekend. With more states legalizing sports gambling, sports betting platforms are gearing up for a record influx of wagers. We'll have a breakdown after this quick break.
Welcome back, everyone. Big bets for the big game are adding up as more states have introduced legislation for gambling, prompting a surge for new customer acquisition from sports books. Here with more is Yahoo Finance's Josh Schaefer. Josh, just help us quantify the growth in wager volume even before the Super Bowl.
Yeah, Brad, it's been huge. I mean, Americans are really interested in sports gambling. So we got information out today from the American Sports Gaming Association, which is projecting that this will be a record year for Super Bowl gambling. They project that it's going to be 31.4 million Americans, which is up 35% from last year, gambling on the game. And then for an exact handle, the projections are that it's going to be $7.6 billion bet on this game. That's more than $3 billion more than last year. We should note that respondents of that survey, it was about 2,200 people, slightly favored the Rams. About 55% said that they were probably going to bet on the Rams. And the Rams are favored at about 4.5 points, depending on when you bet and what you look at. Now, I spoke earlier today with American Gaming Association CEO Bill Miller about the increase in betting interest from last year. And he cited really the growth in legalization and just the genuine interest from customers to gamble legally. They like these marketing deals they're getting. They like using the apps. They're interested in betting legally. There's 10 more states this year that are legal than last year's Super Bowl, and 30 states and Washington, D.C., so 31 different territories are eligible to gamble this year. That's more than we've ever seen for the Super Bowl. Thus, the numbers go up. I mean, we should note this industry is only 4 years old, and not even 4 years old. It's really growing state by state. And Miller expects it to grow even more headed into next year. He told Yahoo Finance some states to watch are going to be Florida and California. Those bigger population states are going to be really interesting to see what happens, because as we saw with New York last week, if you can get a state with big population like a California or a Florida, you're going to get a really big handle. One other thing I wanted to note that Miller told me, I asked him about the marketing dollars we've seen all these companies spend, and he said he thinks that's going to continue. The companies really need to spend the marketing in order to get these bettors in from their illegal means that they might have been using prior. A lot of different companies and bettors different companies are trying to acquire these guys by giving them free bets and giving bettors an advantage. And that gets them away from the illegal gambling they were doing and into their ecosystem. That's something that probably isn't going to go away, but might become a little bit less frequent moving forward.
Josh, what does this increase in betting volume this year mean for some of the publicly traded companies in the sports gaming industry?
Yeah, Emily, it's still a really interesting space as far as publicly traded companies go, because there's really kind of two different sections we can look at here. There's the traditional brick and mortar casino companies that have got into the gaming space. When you look at a Penn National Gaming, Caesars has their own sports book now, MGM Resorts has BetMGM, and then we have DraftKings and FanDuel, some of the newer companies that are all online and don't have that traditional brick and mortar Las Vegas style vacation arm to them that we've seen before. So from analysts we've talked to at Yahoo Finance, the biggest things to watch are honestly who's winning the marketing game bottom line with all that money they're spending on the ads we all see on TV and the deals they're giving out, and who's partnering with the best content product. This is something that's been interesting that we've talked about here on the program before with some different CEOs, and we'll probably talk about with some executives later this week, is how these gambling companies are incorporating what they're doing in with a broadcast. We know Fubo Sportsbook, which streams sports, has been able to do this because they have an app that's all-inclusive. FanDuel does this a little bit, where they can send you an alert that says your bet might miss, tune into this sport, and it sends you to an app to watch. I think that might be kind of a key to unlock here. And one other thing on those marketing dollars, because we love talking about who's profitable and who's not, I wanted to circle back to New York from last week. We saw Caesars Sportsbook come in with the biggest handle, over $615 million in New York over the first month. They also had the most aggressive marketing pitch, but it didn't hurt them. They had over $55 million in gross gambling revenue last month. So that marketing pitch paid off and got them the biggest gross gambling revenue we've seen to date, we saw in New York. So I think that if the company that finds the way to spend money on marketing while still securing that bottom line are the companies that are going to be the ones to watch moving forward.
All right, I was part of at least one of those bets, I do know, Josh, in New York, so definitely got me on that front. Shame that Minnesota is the only place right now with that legislation, so we'll see if some Twins and Timberwolves fans can get their way in the future. Our own Josh Schaefer joining us here with the breakdown. Appreciate it, Josh. And everyone, coming up on the other side of this short break, we're diving into the scientific advancements that produce COVID vaccines and distribution to every corner of the world, but what comes next in the process of achieving true global vaccine availability and equal access. That is coming up on the other side.
Welcome back. As COVID cases pull back from a peak across many parts of the U.S., some regions are beginning to ease up on mask mandates and other restrictions. For the latest on this and other developments on the virus, we have Yahoo Finance health reporter Anjali Kamlani with us now. Anjali, you also had the chance to speak with CDC Director Dr. Rochelle Walensky. Tell us about that and what else you've been tracking on the virus front.
That's right, Emily. So we know that, of course, we're starting to see Omicron cases come down a little bit around the country, still at concerning levels, but still on a downward trajectory. And for that reason, we're seeing some easing of mask mandates, especially in the Northeast corridor. New Jersey announcing yesterday that they're going to ease mask mandates for schools by March 7th, and other states have followed, including Delaware and Connecticut, following the example set by Pennsylvania. And we're also hearing about other states potentially getting into that. Meanwhile, of course, a lot of focus on just what the future guidance looks like when it comes to this pandemic. And on that note, I did get to speak to Dr. Rochelle Walensky about specifically testing for travel. We know the airlines have been pushing for that. And here's what she had to say about that.
It certainly is. And what I will go back to really is I'm cautiously optimistic that our cases have come down dramatically, that our hospitalizations are coming down dramatically. But what I will still say is that we came down from a very high level and that our hospitalizations right now are higher than they ever were during the peak of our Delta surge. So while we will look down the field and say, what does this look like and how can we relax some of our mitigation strategies? First, we always need to be prepared for what may come around the corner. And second, we're not quite ready to do so yet.
So as you can hear, really, not quite the time yet to consider those repealing. And sort of in the same vein, we've seen that controversy over any mask action on masking in schools and elsewhere. So it seems like things are sort of status quo, actually, to be honest, for right now. Back to you.
Anjali, thank you so much for that. We're having you stick with us as we bring in our next guest. Dr. Peter Hotez is co-director of the Center for Vaccine Development at Texas Children's Hospital and Dean of the National School of Tropical Medicine at Baylor College of Medicine. Dr. Hotez, thank you so much for joining us, and congratulations on your nomination last week for the Nobel Peace Prize by Congresswoman Lizzie Fletcher for your work with Dr. Maria Bottazzi. I do want to ask about that work on the Corbavax vaccine. Tell us how this differs from the COVID-19 vaccines we've seen widely in the U.S. from Pfizer, Moderna, and J&J.
Yeah, sure, Emily. It's an older technology. It's a recombinant protein vaccine that's made in yeast, and that means it's a vegan vaccine. Number one, no mammalian cells, no animal cells, no animal protein, human protein. People find that attractive. But also it's a technology that's been around a couple of decades. And it's similar to the yeast fermentation technology used to make the recombinant hepatitis B vaccine. And the reason that's significant is the ability to make that vaccine at large scale is in place in multiple low and middle income countries, in Brazil, Argentina, in Bangladesh, in Vietnam, and Indonesia, and India, and the list goes on. So that if you want to make a global health vaccine locally and make billions of doses, we need 9 billion doses for the world's low and middle income countries. This is the one because it produces high levels virus neutralizing antibody and T cells, no limit to the amount you can make, simple refrigeration. It's the lowest cost COVID-19 vaccine. The Corbevax and the one we licensed to India will be 145 rupees, which I had to look up. It means about $1.90 a dose, so this will be the least expensive of the COVID vaccines. So it checks really a lot of the boxes that you would want for resource-poor settings for global health vaccines without sacrificing any of the quality in terms of its ability to protect against COVID. So we're very excited about it.
And Dr. Hotez, to emphasize on that fact, you did license it for free to these companies. And I know that you've been working with, one of the companies here, or at least your partner in India is working with a company here to get that through the FDA process. But looking at what we have globally as the scene, right, we've seen other companies really falter when it comes to certain manufacturing issues. The surges over time have weighed in, supply chain issues. And when it comes to the mRNA vaccines, while they do remain very popular globally, they don't necessarily suit the needs of some of the destinations where we still see largely unvaccinated or low vaccinated populations. How do you plan to overcome that, or do you see the route to overcoming that so that we can, get out of this pandemic?
Well, the problem, Anjali, was the science policymakers never really understood the scale of what's required. If you've got 1 billion people on the African continent, 1 billion in the smaller low-income Southeast Asian countries, almost 1 billion in the Latin American countries, especially the low and middle-income ones, that's 3 billion people. We're talking about 9 billion doses of vaccine. And so, you hear the president of the United States, President Biden, a few weeks ago said, boast that the U.S. is going to donate 400 million doses of mRNA vaccines. Well, it's not a drop in the bucket, but it's 5% of what we need. And so with our vaccine that, as you point out, we've licensed with no patent, no strings attached, or as I like to say, when your house is on fire, you don't call the patent attorney, you call the fire department, and we're the fire department. We've licensed it with no strings attached or patent to vaccine producers in India, Indonesia, Bangladesh, and now Southern Africa and Botswana. And BioE is the furthest along. They have 250 million doses ready to go. They're now making 140 million doses a month. That's 1 billion doses, and that could really start having some impact. As I say, and at the lowest cost possible. So it's a privilege for us at our Texas Children's Hospital Center for Vaccine Development to make that kind of impact. The irony was we got zero help from the U.S. government and we got zero help from the G7 countries. We're able to do this through private philanthropy raised in modest amounts raised in Texas and also New York with the JPB Foundation. And that's what did it. We would have been a lot further ahead had we gotten more support. Who knows? Maybe the world could have been vaccinated by now. We never would have seen the Omicron variant. But hopefully now we can make up for lost time, and we're doing that.
That certainly would have required the absence of politicization of this virus and the vaccination process as well, we do know. But in one of the points that you mentioned as well, it also comes down to, in the future, when companies do shift to a for-profit model for vaccine production and having them be as accessible and producing in the quantity that is necessary to continue to curb any type of variant that comes forward in the future. What does that reality look like? And ultimately, how can we ensure that people still have access and that it is affordable in the future?
Well, as I say, I think we've figured that out, at least for this virus. The problem is, whenever you start with a brand new technology like mRNA or adenovirus or particle vaccines, there's a learning curve before you can go from 0 to 9 billion. And as any engineer will tell you, it doesn't matter whether it's mRNA or new technology widgets, it takes time to learn how to make it at scale. So I think moving forward, we need manufacturing hubs and not only focused on mRNA, because mRNA has weaknesses as well. You show me a different type of vaccine technology, I'll tell you about its strengths and its weaknesses. So we need lots of shots on goal. So we should have manufacturing hubs in place all over the world for mRNA, for adenovirus, for particle vaccines, for yeast fermentation, recombinant protein technology, for vesicular stomatitis virus, VSV technology. Remember that one? That was used to prevent Ebola in DR Congo. That was spectacularly successful. So we have to have all of those in place. And we have to also give greater autonomy to the low and middle income countries. Right now, all of the so-called stringent regulators, called stringent by the World Health Organization, are in Canada, the US, the UK, Europe, Australia, and Japan. And so there's no low and middle income country stringent regulator. So it's discrimination, it's colonialism. We need to give that authority to excellent regulatory authorities in India and Brazil. And while the multinational companies, a lot of people throw stones at them, they do important work. They're important for providing vaccines for the Gavi Alliance. I don't have a problem with the big pharma companies, but you do not want to be exclusively reliant on them, because you see what you got. You've got this gross health disparity between the North and the South. So what we need to do is balance it out, support the multinational pharma companies, or they find a pretty good way to support themselves, but also support the low and middle income country vaccine producers, support nonprofit product development partnerships, based in academic medical centers like ours that are helping them and actually developing the vaccines and doing this without patent or strings attached. That's the way to do it. And if we have to break out of this one-dimensional that only the multinationals can do this, because one, it's not true, and two, it produced truly gross vaccine disparities and inequalities over the last 2 years.
Absolutely, and we've been keeping an eye on that. Dr. Hotez, I apologize, I did misspeak. You do not have a partner just yet in the U.S., and so I wondered if you could update us on that, on whether or not you've received interest, especially after the attention around your vaccine. And then really quickly, moving forward from there, just where do you see, after the news of the African hub producing and being able to reproduce Moderna's vaccine and the focus on that global South and South Africa's role in there, if maybe not in time for this pandemic, but maybe they're on the path for the next pandemic. Do you see that as potential?
Yeah, a couple of things. So, I'm getting, and my science co-partner, Dr. Batazzi, she's getting as well, about a dozen emails every day saying, hey, doc, I'm not going to take that mRNA vaccine, but I'll take your vaccine. Well, it's not, I mean, I think I know what they mean, our recombinant protein vaccine. And, unfortunately, we do not have a path in the U.S. We don't have an interested industry partner. We don't have any of the Operation Warp Speed or U.S. government support to make that happen. So I just have to explain to them why you still need to go ahead and get your mRNA vaccine. Maybe that'll change in time. But I do think it could help a lot closing the vaccine hesitancy gap in the United States if we could have it made available. In terms of Africa, we've also now licensed it to Immunity Bio, headed by Patrick Sung-Shung, who is based in Los Angeles, but has a commitment to do something for the African continent. And he's now building infrastructure in South Africa, as well as in Botswana. So we've licensed our vaccine to him so he can make it as well. So in time, I'd like to see a kind of a rich ecosystem build in Africa for producing vaccines of multiple different technologies like mRNA, recombinant proteins like ours. And you have to do that because you never know which technology is going to work or not work for a given pathogen. I mean, the VSV technology was a spectacular success for Ebola. It did not hold up so far as we know with COVID-19. mRNA may be the inverse. Even though it's working this time for COVID-19, there's no guarantee it's going to be a good vaccine for the next pathogen to come around. So again, each vaccine has strengths and weaknesses.
Dr. Peter Hotez is co-director of the Center for Vaccine Development at Texas Children's Hospital and Dean of the National School of Tropical Medicine at Baylor College of Medicine. Thank you so much again for your time. And thank you as well to our own Yahoo Finance's Anjali Kemlani. Coming up, the future of stablecoin regulation was in focus today as the House Financial Services Committee convened for another crypto hearing this morning. We'll discuss on the other side of this break.
The House Financial Services Committee gathered today for a crypto hearing on digital assets and stable coins. This hearing follows the international finance discussion papers published by the Federal Reserve in January, acknowledging stablecoins' growth potential and impact on this new type of particular transactions as well. And we've got more from this hearing. Let's play a quick clip from what took place.
The report recommends that stablecoins be issued by insured depository institutions. And in that sense, then stablecoins would not recommend that stablecoins be issued by technology companies. This is the issue of the separation of banking and commerce has been an issue that Congress has grappled with for many years. In this case, we believe stablecoins as a payment instrument should not be issued by a technology firm.
And joining us now with more, we've got Decrypt Editor-in-Chief Dan Roberts. Dan, thanks so much for joining us on this day where we know the hearing was taking place. As we mentioned, this followed what the Federal Reserve had published in January about central bank digital currencies, also acknowledging stablecoins' growth potential and impact on banking. Is there anything from today's hearing that sets up any type of acceleration in either legislation or advanced dialogue, at least, on the very matter of stablecoins?
Well, I don't know about an acceleration, but I think in many ways it confirms our reporting from 2 weeks ago. I mean, the clip you just played, basically we wrote a big story on how the Biden administration would like to bring control of the stablecoin market into the hands of the big banks that they trust or at least think are above board, FDIC insured. You heard it right there. They are aware of the big growth of stablecoins and it concerns them. Not all of them, but many, Democrats especially, which has been interesting. And they would like to curb the rise of stablecoins that are issued by technology companies. So of course, that's the leading centralized stablecoins right now. That's Tether, and the company behind that is Tether. That's USDC, and the company behind that is Circle. And that's USDP, and the company behind that is Paxos. What we have reported, and I think the hearing today confirms it, is that the administration would like to not kill stablecoins, but bring them under government trusted entities control. Maybe that's banks, maybe that's agencies and regulators. It's quite a plan. And it's interesting because they see the stablecoin market as their way in, their door through which to kind of curb the whole crypto industry, either rightly or wrongly. And I should say the other highlight to me was the different opinions that we heard from some folks today. They're not all on the same page, and that's clearly a problem. Brad Sherman, who is the congressman from California, who's a Democrat, said that he sees crypto as akin to subprime mortgages, which doesn't make much sense, and said that it could be a threat to people of color. Meanwhile, Gregory Meeks in New York, also a Democrat, said that he believes crypto offers new opportunities for the unbanked and underbanked. So a lot of these lawmakers are not on the same page. They just know that they're concerned about stablecoins.
Dan, what's happening based on your reporting at some of these companies currently issuing stablecoins who perhaps aren't FDIC insured, perhaps aren't under that umbrella category of non-banks that follow specific rules that would be warranted under what's currently being proposed out of Washington? Is there a lot of concern about upcoming regulation? And if so, how are they handling this?
I think there's a lot of concern about upcoming regulation. Absolutely. You nailed it. They kind of are in a push and pull where they can't ignore these regulators who are issuing potential new guidance. Of course, nothing is official yet. For example, that Fed report also invites public opinion. You can imagine what the public opinion they'll get from the crypto industry is. It's stay away from us. But there's a tension here, right, between the people who have come into crypto who are more traditional, cautious, conservative investors and years ago wanted nothing to do with crypto. Now they've changed their tune. They like crypto as an investment. They want to see more regulation. They want to see safeguards and rails. They think more regulation would be healthy for the space. The crypto purists, in many cases, the people who are now pushing these decentralized stablecoins, they would like regulators to stay away. If you are a tech company or crypto company in the middle that offers a token or a stablecoin, it's a tough one because you are being told you have to comply with KYC, know your customer, and AML, anti-money laundering rules, and you think that we better comply. But at the same time, there have been crypto companies that have grown quite a bit that haven't complied. and have so far kind of gotten away with it. So you're eyeing what the lawmakers are saying. In some ways, you're skeptical that they're actually going to really ever do anything, but you're also concerned because if they issue some kind of new format or framework, like say the BIT license in the state of New York years ago, then you're going to have to make a real decision here about to what extent you comply.
The kind of stablecoins that are hoped to be launched in 2022 as well are also hoping that regulators will approve additional blockchain protocol. As of right now, as the International Finance discussion papers had noted, most existing stablecoins, they circulate on public blockchains, Ethereum, Binance Smart Chain, or Polygon. And so is the best way forward, or perhaps the best chance way forward, for a new stablecoin to get approved in this environment, for it to be on an open source protocol?
Well, Brad, I mean, that's the problem right now with the very concept of blockchain. I mean, in some ways, we're starting to get shades of 2018. The joke in the crypto industry is that the narrative in 2018 was blockchain, not Bitcoin. That's when you had companies, financial institutions, banks coming out and saying, we like blockchain. We're experimenting with our own blockchain. Crypto, we don't really want to touch that. And what crypto purists say is, well, the whole point is that, blockchains run on cryptocurrencies to settle the transactions. You have to have a token. And so, when you hear the government talk about either centralized stablecoins or permissioned closed blockchains, a lot of people who've been in crypto since the beginning say that defeats the whole purpose. So really what your question gets into a little bit too is the idea of these CBDCs, central bank digital currencies. China's already done it. Theirs is off to the races. The digital yuan, it's accepted as payment. It's being used at the Olympics right now. The US has basically said it's something we're looking into. And what crypto advocates say is, who wants that? There's no reason for a government-backed cryptocurrency. And so same thing when you talk about centralized stablecoins. If it has to run on a blockchain that a government-backed entity controls, well, then that's not crypto.
Dan Roberts, Decrypt Editor-in-Chief, we appreciate the time and the breakdown on this matter. We're going to continue to see where the dialogue moves forward from here on the Hill as well. Appreciate it, Dan. And keeping with the theme in today's biggest blockchain-based developments, Florida, hear me out here, they made history with a new type of home sale. Yahoo Finance's Rochelle Akufo has more. Rochelle, what do we need to know on this?
That's right. Oh, Florida. Now, imagine being able to buy or sell your home at the click of a button. Now, in what's believed to be the very first U.S. real estate NFT sale, a single-family home in Gulfport, Florida is up for auction starting February 10th. So a few things to know. It's the California-based real estate company Proppy is actually minting the property rights into a digital token, and they're also hosting this auction with the bids starting at $650,000. It's an interesting home. It has sort of elements of a Hobbit, if that's your thing, but an interesting home, and the auction winner will essentially be using cryptocurrency to buy a US-based company that will own the rights to the property. Now, as we've seen from talking to them, bidders' identities will have to be verified and connected to the wallet beforehand in order to participate, and it's only for individuals and not entities. Now, minting property rights into an NFT would allow owners to sell homes as quickly as a Venmo transaction. That's according to the seller and homeowner, Leslie Alessandra. Now, as we've seen over the past year or so, NFTs continue to evolve, first starting with things like artwork and collectibles, and then into things like sporting highlights. Now we're seeing it in supply chain logistics, tracking items in supply chains, and now, of course, with real estate. And let's take a look at what NFTs have been doing. Now, Adapt Radar's industry report for 2021 shows that NFT sales reached an all-time high of $23 billion as some of these bigger brands and celebrities entered the market in 2021. Now, we do see that this Florida real estate auction, I mean, it really does highlight how creative people can be when it comes to things like NFTs and the underlying blockchain technology, and how it can disrupt perhaps any industry, as we're seeing with real estate, as well as decentralizing traditional financing for things like mortgages. Now, Florida's governor, Ron DeSantis, has already been trying to make Miami the center of the US crypto industry, but he's going to have a fight on his hands because New York City is also up for that crown. Brad?
All right. Yeah. Huge mechanisms on both of those state sides to try and figure out how they can become the big crypto hub as well. Rochelle, we appreciate the breakdown there. Yahoo Finance's own Rochelle Akufo. And just minutes left in today's trading activity ahead of some key earnings results from Chipotle as well as Lyft. After the bell, we're going to check in on how major averages are trading into the closing cross.
Welcome back. And let's head right over to Yahoo Finance's Jared Blickery for a check on where markets are trading in these final few minutes of the session. Jared.
Well, I'm actually going to start with the bond market, which settled about an hour ago. We can see the 10-year T-note yield is up 4 basis points. Going to quickly show this 3-year chart. We are back to levels that we haven't seen since about 2019. In fact, inching closer to 2%. And this has important implications for the sector analysis that we're going to do here. Materials, financials, consumer discretionary, tech, industrials, all of those are outperforming. And you take a look at what's happening in the banking sector. Morgan Stanley hit a record high today. That's up 1%. We can look at the travel sector. We also see a lot of green there. American Airlines up 5%. United up over 5% as well. So pretty risk on here. Now, tech taking a little bit of a back. It is an underperformer, but we're not seeing that in the semiconductor stocks necessarily. They are a leader. AMD up 4%. Also seeing software. A little bit more of a mixed picture here. We are seeing some red, but for the most part, nice to see a lot of green. And we got to check out the meme stocks. GameStop has been on our radar today. It's been a trending ticker, the #1 trending ticker for Yahoo for most of the day. And after that, I think we'll check out AMC because AMC is up 10% too. So a lot of the stocks that got beaten down this year are rising today. We'll have to see if it lasts.
We certainly will. Yahoo Finance's Jared Blickery, thank you so much, and we'll see you in a bit. We'll have the closing bell and a breakdown of Lyft and Chipotle's earnings on the other side of this break. Stick with us. Welcome back to Yahoo Finance Live. I'm Emily McCormick here with Brad Smith, and we're also welcoming in our market panel to take us to the closing bell and beyond. George C. is Annandale Capital CEO, and Victoria Fernandez is Crossmark Global Investments Chief Market Strategist. But before we turn it over to you both, let's get one final check of the markets before we end today's session. The Dow Jones Industrial Average is up more than 1% as we speak, up about 372 points. The S&P 500 up about 0.8%, and the Nasdaq Composite up about 1.3%. So definitely seeing green across the screen as we head into the closing bell.
And there you were taking a live look at the closing bell at the New York Stock Exchange and the major averages as we're taking another look at exactly where things end on today's trading activity. You're seeing gains across the board. We've got the trifecta, the hat trick, the triple double, whatever you want to call it. Just call it up across the board. Dow Jones Industrial Average closes higher by about 372 points, 1% to the upside there. The S&P 500, that closes up by about 0.8%, 37 points to the upside. And also in the green, the Nasdaq Composite, that closed higher by 178 points, 1.3% in positive territory. And back to our panel we go. We've got George C., Annandale Capital CEO, as well as Victoria Fernandez, who is the Crossmark Global Investments Chief Market Strategist. Great, again, to have you both here with us today. Victoria, I want to begin with you, and particularly when we think about today's move in the broader context, have we been able to solidly see these markets begin to chart their rebound, or are we just bouncing from some of those levels of the decline that we're tracking, quite frankly, coming into the month of February?
Yeah, so Brad, I don't think I would say that we are 100% in the clear and that we're on this strong rebound at this point in time. There's just too much volatility going on, and I think you're going to continue to see that. I mean, you have a market that's trying to digest so many different elements, right? You've got a decently strong economy, but you've got these inflation concerns, CPIs coming out on Thursday. You've got valuations that have been somewhat stretched. You have questions as to what monetary policy is going to look like over the course of 2022. So there's a lot of digesting going on, and then you throw earnings into the mix, and there's just quite a bit of volatility. Yes, we had that pull down in the beginning of the year, which we were expecting around a 10% pull down at some point during the year. Happened a little early than what we thought it would, but I think you're still going to have some volatility. I would be careful in going all in, thinking this is a rebound that won't come back some.
George, taking a look under the hood here at the sector action today, energy was the biggest laggard in the S&P 500 after outperforming pretty strongly throughout the course of 2022 for the year to date so far. Do you think this is the start of an unwind of some of this outperformance that we saw in some of these cyclical areas and in energy specifically, or is this just a temporary pullback?
Investor looking ahead to the rest of the year, so thanks for asking it. I would say there's a lot of cross currents today. You've got airlines and other reopening cyclical trades that are doing very, very well today and acting very strongly. And I would say that energy has been the leader in the market the entire year so far and was the leader last year too. So to say that trend is going to unwind all of a sudden because oil is correcting based on a potential Iran deal and the potential that Russia may not decide to invade Ukraine, I think is a temporary setback. If you look at the free cash flow these companies are generating currently, I wouldn't want to bet against that over the next year or two. There's a lot of tailwinds behind these stocks, and they've got a lot further to go, I think. But this is a one-day setback. The market's really basically going a whole lot of nowhere so far this year. It's down for the year. This is a nice respite today to get an up move, but I don't think it really knows where to go yet. And with the 10-year at 1.95, you know, the market's ignoring that today. But if it crests past 2, watch out.
George, sticking with you for a hot second here, you also kind of note here how earnings season, even with some of the major tech companies that we've already seen come forward and still yet to have some of the major retail companies, both overlapping in e-commerce and brick and mortar, set to report as well. And so with all of that in mind, where would you still be as we navigate the back end of this earnings season, placing a lot of your attention on, given that there has been a ton of either the forecasts where they're trying to best anticipate where consumers will navigate inflation or where they themselves, these companies, will also navigate their own supply chain concerns?
Yeah, I would really look at the substance of the earnings and not whether they missed by a penny or beat by a penny or things of this sort that traders and Wall Street analysts agonize over. Those are really kind of lower grade pursuits intellectually. I would be looking more at the strength and substance of earnings. And if you look at commodity stocks and cyclical stocks, they're going to have some really nice comparisons and tremendous free cash flow they're generating. And I would focus on that. On the technology sector, I want to note that when Microsoft reported, the initial reaction was a huge sell-off, and then it came back and stabilized. But all the analysts were fretting over the fact that the cloud piece of Microsoft grew 48% instead of 51 or 52%. And the fact that such an unbelievably strong performance by Microsoft gets parceled 10 different ways to Sunday and the stock doesn't move a whole lot, to me says there's some real headwinds on the growth part of the market and the technology part of the market.
Victoria, turning to the bond market, as George was alluding to, the 10-year yield is at its highest point of the pandemic, up above 190 basis points. Now, we've seen in the past stocks react to a sharp move higher in yields, but are we at the point yet where the level of where Treasury yields are trading is something that equity investors should be concerned about?
Well, we've seen a lot of that, Emily, just in the last 6 weeks. As yields would move higher, we saw a lot of those high valuation tech names really become quite volatile, and the prices with huge swings going on there. It's really interesting, though, that in this last push higher that we've seen, maybe over the last week or so in yields, we haven't seen the same reaction from some of those tech names. We see the Nasdaq today up over 1%, I think it was at close. So I think there's a little bit of a shift, and maybe perhaps people looking and saying, look, historically, we're at a 194, a 195. That's still really low levels for the 10-year. You've got global yields really moving. I mean, we have a decrease of 70% of sovereign issues that were negative yielding, right? I mean, just since December. So when you have a huge move like that, I think it makes sense that U.S. yields would get pulled with it. Obviously, equity investors are going to continue to watch that. 2% is going to be a threshold just because it's 2%, right? And we haven't been there in such a long period of time. But I think from a technical perspective, you can still have a strong equity market even with rates moving higher.
Victoria, with regard to your core strategy, you've moved from an overweight to a growth strategy. Can you break that down for us?
Yeah, so we were overweight growth for quite an extended period of time. And as many people were, especially during the pandemic, those were names that you could have as long-term holdings in your portfolio. But probably 6 to 9 months ago, we started trimming some of those growth names, moving more into some cyclical and some value names. Financials is an area we really like. We've started adding to our energy exposure as well. So we think you need to have a little bit more of a balanced portfolio, maybe a barbell portfolio with some growth, but also increasing that cyclical value component, because we do think you're going to have really a tug of war from earnings and from valuations in this economy over 2022.
All right, we'll leave it there. Victoria Fernandez is Crossmark Global Investments Chief Market Strategist, and George C. is Annandale Capital CEO. Well, we're getting some breaking earnings news crossing the wires here. Yahoo Finance's Jared Blickery is standing by with a breakdown of the numbers from Lyft. Jared?
That's right. For the fourth quarter, we have Lyft, and you can see it's popping about 3% in extended hours trading. Revenue came in at $969.9 million. That is up 70% year over year. The estimate was for pretty much lower, $940.4 million. Adjusted EBITDA, $74.7 million versus a loss $150 million years ago. The estimate was for $75.7 million, so a little bit short of Wall Street analysts right there. Now, adjusted net, $32.1 million versus a loss of $185.3 million a year ago. Estimate was for a little bit higher, $33 million. And then active riders. This is a key statistic. Disappointment there, 18.73 million. Street was expecting 20 million. However, those active riders, they did rise nearly 50% year over year. Revenue per active rider, that is $51.79. Finally, they ended the quarter with cash and cash equivalents of $457.3 million, while the estimate was for higher at $802.1 million. And actually, I do have one more number here for you. The contribution margin was $59.7 million versus the estimate of $58.9 million. Now, I do have a statement from the CFO, Elaine Paul. She said, despite short-term headwinds from Omicron, we remain optimistic about full year 2022. You can see the shares now trading a little bit to the downside and the upside in after-hours trading, so I'd say they're fluctuating.
All right, Yahoo Finance's Jared Blickery, thank you so much. Coming up, we'll dive deeper into Peloton's latest quarterly results and C-suite shakeup with Kevin McCarthy, Senior Research Analyst at Neuberger Berman. Stick with us.
Welcome back, everyone. At Peloton, it is the end of the CEO cycle for co-founder John Foley, who will matriculate to the executive chair role, while Barry McCarthy steps in as CEO and president. Peloton simultaneously released a strategy to reduce costs, which includes cutting approximately 2,800 global positions and trimming warehousing and delivery operations. Joining us now for what's next for Peloton, we've got Kevin McCarthy, who is a senior research analyst at Neuberger Berman. Kevin, good to have you here with us today. The company had also released earnings as well, which we'll dive into. But just on the headline of the CEO changeover, what is this signaling from Peloton to the broader investment community?
Great, thanks for having me. It's a pleasure to join, and yeah, certainly a lot of drama unfolding. I think to your question of what was important about today's announcement, it's really twofold. You know, it's a nod to the frustration investors have had, you know, really for the last 9 months, and exactly what John Foley's new role as the executive chairman is probably still somewhat TBD, to be honest. But importantly, the new CEO, Barry McCarthy, really strikes us as being a legitimate agent of change, strong credentials around optimizing subscriber unit economics. And importantly, you know, we don't think what he's doing necessarily takes Peloton out of play. It simply cleans up the business model, something that we all knew, you know, was a very compelling, attractive business model in the first place. And then the second item is that today's release also provides a very credible line of sight to profitability for 23, ramping in 23 and into 24. In the past, the problem has been simply the numbers have not been, the guidance has not been believable. Prior approaches have been too piecemeal, and now we actually have tangible milestones that we can mark to market that amount to around 800 million over the next 24 months. And that's not even including any growth as well.
Kevin, of course, this announcement comes amid multiple reports that Peloton may be seen as a target of an acquisition by an Amazon or a Nike, for instance. So do you think these changes we're seeing at Peloton, the C-suite shakeup, and also the 2,800 jobs that it's going to be cutting, are a sign that Peloton is trying to make a bid to remain an independent company that is now more streamlined?
It's an interesting question, and I don't think it's, as I said before, I don't think, you know, the replacement of John Foley with Barry McCarthy necessarily indicates that they're going to be going one way or the other in this situation. It merely cleans up what I think we all knew was a very attractive subscriber business model. Taking a step back, maybe, you know, this is a very attractive long-term asset. If you think about the context of Peloton, there are 3 million, you know, the 3 million subscribers that they'll have by the end of this year, fiercely loyal, leading NPS scores. Customer engagement is actually up still 20% over the last 2 years, and it accelerated in January from December's. So we argue that the fee stream alone from this business is being undervalued when you use cross-industry subscriber models. And the other point that we make, just from the context of a kind of a long-term perspective and what makes this attractive for the likes of an Amazon, a Nike, and Apple, physical and mental wellness are extremely relevant from a consumer standpoint. And we think connected fitness is kind of the cherry on top. So, you know, if you look kind of the underpinnings for this, you have the emergence of 2 huge generations coming into their prime spending years. Yes, we've probably pulled forward some demand, but time and time again, when we look at psychographic studies, the TAM case is probably still in the mid-teens millions for this in the US alone. So if you compare that where Peloton is today at 3 million, you know, something mid-teens, still a huge amount of growth, and strategically speaking, a leadership position in the connected fitness, which is something, if you look at, you know, what Apple or Nike or Amazon would want, you know, that's a coveted position.
Well, let's think about that a little bit more, because at the market cap that they're carrying right now for Amazon and what they've already signaled within the fitness space, they're going to be more of a companion with the Amazon skills rather than going purely after a hardware player. Apple, they don't have a history of making big acquisitions, especially not to this size and scale. And Nike has exited from much of the even kind of sports equipment markets that they were in previously. So the question being, at what price point would it make sense for any of those companies to buy Peloton?
Well, it's a great question. And I think the answer is, This might have been an exercise to see who flinched first. Having a leadership position in connected fitness, I think, is very attractive. For Apple, it would significantly fortify their leadership position in individual wellness and fitness. So I think that there is, even though that hasn't been something they've been as excited about going on with the hardware, I think it goes a long way in fortifying the moats around their leadership. For Amazon to be a little bit different, they could dramatically alter the CAC proposition, the cost proposition from a logistics and a warehousing perspective. They're clearly the agitator in this situation. And Nike, Nike, I think, would very much so appreciate having a leadership position. But this might be more of a distraction for them. There's plenty of growth, I think, on the bone with Nike and DTC right now, so that this isn't a mission critical thing for them right now. But I think all three of them, strategically having talking about a market that has the potential to grow 5x just in the United States alone, would be attractive strategically for all of them.
I'm also wondering more broadly, how strong is the Peloton brand right now to the general public and consumers? And has it lost any of its sheen, again, to that average user because of everything that's gone on within the company over the past year and because of this decline that we've seen in the stock price over the past 52 weeks?
It's a great question. I mean, and that's frankly what we look at. We look at what the subscriber engagement, to what extent, how, the churn rates, how many times people are using it a month. I believe it peaked out around 24 times a month. We're at around, and that was during the height of COVID when they were just introducing a number of different verticals. It's leveled off at around 15 times a month, which is still a very attractive, engagement from a consumer proposition standpoint. Now, there is competition coming in, and that's something that everyone is mindful of. However, I would say that the benefit that Peloton has is, number one, their first mover advantage. Number two, the stationary bike is something that lends itself to customers having a pretty strong awareness and understanding of what the product is and what it does. So while there has been probably some element of tarnished reputation as a result of this, the value add, if you look at the relevant forums across Peloton, the engagement is still quite strong.
Great to have you here and have this conversation with us today, because there's certainly so much more in this story. Clearly, two Kevins are better than one. Kevin McCarthy, Senior Research Analyst over at Neuberger Berman, joining us today to break down what is next for PTON and Peloton. And we're going to leave that conversation there, but we're going to get to our own Jared Blickery, who is standing by with some tasty earnings that we're tracking here on ticker symbol CMG, Chipotle. Jared, what are you seeing?
That's right, and you're only seeing one of me right now. We have Chipotle up almost 7% in after-hours trading. You can see it's down 16.5% year-to-date, but let's take a 3-year view. And while we're doing that, I can read you the comp sales number for the fourth quarter. Really blew it out of the water, 15.2%. Estimate was a bit lower, 14.8%, and that number itself is up 5.7% year over year. Adjusted EPS, huge blowout here, $5.58 versus the Wall Street, versus a Wall Street estimate of $5.28, but really when you compare it to last year's $3.48, a pretty big difference there. Revenue was in line, $1.96 billion. That's exactly what the street expected, at least in the median, and that is up 22% over the last year. Operating margin coming in at 8.1%, a bit shy of estimates, 9.88%. We'll have to see if there's any color on that in the call. Restaurant level operating margin, that was 20.2%, just a little bit shy of the Wall Street estimate of 20.7%. And then finally, new restaurants in the quarter, those were 78, a little bit better than the estimate of 72. Now for their guidance, they're seeing first quarter comp sales in the mid to high single digits range, and they're also seeing 2022 new restaurants, 235 to 250. The estimate was for a bit lower, 231. And then a very long-term view, Chipotle sees 7,000 North American restaurants over time, and previously they only saw 6,000. I do have a statement from the CEO, and we're saying here, they are saying, moving forward, we believe expanding access and convenience through our digital ecosystem, accelerating unit growth, and continuing to develop our support our restaurant employees. That will all put us in a much stronger competitive position. And we can see here, a little bit of a stumble along with a lot of other stocks over the last, let's say, 6 months. But now that it's probing the bottom end of its range and we are up in the after hours, maybe this is a lunchtime to get back to that upper end. Anyways, Chipotle really knocking it out of the park on the comp sales number, up 6% in after hours trading.
All right, we're going to keep a close eye on shares of CMG, Jared. 86% of those new locations opened in the quarter, including at Chipotle. So prioritizing the grab and go method for sure. Jared, we appreciate the breakdown on the CMG, the Chipotle earnings. And everyone, coming up on the other side of this short break, we continue our discussion on some of the earnings that have come forward, plus much more on Chipotle and the other company that's reported an after hours Lyft. That's coming up.
Welcome back. Chipotle just reported earnings results that topped expectations, and shares are rising in the after-hours session. Fourth quarter adjusted earnings were $5.58 per share, or 30 cents ahead of estimates, and comparable sales growth of 15.2% was also better than the 14.8% anticipated. For more on these results, joining us now is John Stasic, Argus analyst, joining us by phone. John, thank you so much for your time this afternoon. Looking at these numbers, a strong beat across most major metrics here for Chipotle. What was your biggest takeaway from these results?
Just the top line was a little bit better, slightly better, 1 million actually. Yeah, a little bit better than expectations. Digital sales were above 40% again. They're 42%, and they're more profitable than normal sales because they involve less labor. And then food, beverage, and packaging costs. I don't want to be too much of a Pollyanna. We're just a little bit more than I modeled, but I see those easing a bit. So I'm kind of, management had warned us about beef and freight in the third quarter, and so I see those costs easing the next quarter. And even avocado costs, they contributed to higher than anticipated food, beverage, and packaging costs. So, it wasn't a perfect quarter, but it was pretty darn impressive. So, and the restaurant level operating margin was 20%. So,
right. So, John, let's talk about that a little bit more. 20% operating margin. That's an increase from 19.5% in the fourth quarter of 2020. But particularly when we think about what they had to navigate through, they were navigating the wage inflation, of course, that many similar competitors in this industry have to navigate, and higher commodity costs. Are you pleased with those results, or where would you continue to model for them going forward from this point?
Excuse me, I didn't. Could you repeat that? I didn't understand what you
Certainly.
said.
Are you pleased with the operating margin that they saw at the restaurant level, and where would you model for that to go forward from this point?
Yeah, I'm very pleased with their operating level leverage and just their how much they've raised wages and their ability to recruit and keep employees, and just managing beef and freight costs. Just as management pointed out, those were very important to them and a thorn in their side. So so I see restaurant level operating margins actually improving next quarter. So even though I'm a little bit just slightly disappointed, I don't like to be too much of a Pollyanna, but it was a great quarter. So.
And John, we've seen a number of restaurants and other companies in the consumer packaged goods, food industry having to pass on their costs to consumers in the form of higher prices. Is this something you're expecting to see at Chipotle?
Yeah, they do have good pricing, price leverage, and though they charge relatively high prices, they have very loyal customers. So I think their price hikes will stick.
They also opened 215 new restaurants during the entire year, because we did get those full year results as well. And then even breaking that down on a quarter basis, we saw that they opened up 78 new restaurants, and really 86% of those, including a Chipotle. What does that signal to you about the prioritization of ordering ahead and the consumer group that Chipotle continues to go after here?
I just really like Chipotle. I'm glad you brought that up, because those just really just improve their operating leverages, and building like so many of those into their new restaurants is just really great for their restaurant level operating margin. And so I really like that idea that they're going ahead with Chipotle's and Chipotle's that are dedicated only to digital and smaller store formats that they're using. So I really like those, and I really see that benefiting restaurant level operating margins in as we all know, a very tough environment for restaurants.
And again, we are seeing shares of Chipotle up about 7% in after hours trading after these better than expected results across most major metrics. But John Stasic is an analyst at Argus Research, and we thank you again so much for your time. We have much more Yahoo Finance coming up for you on the other side of this break. Stick with us.
Welcome back to Yahoo Finance Live, everyone. New York State's fourth largest city, Rochester, is taking steps to create a cannabis market economy to contribute to a guaranteed income program. So here with more on the budding industry is Rochester Mayor Malik Evans. Mayor Evans, great to have you here with us today. First and foremost, we've got to know, what has the initial response to the plan from local residents been like?
I think local residents are extremely excited. Marijuana is now legal in New York State, and as the state works on drafting its initial regulations for adult use, folks want to be involved. They want to know how they can get connected, and how we're going to use the tax revenue that we'll get from marijuana legalization.
Mayor Evans, this is Emily here. Thank you again so much for your time. When do you expect the sale of marijuana to be legal in the state of New York? And when do you expect, at least, for there to be some progress on that front?
Well, I think it depends on where New York State's Cannabis Control Board, when they decide to issue the final regulations, it is legal. Now, however, the sale of legal for recreational usage has to have some regulations and other, technical things attached to it. And I'm hoping that we hear more in the spring, at least. So what we're doing is we're getting ahead. We have a cannabis preparation commission that we have set up here in Rochester to look at the means, the matter of how we will go about, regulating marijuana at the local level in terms of where they can locate. But then there's another level of how we make sure we involve what we call the legacy market. A more fancy word for people who were on the underground market selling marijuana, how they then will be able to come into the mainstream and participate from a business perspective. So, all of those are things that we have to work on before you can have legal adult use cannabis, not only in New York State, but in Rochester as well.
For the legislation to move forward also comes the major conversation of decriminalization as well. And so where will you be able to retroactively look back and expunge any still existing records and perhaps provide even a job entry program if you're able to continue to move forward and move the dial on this potential program that would certainly have tax benefits as well for the state and, well, specifically for the city of Rochester?
Yeah, well, the good thing is that New York State has already put things in place where you can already start to expunge records for certain people who've gotten marijuana offenses. So that's the good thing. So there have been events all around New York State helping people who have gotten marijuana offenses under some of the draconian laws to help them expunge their records. So that's great. So a lot of what we're looking at now is what types of programs, incentives we can put in place in order to bring people into the marijuana industry. I mean, it's still complicated. It's going to take a lot of money for individuals to enter this market because, it's still legal at the federal level. It's not like you can go into your local bank and say, hey, I'm opening up a marijuana dispensary, give me a loan. You have to have a lot of that money fronted. So that's why it's important that you're able to work with either venture capitalists or other companies that are selling medical marijuana, which has been legal in New York for a long time, to help you get started. So those are all of the pieces that we have to help folks understand and put together, so that way those who are most affected by the draconian marijuana laws don't miss out on this huge opportunity, this bonanza of dollars that will be flowing as a result of legalization.
The Rochester City Council recently approved a proposal to pilot a guaranteed basic income program using funds from the Federal American Rescue Plan. If it does end up taking months to potentially years to see recreational marijuana sales legalized and providing funds for this program, could you rely on government funding for this basic income program, or are there alternatives you could use as well?
I think that's a great question. I think it has to be alternatives. We're doing a pilot. I think we're using a couple of $1 million, but for the government just to do it alone is pretty unsustainable. If you look at universal basic income programs or guaranteed basic income programs around the country, a lot of them work with philanthropic dollars or other private dollars. So if you're going to sustain a program like that, you have to have a public-private partnership, because government alone cannot sustain a program like that if you want it to impact it on a large scale. So this pilot that we're doing is relatively small. We hope to learn a lot from it, but I think going forward, if this is something that we want to take to scale and do in the long term, we have to make sure that we work with the private sector and philanthropic sector in order for it to be something that will be sustained.
You have a unique background as a former banker, as part of a federal credit union, and with that in mind, how has that kind of influenced how you are running the city of Rochester's budget and how you are thinking about everything from using tax dollars that could be generated from a marijuana program or advancing legislation there to dovetail into, as Emily was mentioning a moment ago, universal basic income and all of the intertwining elements therein for the city's finances, and where that could also provide a use case or a best practices case for other cities.
Yeah, absolutely. You know, my entire career has been in financial services, so I'm always looking at it from a couple of different angles. How we can use multiple streams of income, multiple revenue sources in order to do innovative things like universal basic income, but also how we can also use it for workforce development as it relates to not only just the marijuana industry, but also leveraging public-private partnerships in order to get a bigger bang for your buck. Because if you just rely on government resources or just private sector resources, you're going to lose those gaps. So you really have to create these public-private partnerships in order to bring programs that we know work to scale. So that's what I understand from my banking background, because whenever I would give someone a loan or any of those things, we would say, you know, where are your sources and uses of funds? And you would always look at someone putting in their personal funds and then getting maybe some grants from the government and then getting some funds from the bank, right? So it's the same thing in government. If you want to have a great program that you want to fund, you know, I have a youth to work program that I want to have where every young person gets a job. The city can't do that alone. We also have to rely on philanthropic and government support in order to launch something like that. So my background in the business has really allowed me to think more broadly. And also I have those connections, so I'm able to bring those to the office of mayor, and I'm hoping that it will pay dividends for the residents of Rochester.
All right, the residents certainly are hoping so as well. Mayor Malik Evans, Rochester Mayor, joining us here today. Thanks so much for the time. We appreciate it. And everyone, coming up, filmmaker and actor Mark Duplass of Morning Show and The League fame joins Yahoo Finance alongside Seton Sparks CEO, founder Emily Best, with the details on their new crowdfunding program that connects established filmmakers and industry veterans with emerging storytellers. That's next.
Creating a film, whether a short, series, or blockbuster feature, is no easy feat, and financing can often be a major hurdle to overcome. The film crowdfunding platform Seed and Spark aims to remove these barriers for emerging storytellers. Yahoo Finance's Alexandra Canal has a discussion with two individuals leading Seed and Spark's latest initiative. Allie, I'll let you take it from here.
Thanks so much, Emily. Very excited to be joined by Mark Duplass, filmmaker and actor, along with Emily Best, Seed and Spark CEO. And guys, Seed and Spark has a new initiative, the Patron Circle program, which invites established filmmakers and industry leaders to directly support stories from up-and-coming creators within the Seed and Spark community. Mark, you are among the initial wave of patrons, but what's cool here is that you get to choose who to support. What made you want to be involved with this? And what's going to be your criteria when it comes to finding the stories that you want to help bring to life?
It's a good question. I mean, I've been working with Emily and Seed and Spark for a long time now, and they have a deep history of sort of championing unsung perspectives in front of and behind the camera. And I think that relates to not only the kinds of people that are telling these stories, but where do they live? You know, there's no secret that there are gatekeepers in New York and LA, and these are the kinds of stories that are told from those perspectives. And unless we do something different, we're going to get those same stories over and over again. So for me, my priority is, you know, using whatever influence I have, a little bit of cash and some mentoring, honestly, and trying to find a place like Seed and Spark, who they have access to these incredible creators from all over the country. And those people with the democratized filmmaking tools, you know, how cheap it is to shoot something with your iPhone now. And they can really do something if you just give them a little bit of cash and a little bit of support. So that's really what brought me to it.
And Emily, the platform, this new program, it's so helpful to creators. We know the pandemic has been devastating to the creator economy at large. How have you seen Hollywood adapt over these past 2.5 years? And has crowdfunding become more difficult in this environment, or are you seeing people that really want to help out right now?
Yeah, I mean, I think at the top of the pandemic, everything contracted very, very quickly. And it was really difficult for creators to understand in this vast landscape of need where to locate their need to tell stories and the need for communities to have responsible representative stories told, like where that sat in the larger picture. And what we saw in 2020 was a great contraction, and creators really going back to the drawing board and figuring out, what is the format that I can use right now? What is the story that absolutely must be told right now? And then in 2021, we saw an almost complete recovery to pre-2020 numbers, and it's come out of the gate in 2022 absolutely swinging. So I think creators do what creators do, which is they use their creativity inside whatever constraints they're given. What we did see by the end of 2021 was creators they felt beaten down, they felt tired, they felt like they were carrying it all on their own. And the Patrons program was really one in a number of initiatives, certainly that we're taking, but that we see across the industry, to really support and inspire the creators who've actually been the ones driving the innovation in the first place.
And Emily, I want to follow up on that point, because we have TikTok, YouTube, social media. The accessibility for creators to create right now is astounding, but that also means more competition. So how has technology played a role within this new wave of Hollywood, and how do you advise creators on how to navigate that side of things? Because it's a lot different now than it was 10 years ago.
Yeah. So around 2018, our creators started to come to us and say, we have a problem. We're getting locked in an echo chamber. And as much as there are these great tools for democratization, those tools are tailored for shareholder value and advertiser value. They are not tailored for creative impact value. So a creator can make something, but then the algorithm decides what happens next. And what our creators were coming to us and saying was, we are being delivered like a heat-seeking missile to people who already look like us and already agree with us. And that is not why we make work. So actually, in 2020, we launched a product at Seed and Spark called Film Forward that delivers the films of our creators into organizations for education, employee engagement, diversity, equity, and inclusion training, leadership training, all sorts of different ways that organizations can leverage film to serve their needs. And that circumvents a lot of these sort of algorithmic blockades that the filmmakers were finding. So I think technology has been a huge boon because anybody from their living room anywhere can like reach an audience. The truth is the relationship with that audience is intermediated on those platforms in ways it simply isn't through crowdfunding. Through crowdfunding, you build a direct relationship that you own, and you own the rules for that relationship for the rest of your career. And that's why we've been doing this for a decade, and we will do it for a decade more, because it actually gives creators the tools that they need to drive sustainability, which is ultimately what will drive diversity in entertainment at the end of the day, is if creators get to decide what the rules are for how they reach audiences, not platforms.
Right. And with the rise of technology, we've seen the rise of streaming. Mark, you star in the morning show. We love you there. Your character especially is a favorite of mine. But this was an out-of-the-gate experiment for Apple TV+, brand new streaming service at the time of the premiere. And since then, we've seen so many new platforms come to market. As an actor and as a creator yourself, what have you noticed when it comes to the streaming evolution and how that's impacted the industry at large?
How many hours do you have to talk? I mean, I could go on forever. I think the long and the short of it is it's certainly creating a lot of opportunities, and the streamers, I think, are trying to do their part to tell different kinds of stories. But at the end of the day, they have to respond to their shareholders. And that does mean that there is a certain kind of story that is told because it's safer to be told. It reaches the target audience that they want to reach. And listen, I came up making movies with my brother for $3 in my kitchen in the suburbs of New Orleans. That's who I am at my core. And that's why I ultimately find my way to partners like Emily and Seed and Spark, because what they are essentially doing is putting the power in the hands of the filmmaker to tell whatever kind of story they want to tell. And when you have a platform like Seed and Spark that I love so much, you build that community there and you start to build your whole ecosystem so that you can become sustainable in there. And so I'm really lucky and really happy that I get to act, on a show like The Morning Show and be on Apple TV and make that cash. I mean, it's great. But ultimately, at the end of the day, I'm happiest when I'm scrapping with my friends, making a $15,000 movie like I came up. So that's kind of why I wanted to do this Patreon Circle, is to pay that back into it and also be a part of that. And we're hoping a lot of other people will kind of jump on with this.
And Mark, we only have about 30 seconds, but can you give us a little teaser for season 3? I mean, we have some other scandals in the news with Jeff Zucker, CNN, the Chris Cuomo drama. We know you guys like to rip headlines. So what do you think?
Yeah, I think if I said anything about what happens in season 3, Apple has a technology that could literally zap me right now and just poof me into thin air. So I'll be quiet. But, I will be back and the crew will be back and we're psyched to see what goes down.
All right, fair enough. Mark Duplass, filmmaker and actor, along with Emily Best, Seed and Spark CEO. Thank you both so much for joining us. Back to you, Emily.
And Alexander Canal, thank you so much for bringing us that chat as well. Coming up, happy hours here early. We'll speak with the co-CEOs and co-founders of Duke and Dame Whiskey for a check on their business and the spirits industry. Stick with us.
Welcome back, everyone. Happy hour starts in about 10 minutes on the East Coast here. So fitting we tee up the drink specials with the co-CEOs and co-founders of Duke and Dame Whiskey, Amani McCauley and Shima Burey. Great to have you both here with us today. Take us into this founder's journey. We know it's a heavily saturated market, but at a time where there is potential for new entrants to really make waves, what made you want to get into this part of the spirits industry, if you will?
Well, thank you for having us, Brad. Appreciate it. When we, and I'll let Chima kind of tell the origin story, but in terms of this particular segment, we really saw a great opportunity in the flavored whiskey space to create a brand that offered something very different to the consumer and to play in a space that not a lot of consumers, really knew about. So we saw it as an opportunity to really build a brand, build consumer loyalty in a space where you're not competing against, 1,000 different brands.
So Monty and I met working in New York and years ago came up with this great idea. The flavored whiskey space, obviously starting with Fireball, really exploded, followed by Tennessee Honey and Crown Apple. But for us, we wanted to create a flavored whiskey that was less syrupy and more like a whiskey. So we're actually only at 1 gram of sugar per serving in comparison to a lot of our competitors out there. That really separates us from those other guys. So it really makes a difference with the consumer, especially now with everyone paying attention to what they're consuming.
And Amani, where are most of your customers or sales coming from? Is it through your local retail partners, through cruise lines or resorts, or some other channel?
Yeah, most of our sales are coming through the liquor store channel, the off-premise channel. Industry-wide, it's usually about 75 to 80% coming from the liquor store off-premise channel, and we're no different. We do, have some online sales. You can purchase our whiskey online in 37, 38 states, but the bulk of it comes through liquor stores.
Tell us about the growth. Over the pandemic, we had certainly seen many people change their flavor profiles, perhaps shifting from some of the beers that they were drinking or even some of the hard and spiked seltzers into some of the more spirited beverages. What did that do for your business? And particularly from here, what opportunity does that open up as well in getting into even more of those states where you're looking to tap into the consumer base?
So for us, we saw great growth during the pandemic, like a lot of the spirits industry. We actually grew over 150% during it. For us, what really separated us, our ability to really the versatility of the whiskey itself. So we saw a lot of at-home bartenders. So a lot of people were making traditional whiskey cocktails, but because of the versatility of our brand, a lot of people were doing things like, let's say, whiskey mojitos or espresso martinis, and they were really seeing the depths of what they can do via YouTube and things like that, where they were actually finding different recipes where they can actually create at home. So we saw an explosion there, and then that also is actually going to take us into other states as well.
Amani, salted caramel is your flagship flavor over at Duke and Dame, but do you have plans to expand into other flavors or potentially even expand beyond whiskey?
Well, we do plan to introduce additional flavors. We wanted to build the brand with salted caramel first, really establish Duke and Dame as a household name, and then introduce a new product that people kind of already trust and love because of the Duke and Dame brand. This year we'll be working on a couple additional flavors and potentially other products as well. But I think we're going to stay in the whiskey space, but we'll be looking at other innovations around the core whiskey.
Really great to speak with both of you here today, and congratulations on the success you've seen thus far. We're going to have to check back in for some of that future expansion as well. Amani McCauley, who is the Duke and Dame Whiskey CEO and co-CEO and co-founder, and additionally here, we've also got Chima Burey, who is also the co-CEO and co-founder of Duke and Dame Whiskey. Gentlemen, thanks again for joining us today. We appreciate it. And everyone, as we're edging closer to the end of today's show, we want to give you a quick check on where the markets had ended here today, just to remind you of what we're setting up going into tomorrow. We're going to continue to track some of the after hours activity, but there you're taking a look at the Dow that ended the day in positive territory. That was up by a little more than 1%. gained 371 points there. S&P 500 and the Nasdaq Composite also both ended the day in positive territory. That does it for myself and my colleague and co-host, Emily McCormick. Emily, been an action-packed show here today.
Absolutely. And we'll see you all tomorrow. Yahoo Finance Live kicks it off at 9 a.m. Eastern. Stick with us then.